on a year-on-year basis. For Nykaa, the net profit has come in at 66 crores versus just 26 crores in Q3 of last year. So big jump there. Even the revenue has seen an increase of roughly 27% compared to the previous year. For Kaynes Technology, net profit has come in at just 77 crores versus the estimates of 106 crores that we were working with. Even the revenue has been below estimates at 804 crores. Lastly, Physics Wala has also reported its Q3 numbers. Net profit seeing an increase of roughly 10% compared to the previous year. Revenue has also gone up by roughly 34% for this one.
Riya, thank you for that update there. And over to Mangalam now, joins in with cues from the FNO space. Mangalam, good morning. What's the data indicating?
Good morning. So the data is indicating that perhaps the post-India-US trade deal rally has more or less fizzled out. Yesterday, there was weakness in the frontline indices as well as the broader markets. But the only glimmer of hope is that yesterday's low was pretty close to the previous trading session's low. And to that extent, we have some support at lower levels. The FII flows, they fizzled out in the cash market. After buying 5,000 crores post the trade deal announcement yesterday, they did not sell. And then today, as we go into trade, they have sold about 2,150 crores in cash. And similar is the case with reducing purchases in index futures. They've begun to cover short positions, but they've now yesterday also unbound some of the long positions. So after buying 6,800 crores, 1,800 crores, yesterday the purchase was just 500 crores. And the FII longs, which were at 19% day before yesterday, are now at 19% as well. So a large part of that up move has happened via short covering. Now, with the market being what it is and the GIFT Nifty indicating a lower start, the put writers are active at 25,600, call writers are active at 25,700. That tells you that the range that the Nifty is hoping for is 25,500 to about 25,800. And that's exactly where the technicals are as well. We are at the 100-day moving average, which is between the 20 and the 50-day moving average, and that's the large range. Today is RBI policy, so the Nifty bank will be extremely crucial. Yesterday, it did not fall so much, held above that 60,000 mark. 59,400 to 59,500 is a crucial support zone for the Nifty bank. Finally, looking at stocks, Nykaa reported a great set of numbers post-markets. A lot of long positions added out there. Also longs added on Jubilant Foodworks and Page Industries.
Mangalam, thank you for that. We'll keep an eye out on those important levels on the index and, of course, the Nifty Bank as well. Speaking of that, the Reserve Bank of India will be announcing its monetary policy decision today. Ritu is here with more on what we can expect. Ritu.
This monetary policy may not be about rates at all. It's really about liquidity. With inflation benign and growth steady, the Reserve Bank's focus is now on ensuring that past rate cuts transmit smoothly through the economy while keeping its powder dry. And that is exactly what the CNBC TV 18 monetary policy poll is also signaling, with an overwhelming 90% of the respondents expecting the MPC to hold steady despite having the room to cut, with only a very small minority still betting on a 25 basis point reduction. Interestingly, the number of people that were expecting a cut was a tad higher before the India-US trade deal was announced, but now the market believes that the deal has eased the pressure on RBI to provide any immediate stimulus. Now, looking beyond the meeting, the message is even clearer, where 70% believe that RBI will stay on pause throughout this calendar year, with barely one-third penciling in one more rate cut. And for now, no one is talking about hikes. So if not rates, what is RBI going to focus on? That is liquidity. Now, despite record high open market operations this year, bond yields have been stubbornly high, and the street expects that the central bank will step up support either through more OMOs, possibly even a CRR cut, longer dated VRR operations, Operation Twist, everything is on the table to cool down yields. Any talk on liquidity is also going to be keenly watched. Now, on the currency front, rupee volatility has been a concern, but the markets don't really expect any targeted intervention. Instead, RBI will likely stick to the long-standing stance of not defending any specific level. Now, our respondents see the 10-year yield settling around 6.7 to 6.8% by March, while the improving sentiment after the US trade deal could see the rupee strengthen to below 90 by March. Now, as for the macro forecast, don't expect any major change because you have the new CPI and the GDP series that is just around the corner, so RBI will leave these as is. Now, economists on their end see the FY26 inflation inching up to about 2 to 2.5% on the new base, and then rising towards 3.8 to 5% kind of a range for FY27. The bottom line is expect a neutral tone from the RBI this time, a wait-and-watch policy, and a policy focused less on the rate action and more on liquidity management.
Ritu, thank you for that. All eyes on RBI Governor Sanjay Malhotra in just a few hours from now. Take a short break. All the action from Wall Street on the other side. Stay tuned. Welcome back onto Wall Street action then. Losses extended across the benchmark indices following another day of tech-led sell-off. The Dow shed over 600 points. The S&P 500 was down over 1%. The Nasdaq fell over 1.5%. And that took the worst three-day performance for the Nasdaq since April of last year. CNBC's Kate Rogers gets us a wrap of all the action on Wall Street.
U.S. markets were down sharply across the major indexes in Thursday trading as the tech trade continues to weigh down stocks and new jobs data raises concerns of a weakening labor market. The Dow tumbled 593 points, the S&P 500 lost 84, and the Nasdaq was down 364. Bitcoin fell below $63,000 Thursday for the first time since October of 2024, as investor confidence falters in the asset once called digital gold and a unique store of value. The cryptocurrency is down 20% this week alone. Bitcoin peaked at $126,000 last October. And outplacement firm Challenger Gray and Christmas reported Thursday there were more than 108,000 layoffs in January, the highest January number since the global financial crisis, and up 118% from a year ago. At the same time, companies announced just 5,300 new hires, which is also the lowest total since Challenger began tracking it in January of 2009. That's what's happening here in the U.S. Back to you in Mumbai.
Kate Rogers, thank you for that. On that note, let's listen to Drew Petit of Citi Research, who shares his thoughts on whether the tech-led sell-off is seen in the markets this week is a sign of the market entering a risk-off or just a rotation out of tech names. Listen in.
I would say more of a rotation. Look, when you're fully valued, any incremental news flow is going to have a lot more effect on price. There's just no margin of safety. I'm not going to say late or end of bull market, but we're definitely not in the early stages of a bull market, especially when it comes to growth. So against that backdrop, you get more idiosyncrasy, you get more volatility, and that will be two ways. And honestly, what you've been alluding to leading into this, we've probably had, it feels like 2 years of news flow and news cycle in about a month.
Take a short break. Cues from the commodities market on the other side. Stay tuned. Welcome back onto the most awaited segment on the show. Considering what's been transpiring recently, Manisha Gupta is now here with all the commodity updates. Manisha, good morning. It seems volatility has now become an understatement. Manisha, if you could hear me, what is something that you are tracking this morning? It seems that we have lost the line with Manisha, but it does appear that volatility is indeed an understatement, because if you look at the silver prices earlier this morning, the spot prices were down to as low as $64, and they have now staged a recovery. They are now turned into positive territory. They are now above the mark of $70 and are now at 71.66, 0.6% higher, while falling as much as 10% on an intraday basis. That's the kind of swing that you have seen on silver. Gold too has seen a bit of a reversal, is now back towards that mark of $4,800. But on that note, we take your leave on this edition of Power Breakfast. Bazaar Morning Call on the other side to set you up for the final trading day of this week.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV 18 Moti Oswal studios. Finally, it is Friday. It's that kind of a week. It's been that kind of a week where Tuesday felt like a Friday, Wednesday felt like a Friday, Thursday felt like a Friday, and here we are on a Friday finally. You know, don't take my shirt color for what the market will look like. It's a sea of red across the board. We're coming to you from the CNBC TV 18 Moti Oswal studios. I'm Prashant, Nigel and Reema with me. Guys, morning.
Hi, and we're not going to end this week without a lot of action. We've got the RBI policy, lots of earnings reaction. And as you said, it's red not just across equities, but across commodities, crypto assets. It's all happening this week.
Well, that's right. I hope Prashant's got the color right, though. Maybe we start off in the red, but I expect India to outperform. So let's hope that goes. And no bigger week than this, right? You have the budget, you have a trade deal, you have earnings, and you have the RBI policy. Prashant, party hard over the weekend. You deserve it.
I'll tell you, week on week, it looks like, I mean, if you do a Friday to Friday kind of close, the market will be where? I mean, not very much by way of change, right? But, you know, you got to live day by day. And day by day, it's been basically trench warfare, you know? Just one sector, the other sector. It's absolutely been crazy.
And just when you thought things are improving for us, right? Like finally, India's time to shine with the India-US trade deal. The global market started weakening.
Well, that is markets for you, always unpredictable and take the path which the least number of people expect, right? Let's just take it from the top in terms of what you need to know. So absolutely ugly session overnight. And, I thought about the word to use, but it is ugly. No other way to put it. Stocks falling off a cliff. I mean, 8%, 10%, 15% on Wall Street. NASDAQ down 1.6 odd percent. S&P down about 1.2 odd percent as well. Now, software is a large reason, software stocks is a large reason why the market kind of rolled over. And this is the pack. And this is important for India as well. EPAM down 4%, Globant down 4.5%, Gartner down 4%, Accenture down 3%. We were the first to highlight this on Wednesday morning, that this sell-off is starting. And we've, of course, got your opinion on Wednesday. We got your opinion on Thursday, that is yesterday. And we will get you a good opinion today as well in terms of what to do with software stocks. By the way, the ADRs, you look at the Infosys ADR and the Wipro ADR, they were flat. I mean, 1/3% up, 1/3% down, so not very much. But the other names, and these are also large software names in the US, they did sell off. Now, with the correction we've seen, the S&P 500 is testing its 200-day moving average, which is the long-term, in a way, Lakshman Rekha. The NASDAQ is down 6%, 6 point something from the all-time high. Now, I've put this table up earlier as well in a different context, but, it just makes sense to just pull back and zoom out and look at where we are. These are the correction on the NASDAQ that we've had over the last 1 year, right? Starting with the January correction of DeepSeek, which was 7%, Liberation Day, which was April, which was 15% for NASDAQ, and just a kind of a fatigue of the rally kind of sell-off, which happened between October and November last year, late last year, when the NASDAQ gave up about 8%. And this one so far from the highs is about 6.15%. So it's not as if it may feel like, the markets had this one-way correction and now you're set for this massive, wipeout. But it's not like that. And this is just the 12 months. I could go back and there's the yen carry sell-off, et cetera, et cetera. The point I'm making is we've had these routine, and 4 of them in the last 24 months, this included, we've had these, 5% plus, 15% corrections, and the market's done well, and they've come back from these pullbacks. The broader theme in the US, right, that may change, has been very strong growth, the economy running red hot, a Fed which is likely to cut rates, especially egged on by President Trump, with, of course, his new appointee taking charge, I mean, if his nomination is cleared, etc. So these are the 2 big kind of focal points. Now, markets can do their own thing because they've done so well. But, I mean, just keep this in mind before you sort of, call doom and gloom for global equities in that sense. I mean, this may run for a little while more. I mean, we've had, as I said, we've had 15% falls, and this is only 6 odd percent. But that's a sort of perspective, I think, which you must remember. Now, this is precious metals. Silver futures, 21%. And this is just 1 day. Silver is down 50. It's halved in 7 trading sessions. Gold futures down 4.6%. So absolute kind of bloodbath. And we will discuss this with Manisha a little later in some detail. Dollar index, well, that continues to creep higher. It's 1/3% higher to about 97.96. 10-year yield lost about 9 basis. It's basically risk off. I mean, bond prices went up, yields fell. Oil prices were down 3%. Again, risk off, right? 67.36 is where oil prices are at right now. There's the US-Iran thing, which again is important. bulk of this, all this, geopolitical changes, etc. I mean, the big stuff has all happened over the weekend, and we're heading into another one, especially. So I think that's going to be something to watch. Now, as I said, so many stocks sold off, and I was making this point. Apple didn't rally after numbers. Palantir didn't rally after numbers. Alphabet, same thing. And now you got Amazon, right? But of course, with Amazon, it's the capex number, which basically to the market indicates that you're still investing, and the ROI perhaps is far out. Bitcoin, that's the other one. I mean, we only here use Bitcoin as a risk indicator, especially retail sentiment in the US. Bitcoin is also down 50%, almost 50%, 65,000, below 65,000, and it's at the lowest since October of 2024. I mean, news flow, both ECB and Bank of England kept rates unchanged. There's weak headline numbers in the labor market and the challenger job cuts, etc. We'll talk about this in a little bit from now. No jobs data tonight. Friday around US market open is when you get the jobs number. It's not partial government shutdown. I think numbers are due coming Wednesday. And you have, as I said, I mean, here's a Fed which will stay on hold or perhaps even cut. The Fed's Bostic essentially saying that FOMC should hold rates steady in 2026. I'll just put out one level. I think this is what I've put out for the last 3 days now. It's the gap. A Tuesday over Monday, which is Monday was the big 600, 650 point gap up. And then compared to Sunday, basically Monday over Sunday, that gap is 24,450 to 25,640. I mean, I'll say this, that I'd be very surprised if the market here falls with the same intensity that the US market has fallen. It can't go the other way. It can't be that global markets are around 1.5%, 2%, and we're up 2%, but we should fall less. And 25,500 approximately, roughly, should hold. So let's see as we open up this morning. GIFT Nifty will give you a quick sense of how we're likely to start. It's about 100 points lower on the GIFT Nifty. So indicative open minus 100. Nigel, how's the positioning looking?
Well, Prashant, I take that point, right? I think India will outperform from here on. And the other point is with cryptos as well as silver and gold seeing some kind of a correction, I think that movement to equities will continue yet again. So that's good. But it takes time, right, to break a bad habit. And in fact, the FIs, they have turned sellers yet again in yesterday's trading session after remaining buyers for a couple of trading sessions. So the FI net sell number should come up for you on the screen. And I think there is some kind of rotation that's taking place out from, the tech names, some of those banking names as well. They have been under pressure. And net, if you look at it, institutions were sellers in trade. What did they do on index futures? Well, they went ahead yesterday and they covered some short positions, as this is telling you, but they unwound some long positions as well. But they still continue to remain net short, with close to around 81% of their positions on the short side. Well, a couple of other data points as well should come up for you on the screen. The FIs in yesterday's trade, they added more shorts than longs on stock futures. And on index options, that's quite interesting, because after a while, we saw aggression with regard to writing of calls. In yesterday's trade, close to around 8 calls were written for every 1 put. Put everything together, the FI sell number in the cash market continues. It's relatively lower than what we have seen on the past, while the short positioning continues in the futures and options space. I'll tell you what, that's not such a bad thing. You don't want them to turn very, very big sellers, but you want shorts in the system, and that's precisely what they're bringing to the table. Because of the kind of call writing that we have seen, well, we've seen the PCR come down yet again. A couple of trading sessions ago, it went to around 1.15. Well, that's come back down to around 0.8. So it's closer to the lower end of the range. And the reason is that we saw call writing yet again. So the 25,700 call, that was written very, very aggressively. You have the 26,000 call as well, mixed activity being seen out there. But there is writing being seen at, at these levels. I think the markets will outperform from here on, the Indian markets, going by the cues that we have and going by the underperformance that we have seen. And the first reference point that you have, both on the Nifty as well as on the Nifty Bank, you have the 25,450 on the Nifty, which is the 20 DMA, and on the Nifty Bank, around 59,400 or thereabouts. Till that holds out, you'll still see the trend is still up. Over to the RBI Governor. Let's see whether or not we can see a bit of a surprise in today's trading session. But otherwise, after cooling off yesterday, gap down today, expect some kind of recovery at some point of time during the course of the day.
Thank you very much for that. Straight away, let's get in our guest this morning, William Lee, Chief Economist, Managing Director at Global Economic Advisors. William, great to have you. 3-day slide on the NASDAQ. It's off about 6% from the highs. Is this the start of a deeper correction? How have you analyzed?
It's really remarkable how split the market's been, and the brunt of the selling is really where the brunt of the buying was not so long ago. So it seems like it's very focused on the tech market and the AI-centered massive investments. And in my mind, it really all started with Microsoft's announcement that they had spent a lot of money yet again on CapEx. And I think the concern about software companies like Microsoft getting return on that investment is something that's starting to drive markets. But I think to the overall uneasiness of markets, especially in crypto markets, is broader than just the AI trade and broader than technology. I hate to say it, but I think my appearances on here of warning investors about what Kevin Warsh means as a Fed chairman may have something to do with people reconsidering the plentiful supply of liquidity they've been so used to all these years. If he is appointed and confirmed by the Senate, that's going to come to an end pretty soon. And I think the world is going to have to start deleveraging. And I think the brunt of that is being felt to the crypto markets right now.
William, hi, morning. I put that table up, right, which is the NASDAQ and the falls we've had. Let's put this up. We've had 7%, 10%, 15%, last 12 months, right? Because when you're living it, it feels like it's just been a one-way kind of move higher.
Right.
And the point about and I sort of put out a few pieces on the new Fed chief and his thought process, etc. But the point is, as they say, anyone who's an outlier comes into a system like the Fed, they kind of fall in line with the consensus. I mean, they can't do anything wildly different. And of course, I mean, add to the fact that President Trump going into midterms would want a stock market which is strong, not low. So, I mean, what's your sense? I mean, could this really be the start of a big rout across, which is like 15? Is it the 15% fall, or like a, we're already down 6% from the top, like a 8-9%, and then we're done? What's your sense?
Well, first of all, I think everyone should be expecting some kind of a market correction after the massive run-up that we've had so far.
No doubt.
And last spring was a good time for it to occur. This spring, I suspect, is probably another good time for it to occur. But I think the overall anxiety about having a shift in policy is something that people are trying to get over right now. At first, they didn't believe that he would be as serious as he is about being a hawk on inflation, which does not, as I said, necessarily mean higher rates, but certainly means much less liquidity in the financial system, smaller Fed balance sheet. Those are the ingredients, I think, that make up the concern for highly leveraged positions, and the fact that legislation on crypto has stalled in Congress has made that specific market much more nervous, just as there are specific factors in the tech market that have made software companies much more sensitive to the rout than say the hardware companies. But everyone's taken a beating in that everything was overvalued to begin with. But now the issue is, will it be a fast whoosh down and then it'll come to some equilibrium and start to rise again, or is this the start of yet a long, prolonged whoosh down? And in that case, that would be something very serious. That would be something that President Trump would not welcome. I tend to think it's not the latter, because I think the sense that we have someone who's very serious about ending Fed mission creep, slimming down the balance sheet, and joining the Trump administration in limiting the mission creep of the Federal Reserve. Those are the things that I think are taken up board much more seriously. And I think we're trying to separate what is mission creep from Fed independence. As I said repeatedly, I don't believe this is an attack on Fed independence, but it is an attack on Fed overriding mission of expanding its mandate over the last 20 years. And that is something that has to be limited.
All right. Hi, William. Good morning and good to see you, Win. William, what about the Indian markets? We have underperformed in terms of equities. The Indian rupee as well has been relatively weak. But now the pieces are coming together. We've got that trade deal with the United States. Details are awaited, obviously, but it's a sentiment positive. The budget was pretty okay with regard to their focus on capex as well. And the rupee is showing some signs of stability. In that sort of environment and giving the underperformance, do you think India outperforms from year on?
I mean, since I've been on last, I mean, a remarkable shift that you just rattled off, right? India, Prime Minister Modi's gotten on the phone with the key players in the world and seems to have made everybody happy. So that alone, I think, is a good gesture that would place India in a very good position relative to the rest of the world. But my own fear, and probably for those of global investors, is, well, words are cheap. let's see India actually do the stuff. Let's see it open up some markets for foreign exporters to come into your marketplace. And let's see you stop buying more Russian oil and switching to, say, American or Venezuelan oil. And that takes time. So I think in terms of skeptics out there I think are plenty, and enough skepticism may hold back the kind of market rally that you were hinting at earlier.
William, you said that the unease in the markets, the fall that we're seeing, the brutal sell-off in crypto markets perhaps has to do with the appointment of Kevin Warsh. Now, it's a 4-year term and his appointment is still yet to be confirmed. But what's your own expectation of what year one of Kevin Warsh, if he is the final Fed chair, going to mean for the markets? What do you think he will do?
I think it would.
Yeah, go ahead.
Yeah, I think he's fantastic news for the market because, where the markets really want someone who's an inflation hawk, who's serious about limiting inflation, but at the same time, well aware of the imbalances in the U.S. economy, especially in the jobless economy that we're getting right now. But more importantly, I think the issue is, can the Fed restore its function to be the central bank that it was when it was so good under Paul Volcker, say, where its mission was price stability, full employment, and banking safety. And if we can limit the Fed to that kind of a task, then it would fade into the background. We would not be talking about the Fed if it were doing its job. But the fact that it's in the headlines every day, I think, shows that the Fed really has overreached, and vice versa. The federal government has underperformed because a lot of the issues really that concern the Fed and markets is the overwhelming rise in federal debt, and that is not the Fed's fault. That is where Congress has to step in. So I think the juxtaposition of stars is one where Kevin Warsh is an alignment that will be very market favorable in the medium to long term, and getting over from here to there, getting over the anxieties of what his policy shifts might produce in markets is something that the markets, I think, can get over relatively quickly. But we'll see if that comes true.
Okay, all right. Thank you very much for joining us. Really appreciate your time on CNBC TV 18, and look forward to our next one. Thank you. Well, we'll just run you through what's coming up here in terms of programming. So we have at 8:35 the management of Kaynes Tech joining in to discuss the third quarter numbers. 9 o'clock we'll be joined by Bhavin Shah of Sameeksha Capital, IT in Focus. Bhavin, perhaps one of the oldest IT analysts, not age-wise. I mean, the number of years he's perhaps looked at it. 9:20 Manishi Chaudhary of Emma Capital will be our market voice, and 9:30 the Hitachi Energy management joins us on the third quarter numbers. Uno Minda is our 9:40 guest, December quarter, and the outlook ahead. 9:45 we have Kaushik Das of Deutsche Bank, Parul Mithil Sinha of Standard Chartered, Lakshmi Iyer joining in of Bajaj Finserv, head of the MPC policy.
Well, time to slip into a quick break. We've got a lot of stock-specific action to focus on the other side. We'll get to that in just a bit. For the time being, I'm giving you a sneak peek into the list. We have Bharti Airtel, Hero MotoCorp, Nykaa, Hitachi Energy, Mastercard, Doc. All of them will be reacting to positive news flow. Add to the list data patterns, physics, Wala, ILIC. While on the flip side, Kaynes Technology could be the stock on the downside, while Tata Motors PV as well will be the other stock that could react mixed. Take that break, come back, we get into further detail on all of these names. Welcome back. You're tuned into Bazaar Morning Call. You're on CNBC TV 18. As promised, let's get to stocks that are in focus. Our research team is standing by to run us through that list. And first up, Rima, tell us about Bharti Airtel.
Well, numbers are largely in line with expectations on a consolidated basis. Where the beat has come in is on Africa, and Africa numbers came out a couple of days back. Africa actually was a very strong performance. The revenues went up 40% year on year, and in constant currency, it went up 25%. And that's because one of the key markets, Nigeria, they had a tariff hike. So Africa was a standout performer. When you look at India, largely in line, the company's revenues for the India mobile business went up by 1.9%. On a year-on-year basis, up 9%. Subscriber ads were at about 4.5 million in the quarter. ARPUs inched up, so 256 became 259. But in the absence of a large tariff increase, the ARPU increase has been about 1 to 2% on a quarter-on-quarter basis. The bottom line got hit on account of the labor code impact. That's the reason why profits went down 2.4%. But all in all, it's a good set of numbers. There's a conference call today at 2:30 p.m. India in line. Africa was the big beat when it comes to Bharti Airtel. But there's Nykaa as well, and there's some upgrades, I can say.
Well, that's right. Mangalam joins us to bring us the good news of the day. Hey, Mangalam, morning.
Good morning. So it's a brilliant set of numbers coming in from Nykaa. We already had the top-line performance given the company's quarterly updates, but the extent of which EBITDA beat has come by has the street by surprise. Jefferies actually calls it a picture-perfect result. In fact, it's over 13 quarters since the company has reported over 20% growth, and revenues of the company grew 27%, the EBITDA grew 63%, and the net profit obviously followed. 156% jump is what we saw out there, and this despite a 10 crore one-off impact coming in. So had it not been for that extra decline, the net profit would have been 78 crores. So that itself, 7% revenue growth, 70+% EBIT growth coming in. A large part of the growth coming in by their own beauty products. House of Nykaa is what they call it. Fashion as well, very close to break-even, and the company had called for break-even in the second half of this year. So maybe by the fourth quarter, that business breaks even as well. All these factors should take the stock in green today. Though, remember, it had seen an up move in yesterday's session already. The beat is far higher.
Thank you very much for that. Hero MotoCorp numbers are in line with expectations. The company's revenues went up by 21%. This was driven by a realization increase of 4% and a volume jump of 16%. Margins have come in line with expectations, expanding by 20 basis points to 14.7%. The other one that we're tracking is Tata Motors passenger vehicles. And here the revenues have missed the mark. The company's revenue growth came in at 24%, and this is lower than expectations of a 30% increase. Margin performance, though, was better than expectations. EBITDA margins at 7% versus a poll of 6.8%. Now, the India business is improving, but JLR is a drag. JLR revenues were down 39% and EBITDA margins came in at 0.7%. Now, the company had lowered the guidance earlier, and yesterday they reiterated the JLR guidance, which is EBIT margins between 0 to 2% and negative free cash flow of 2.2 billion euros. And the company says that they expect a sharp recovery in Q4 led by JLR volume normalization. So all in all, it's a bit disappointing. JLR is a bit of a drag this time for Tata Motors passenger vehicles.
Okay, all right. Thanks a lot for that, Rima. But hopping across to Vinny, who we're twinning today. Vinny, tell me about Hitachi Energy.
Nigel, Hitachi Energy is also a great set of numbers that's coming from the company. Strong execution that one is seeing, revenue growth of around 28% for the quarter. We're seeing strong order book as well this time, in terms of the order backlog that is there at 29,872 crores. Order inflow is also coming at 2,477 crores. Obviously, when you compare it YOY, you may see a decline in order inflow, but that is because last year it was a high base. There was one of those big HVDC orders that had come in. But apart from that, if you exclude that order, it's a good growth that one has seen coming in. Now, obviously, margins, which have seen a 600 basis point expansion this time, that is mainly the second consecutive quarter that we're seeing this mid-teens growth come in terms of margins. And that is expected to continue, given that the management has said that there are no penalties that they're envisaging in the Maharashtra HVDC projects. So margins likely, hopefully, would sustain at these levels. But as of now, a good quarter coming in from the company. We've seen some of the analysts even upgrade or increase the target price for the stock as well. So green expected here.
All right, thanks very much for that. Mazgaon Dock and Data Patterns are two names on the defense side we want to focus on. Ria's got details. Ria, morning.
Well, good morning. Let's start off with Mazgaon Dock first. Overall, very strong quarter for the company. Revenue growth has been healthy at 15% this time around, and this has been led by a recovery in execution. Some of the large frigates are close to delivery, so that is what has led to revenue growth. EBITDA and net profit have each increased by roughly 9% on a year-on-year basis. Margins, however, have contracted by roughly 136 basis points to 24.6%. And overall, the profitability, however, has been supported by a sharp decrease in subcontracting expenses, which have nearly halved to 209 crores. In terms of the provisioning, we have seen slight bit of provisioning in this quarter, roughly 33 crores. Remember, in the last quarter, the company had reversed liquidated damages worth roughly 102 crores. And in quarter 4 as well, they are expecting another waiver of LDs of roughly 100 crores. And last time they had said that there will be no major provisioning surprises going ahead. In terms of the order book, that stands at roughly 24,000 crores, down roughly 13% compared to quarter 2. But the order book is likely to exceed 1 lakh crores by the end of FY26 if the P75 order comes through. So overall, good set of numbers for Mazgaon Dock. For data patterns as well, very strong quarter for them. They have beaten estimates across the board. Revenue growth has come in at roughly 48% versus estimates of 32%, and this has been driven by a very strong execution pickup. And there was also a low revenue base in quarter 3 of last year. EBITDA and net profit have also increased by 49% and 30% respectively, well above estimates of 8 and 2% growth. Margins also very strong at 46.5%. Even sequentially, we have seen a very strong margin recovery for the company. However, gross margins have declined by roughly 280 basis points compared to the previous year. In terms of the order book, that also stands strong at roughly 743 crores at the end of quarter 3. And as on date, the order book is roughly 1,867 crores. The order inflow has been a little bit muted at 243 crores versus estimates of 550 crores. But going forward for the remaining part of the year, the company has said that they are expecting roughly 500 crores of order inflow to come in.
Thank you very much for that. Over to Upasana now for LIC, Physicswala and Kaynes Technology.
First up, let me start with LIC. Overall, the numbers are good. It beats the street estimates. New business premium and VNB margin above street estimates, while it's a slight miss on AP front. Now, coming to new business premium, there has been an uptick of 32% on a one-wap basis. VNB margins, there is a strong beat here. They stood at 21.2% versus the expectations of 18.7%, and largely on a one-year basis, there has been an uptick of 182 basis points. Coming to AP, it has seen a strong growth of 49%, while the street was estimating somewhere around 55-60% growth. So slight miss on this front, but overall numbers seem to be good. Next up is Kaynes Tech. Overall, it's a weak quarter for the company. Numbers are below our poll. It's a miss across the board, be it revenue, margin, PAT. It's a miss throughout. Q3, the revenue growth stood at 22% versus the poll of 50% growth. And also, company has missed its Q3 revenue guidance, that is of 1,300 crore. Now, coming to the 9-month numbers, the 9-month revenue saw an uptick of 37% on a one-year basis, but company has only achieved 54% of its full-year guidance, that is of 4,400 crore. Order book, it has seen a sequential uptick of 12%. Now, coming to company's quarter results, that is Q3 numbers, revenue saw an uptick of 22%, EBITDA margin saw an uptick of 60 basis points at 14.8%, and PAT saw an uptick of just about 15%. Next up is Physicswala. Overall, the numbers look good. Revenue has seen an uptick of 34%, EBITDA up 29%, EBITDA margins down 90 basis points at 21.8%, and net profit has seen an uptick of 10%. So overall, if we see company's 9-month numbers, they have surpassed the full year, that is FY25's revenue growth. So 9-month numbers, they are standing at 2,981 crore versus the FY25 numbers of 2,886 crores.
All right, thanks very much for that. Commodities, right? And Manisha is here. Manisha, morning. Take your pick, gold, silver, Bitcoin. What's on your mind?
Oh, well, absolutely. You know, one thing is very clear, Prashant, that we are looking at lower lows in many of these commodities and asset classes. I'll start with gold, for example, and we've seen 4,600 coming yet again. So we are testing those lower levels again and again. So we are down 3% on a week for gold prices. It's a second weekly decline coming in for the markets. It's profit-taking, easing geopolitical tensions, strength in US dollar, all of that weighing into the markets. A bigger volatility clearly seems to be coming in for silver. It's trading at a 7-week lows now. It's seen a 9% decline in the overnight markets. We've seen $64 an ounce on the lower side. It's trading at 71 right now. So it seems to be breaking that $70 and $90 of a range and testing newer lows. Interestingly, on COMEX, we've seen a bit of a buying comeback and it's trading above 70. But when you look at the Shanghai, China's exchanges, it has continued to decline even further. So what we are looking at is some disparity between various exchanges, whether it's about China, London, and New York, and that arbitrage opportunities and the fact that people are buying somewhere and selling somewhere else is also seems to be emerging into the markets there. And then, of course, it's about platinum, down 7% overnight. Crypto sell-off seems to be really extending even further today. Bitcoin is now spiraling towards 60,000. It has seen a 10% decline in the overnight markets. This is the worst one-day drawdown since that FTX blow-up that we all remember. Analysts tell me that 200 days moving average comes at 58,000. If that level also is taken in Bitcoin, then we are looking at further very sharp declines coming in for this one. Just to remind you that an all-time high of Bitcoin has been 126,000. We are trading at 60,000 right now. So almost 50% gone from all-time highs.
You know, we used to talk about Bitcoin halving, right, Manisha? It's a thing.
Yeah, that was last
Bitcoin.
year. And
I think it's happening this year as well. Well, I think, thank you very much. And we'll talk more. I mean, commodities, of course, is going to be something we'll focus on extensively. There's a Chinese Lunar New Year holiday coming up, but it's about a week out, so perhaps some readjustment, risk management ahead of that, and a bunch of other things. Manisha, thank you very much. We take a break. The Kaynes management with us. Numbers are a sharp miss to what the consensus expected. Stay tuned, coming up.
Welcome back. Let's focus on Kaynes Technology. That's the company that delivered its numbers yesterday. The numbers were weak. The guidance could be actually now a tall ask for this year. And also, the net working capital cycle got elongated. To help us out with a quick analysis of what went on and what's the way ahead, we have Mr. Jairam Sampath, the Chief Financial Officer at Kaynes Technology, who joins us. Hi, Mr. Sampath. Good morning. Good to see you in. So the street will be a little bit disappointed because there was no hint of this sort of a howler coming in. So clarify a couple of aspects. First, in Q3, was there some kind of one-off? Was there some kind of revenue that hasn't got reflected, that will get reflected in the Q4? And also, what is the revised guidance for FY26? Because it appears now that it's a very, very tall ask. You've only done 55% of what you promised. Go ahead, sir.
Yeah, good morning. Fundamentally, the business, ironically, is probably poised at its best at this point in time. And yeah, there are this quarterly numbers that is expected despite a 3-quarter growth of about 37%. People do expect more, which I take it as a positive sign because I think it means that the public and the investors and customers, everybody are asking us to realize our potential. So having said those few comments, fundamentally this year we will do in the Q4 about 1,700 crores so that we can take up the quarterly number to about 4,100 crores. And mind you, this is without adding a particular product that we have developed for the railways, and a new version is being created for that. And so that is a postponement for about 300 crores of business. So we are talking about a...
Mr. Sampath, sorry, just the numbers first, sir. Sorry, this is, you said we will do 4,100 crores for what period?
For this FY26.
Okay. And that is against what you said earlier?
4,400.
4,400.
Yeah, 4,400 was consolidated basis. This is primarily all the revenues have come in from EMS sector. We did have, we are still tentative about the OSAT numbers of being anything significant this year. So we let it play out.
Got it. What about margins, Mr. Sampath? They're at 14.8. What happens here? They're about 150 basis points lower than what the street expected. What happens to margins?
So margins will be around 16%. Of course, we did have a small expense out of the labor code change. But other than that, I think this year we will deliver about 16% on the EBITDA number. And PAT number will be definitely 2-digit. And I don't think we will miss out these two numbers. And fourth quarter number, revenue number, in case you did not register it, is about 1,700 crores what we are planning. We have already 1 month done, and we're quite confident that we'll deliver that number.
Sir, is there any number on consolidated revenues for FY26 and also on net working capital days? That is spiked up to 139 days. What led to that, and what will it come down to by the end of Q4?
Yeah, so I will answer the related question too, which will be the follow-up question. See, fundamentally, people are looking forward to us to implement all our CapExes early and then make sure that we are operating cash positive. We pretty much came very close to being operating cash positive on a standalone basis in the parent company, that's KTIL. We just had about 55 crores of, let's say, minus negative cash flow at the operating level. But at the end of the year, the operating cash flows for the consolidated number will be positive and significantly positive. That's point number one. And this is possible because we will most probably improve the inventory portion of our working capital, because the inventory has kind of ballooned up a little bit because of delayed execution of certain orders and so on. And now we have taken stock of the entire situation, and we are hopeful that we will be able to deliver on the working capital, net working capital number, which last year stood at about 85. So this year we are saying 85 to 70 days, somewhere in between there. And we have another 2 months to go. So let's see where it...
So Mr. Sampath, just to clear the air, as you said, Rima asked you the question, you went down to the working capital, and then you went to the operating cash flows. Operating cash flows will be positive, right? When you join at the end of this fiscal year, correct?
Absolutely.
Very good. Good to hear. What about semicon facility? That's expected to come on stream in April? That's on?
So No, this year itself we have started commercial production. Our FSA has been signed. The fiscal support agreement has been signed. And it's very important to know that the 3 clients that we have onboarded, we have already started working on the second client too. We were the first to ship out the chipset. So it takes a little bit of time. Sometimes we probably overestimated our ability to get this done first time, but still it is best in the industry as of now. Among all the 4 peer group companies, we are the only ones to have exported out India assembled the stuff. So the primary plant, which is going to do the series production, is almost ready. And hopefully we will have something on board, but I'm not able to commit numbers there yet. And that will be in addition to this 4,100 crores that we are talking about, which is our traditional, see, out of 4,400, if you remember, if you recall, we had talked about 100 crore of revenues in the semicon area.
Yes.
I want to bring a very important distinction here. I know there are questions that people do ask about other things, but our PC board facility is almost come up fully. And this PC board investment, if you notice, was about 1,400 crores. And this 1,400 crores, we had not invested to just get 1,400 crores of the bare PCB business. We had invested also with an eye on the EMS, which is subsequently can be done, because when we join early with the customers, about 15,000 crores of potential EMS is hiding there, which is probably missed by people. So we've always been talking about us being an integrated company, end-to-end company.
Right.
So going forward, this 1 billion and 2 billion numbers, etc., will become more of a reality with the better.
So 1 billion, right. Mr. Sampath, $1 billion by 2028, that's on, right?
That's on.
All right. We appreciate you joining in, Mr. Sampath. Just one feedback, a lot of sell-side analysts all of last evening were saying that maybe Kaynes Technology should have given some kind of hint that Q3 is going to be this sort of a washout. But as you're telling us, Q4 actually is going to look much better, and you'll be now ending at around 4,100 crores rather than the 4,400 crores that was expected earlier.
Yeah. So we must look at 2 indicators. One indicator is what is known as a leading indicator, which is the order book. And second indicator is actually the trailing indicator, which is the actual performance on the street. There have been headwinds and so on, but we have weathered all of that, and we are still here to deliver 4,100 crores without the support of any of the new businesses, which we most probably will do from first quarter.
Yes. Got it, Mr. Sampath. Appreciate you joining in, clarifying some of those aspects, but maybe some kind of a heads up would have made the street a little bit more prepared. Thanks a lot for joining in. Wish you all the best for Q4. Well, let's welcome Mayuresh Joshi, Director of Research at MarketSmith India, who joins us on the show. Hi, Mayuresh. Good morning. Good to see you in. Kaynes Technology, that's going to be the stock of the morning. These numbers look a little bit weakish. Mr. Sampath is saying, though, that the end of this year will be around 4,100 crores, which means they do 1,700 crores in the Q4. Your view on the stock, it's already corrected big time from the top. It's gone into the numbers weak as well.
Morning, Nigel. So from a price perspective, I think structurally it is penciling in the worst. And therefore, I think the numbers that have now come out as far as Q3 are concerned are definitely soft. But what the street will ideally like to watch out for is how Q4 will play out. And looking at the management commentary, Q4 is definitely going to be better than Q3. What really transpires now is in the budget announcements, the additional 40,000 crores allocation that is happening towards the EMS space and new areas that Kaynes is probably getting into, which will start reflecting better both in terms of volumes and numbers from Q1. And specifically in the first half of the next financial year. I think how numbers will stack up at that point of time is going to be extremely critical. At the same time, the ODM part of the business, where margins are relatively higher, considering that the developmental expertise in the IP probably stays in-house. And what kind of a progress is made on that is something that the street will watch out for. Soft numbers, the street will gestate that. From a price perspective, I think the worst is probably over, but does this lead to some element of a re-rating? I think it's only up to Q4 and rather Q1 on how numbers will stack up.
Stock is 53% off from its 52-week high. That's Kaynes Tech. Mayuresh, Mangalam is telling us that Nykaa has delivered the 13th consecutive quarter for 20% plus top-line growth. Is there a case to buy Nykaa?
Morning, Rima. So again, I think good set of numbers. If you probably look at both the beauty and the fashion segments, the beauty segment specifically has fired on all cylinders, whether it's EB2B, whether it's House of Nykaa. And therefore, I think the kind of gross merchandise value that you probably see, and even on the NMV part, the net margins or the EBITDA margins for the first 9 months have shown a significant amount of increase. Even on the fashion segment, the kind of profitability growth that has now started coming through is stellar. Having said that, House of Nykaa, the expectations in terms of a GMV of almost 3,500 crores, with a lot of their internal banks, whether it's Dot & Key, whether it's House of Nykaa Cosmetics, have shown a significant amount of increase, both in terms of GMV as well as the dealer distribution network. At the same time, if you look at the core metrics in terms of fixed asset turns for the first 9 months, they're at 10.1, which has probably led to working capital days coming to 30, and a significant increase in ROCs, which have shot up to 19.1% for the first half, which is significantly higher. Now, the management believes, as per their press release, that this can continue at a decent pace. The marquee brands that they're keeping on adding should add to growth. And House of Nykaa should start contributing on an EBIT front as well. Interestingly, I think they've also collaborated, Nigel, interestingly, this is for you, with Nike, so that the entire perspective of running Nike, both the commercial app, now stays with Nike.
Right. QSR, right, guys, is another theme which did phenomenally well. Just a quick word, 30-second response. You know, Sapphire Devyani did well. Westlife was up. There was Jubilant Food which rallied. Is something turning here, Mayuresh?
Morning, Prashant. So I think the discretionary space will show signs of recovery, and I think the QSR players have started showing that. Obviously, the strategy that they have deployed in terms of the product mix, the menus itself, as well as tier 2, tier 3 penetration, I think is a positive for a large part of the space.
Okay, HAL sees a recovery. We spoke with them. They said nothing written from the government on that order. But, I mean, you know, they said that perhaps this is a design thing, the current tender, which reports say they're out of. But, well, there's a manufacturer of it. That'll be a separate tender. They'll participate in it. Has stock fallen enough? What's your sense?
More or less, yes. I think, and again, the order book is strong, that the revenue visibility is strong for the next few years. And the orders that they've probably received over the last few quarters are with decent margins. So with executable timelines, working capital probably stays under check. And therefore, I think, in my opinion, if the stock that basically tanked on this news, I think the worst is probably.
Mayuresh, short conversation, useful, but thank you very much for joining us. You have a good weekend and talk to you soon again. RBI monetary policy, right? 10 o'clock is when we'll get the decision. We'll come back with Ritu in terms of what she's picking up, the expectations are. Stay tuned.
Welcome back. The Reserve Bank of India will announce its monetary policy decision today, the first one of this calendar year. Ritu is joining in with what we can expect.
This monetary policy may not be about rates at all. It's really about liquidity. With inflation benign and growth steady, the Reserve Bank's focus is now on ensuring that past rate cuts transmit smoothly through the economy while keeping its powder dry. And that is exactly what the CNBC TV 18 monetary policy poll is also signaling, with an overwhelming 90% of the respondents expecting the MPC to hold steady despite having the room to cut, with only a very small minority still betting on a 25 basis point reduction. Interestingly, the number of people that were expecting a cut was a tad higher before the India-US trade deal was announced, but now the market believes that the deal has eased the pressure on RBI to provide any immediate stimulus. Now, looking beyond the meeting, the message is even clearer, where 70% believe that RBI will stay on pause throughout this calendar year, with barely 1/3 penciling in one more rate cut. And for now, no one is talking about hikes. So if not rates, what is RBI going to focus on? That is liquidity. Now, despite record high open market operations this year, bond yields have been stubbornly high, and the street expects that the central bank will step up support either through more OMOs, possibly even a CRR cut, longer dated VRR operations, Operation Twist, everything is on the table to cool down yields. Any talk on liquidity is also going to be keenly watched. Now, on the currency front, rupee volatility has been a concern, but the markets don't really expect any targeted intervention. Instead, RBI will likely stick to the long-standing stance of not defending any specific level. Now, our respondents see the 10-year yield settling around 6.7 to 6.8% by March, while the improving sentiment after the US trade deal could see the rupee strengthen to below 90 by March. Now, as for the macro forecast, don't expect any major change because you have the new CPI and the GDP series that is just around the corner, so RBI will leave these as is. Now, economists on their end see the FY26 inflation inching up to about 2 to 2.5% on the new base, and then rising towards 3.8 to 5% kind of a range for FY27. The bottom line is expect a neutral tone from the RBI this time, a wait-and-watch policy, and a policy focused less on the rate action and more on liquidity management.
Well, keep an eye out on that. Ritu, thanks a lot for that. Well, time to slip into a short break. You come back, we'll get to the pre-open rates, and our technical experts as well will be joining in. Stay tuned.
Welcome back. You're with us here on CNBC TV 18. And markets, of course, 3 minutes out, the pre-open session at least, it's a red global screen. And the question here in India for us is, can we do a little better, fall a little less? And perhaps it's possible. 96 points down on the implied open. Well, HAL stocks down about 12% on news that they are perhaps out of the reckoning, out of the race for the fifth generation fighter aircraft. I mean, we spoke with the HAL management yesterday. They said, well, they're still waiting for something written from the government. They've not heard it, which means that nothing's been decided, nothing's been finalized. Just want to play out a small slice of that conversation.
This news about HAL being out of the AMCA race is what we are hearing on the, seeing in the newspapers. So let me at the outset say that we don't have anything in writing that we are out of the race. So that's a disclaimer I would like to make upfront. This comes into production 10 years down the line, 2035. So even in our revenue plan, today the AMCA doesn't figure because we know that this comes up into production in 2035. Even in the worst case that we are not in the race for building the prototype, we will definitely be in the race for building the aircraft during the production phase because we have the plants, we have the capability, and at that point of time we will also pitch in.
All right, let's get you a technical check then on the markets and how do you approach trade today. Mitesh Thakkar as well as Sudeep Shah join us on the show. Hi, good morning, gentlemen. Good to see you all in. Mitesh, you go first. Yesterday we had a bit of a down day. Today you're expecting to open gap down. How do you approach trade? Would you look to buy into the Nifty or do you think now the markets want to cool off a little bit more?
Good morning, guys. So, a gap down, which is a minor gap down may not be very encouraging. But as I said, I think, anything close to about 25,500, which is roughly about 130, 40 points lower from here, is of my interest. So in case we get some follow through post the gap down and we see the Nifty getting close to about 25,500, that's when I would want to, suggest some long position with a 70, 80 point kind of a stop loss. I think there's a fair chance that we might retest 25,800 in the coming days. And if we can sustain about that, maybe even higher levels.
Sudeep, what's the call on the Nifty? Would you also wait for a dip closer to 25,500 or is there a trade?
Good morning, Rima. Yes, even I would like to wait for this 25,500 mark because this is that 20-day exponential moving average, and 25,450 mark was a high on 29 Jan 2026, like just before the budget. So that swing high also is of interest to me. So I feel this 25,450, 25,500 band will be extremely crucial from a rebound perspective. And in case we see this holding for the couple of hours post opening, then in the second half we can see expect some recovery from this zone of 25,500, 25,480 zone. So as long as 25,450 holds, I expect a recovery back to 25,800, 25,850 in the coming few sessions for Nifty.
Yeah. What would your trades be?
The first trade that I have is on Cummins. We have seen a strong move yesterday on Cummins post the numbers and post the management commentary regarding the data center business. So here there was last 20-25 days consolidation which we've seen post that the breakout, and now we expect levels of 4550, 4600 to be seen on Cummins, and right now it's quoting around 4369 in pre-open. So we should be keeping a stop loss closer to 4280 on the downside. The second stock that is there on our radar is a cement name, Dalmia Bharat. We've seen the cement stocks also building some traction from lower levels in the last few sessions. So here the stock is sustaining well about 2100, 2080 zone in the last few sessions. And now we feel that this can be bought at the current levels and the stop loss could be 2110. The targets on the upside would be 2210, 2230.
Mitesh, good morning. How would you approach things? Very carefully, obviously, but what's the thing to do?
Yeah. Morning, Prashant. So I think the idea is that I have about more of long calls, despite the fact that the GIFT Nifty is mildly down. So buy on CAMS. After this breakout, it's given a pullback yesterday. CAMS is a buy with the stop at 716 for targets of 760. Jubilant Food had a strong price and volume action, so on a mild pullback, say around 540 if we can get it. Buy with the stop at 526 for targets of 570. Also a buy on Grasim with a stop at 2844 for targets of 2900, and one sell call, that's HCL Tech. That's a sell with a stop at 1632 for targets of 1570.
All right, by the way, let's just pull up Asia once again before we get in some more questions. Kospi continues to lead Asia lower after plunging nearly 5% yesterday. It's lost another 1.5–2% this morning. Red on the screen when it comes to Hang Seng. Hang Seng's also down about 1.25%, taking its weekly loss to nearly 3%. But Kospi is the one where you are seeing the biggest sell-off. This is following a 65–70% rally and a very strong start to 2026. I think Kospi still, since the start of the year, is up 30%, but it started correcting a tad bit. The Taiwanese market is just moving between the red and the green line. Mitesh, Nykaa is a stock everyone's watching because numbers are looking good. Technically, is there anything here?
Yeah. So Nykaa, in fact, did catch my attention yesterday. If you look at the last about 3–4 months of price movement, it's kind of had multiple highs around this level of 270. And one, I'm looking at a retest of 270. Closing about that, I think can be very positive, and then take the stock much higher with the preferred targets in the range of about 292 to about 295.
Hitachi Energy could be opening up with strength. In pre-open, it's up nearly 6.7%. Very strong numbers, 28.5% increase in the top line. Profits have gone up 90% on a year-on-year basis. Margins have expanded, and that's the stock to watch. And on the way down, Kaynes Tech could get hammered today. Kaynes Tech was down 6%. Now it's settling 3.5% lower. And Krishna Diagnostics, we didn't talk about the numbers in details, but it looks like a miss, and the stock could react negatively.
Yeah, 3.5% lower, and I think it's coming through in terms of some of those corrections. 20 points lower. Well, that is the outperformance to global markets, and hope that is the case. Oh, green, wow. I mean, that's the, 5 minutes in, 3 minutes to go for the pre-open session once again. Well, amidst the global tech rout, we spoke with Ravi Kumar. Rima spoke with Ravi Kumar, the CEO of Cognizant, to understand the impact of AI on the software sector. I want to play out a slice of that conversation.
There is a sense of urgency because this technology has a short shelf life, because it is moving, it's innovating at rapid pace, which means all the infrastructure investments have to drift for trillions of dollars of value. I mean, if we have invested $500–600 billion in 1 year in infrastructure, it has to be trillions of dollars of value. That has not drifted yet. The technology is smart. It is super, super exciting, but that value has not drifted. And as that value drifts, productivity will drift. People's wages will go up because they're going to use the technology to improve their throughput. And we're going to see growth in industries and companies which use this very smartly.
And you can catch the full conversation with the Cognizant management later on the channel about 11:30 a.m. today on CNBC TV 18. Bhavin Shah, founder, CIO and CEO of Samiksha Capital, is now joining in. Bhavin, thank you very much for joining in. Do you want to comment on the big tech wreck that we're seeing globally, what it means for the Indian IT companies, overdone, warranted, more to come?
I think more to come is definitely what we are observing. I think the impact of this big tech disruption is something we have talked about before, and how it is, there is some deflationary impact on revenues to start with. But I think if I look at what we hear from from various companies and industry and people in the industry in terms of the productivity improvement, I think the percentages are going up. Like compared to 6 months back, today, people are talking about much bigger productivity gains. And so, that deflationary impact is bigger than what, people were experiencing. And I think is what Indian IT companies will have to deal with, while we continue to see them having those relationships with customers and, basically being required to provide their services. I think there is a big deflationary impact on their revenue pool. And I think that's what they will have to deal with. And I think so. That's, I think, yes, there is, and there could be more to come.
So currently, the revenue deflationary impact is seen about 2 to 3% on an annual basis. We spoke to Hexaware, and even they said that over the course of the deal, it's of course much larger, but annually it's about 2 to 3%. You're saying actually the number is going to go up. How much more? And in terms of earnings expectations, do we need to start downgrading EPS estimates?
See, I think 2 to 3% would be, very, I think it would be, I think, one can probably start to ignore if it's only going to be 2 to 3%. But I suspect it will be bigger than 2 to 3%. And I say that because, yes, there are, if you look at the entire code, software cycle, there are multiple elements of it. Code development is only one of them. There are other aspects of it as well. Whether, basically specification, program design, documentation, the testing, and then ongoing quality assurance. But I suspect AI could have impact on other segments as well over time. And I think AI is surprising us with the magnitude of impact it is having. I think we have seen many announcements over the last few days. And while companies who announce those may have a tendency to exaggerate the impact, I think in reality, there is definitely that impact happening in all areas that we had earlier probably not even anticipated. So I would say that 2 to 3%, if that estimate is right, is great. But I suspect it will be greater. And yes, that would obviously lead to an impact on the EPS, even if the companies are able to retain their margins. If the revenues are not growing, or even maybe experience a potential erosion for at least some period, that is that impact that we'll have to worry about. I think this is still a very evolving situation.
Yeah. Bhavin, hi, morning. Now put on your investor hat, right? The point is the actual earnings hit may not happen, but P's can change very quickly, right? P multiples. That's the problem for now, right?
It is definitely a problem. No doubt about it. And our earnings impact could also be there, right? If the revenue growth is not going to be there, or less than expected, then there'll also be an EPS impact. So yes, it could be both. And I think the other thing to think about is what other sectors could be impacted by this beyond Indian IT, because obviously Indian IT is a big job creator, and there are relevant sectors that may be affected if there are fewer jobs.
Yeah. No, I only asked the P multiple question. For example, right, numbers will come out and say numbers don't show too much of impact. I mean, stocks have all sold off and numbers come out and numbers are all okay. This quarter, next quarter, they're again okay. So should that be a signal to buy some of these companies or no? I mean, the point is that it's a multiple kind of a derating right now. So it's kind of that cap is there now, because at some point the impact will show through. That was my question, because a lot of people will point to next quarter, the quarter after, and say, well, this is all halabaloo. Nothing has happened.
I mean, I think there will be all types of investors. Some might have a more bullish view of things, but I would say that on the whole, when there is so much, there is such a fast-moving technology having such massive impact, many will prefer to stay on the sidelines and sort of wait it out. And that, I think, will mean that there is definitely a risk for further multiple contraction.
Do you think, so one big impact is going to be revenue deflation, which is much more than what the industry investors are currently penciling in. But do you think this has also injected a lot of uncertainty? Will customers think twice, thrice before signing up a very large deal, because the AI architecture itself is changing? So we've gone through a period when decision-making was slow, spends were not taking place. Does that get extended? And how much of a problem will that be?
So I think the reason why, there's a very valid point, Rima. I think the issue is that the things are moving so fast that, even from my personal experience of having in-house software activity, by the time we, let's say we take on a project, by the time we finish it, we might realize that, we could have done this differently based on availability of some new, AI tool. And so I think, that affects, that is likely to affect decision-making as well in some cases. And so, that also is the factor that one has to keep in mind.
Yeah. You own Sonata in your portfolio, right, Bhavin?
We used to. We currently don't own.
Any IT names in your portfolio?
I mean, we have some names, but we are reevaluating our positions. I think the announcements and kind of data points over the last couple of weeks have been pretty dramatic.
So you were likely to sell down your holdings, whichever holdings you have in IT stocks? I mean, that's the direction when you reevaluate it?
Yes.
Okay. And what about global AI stocks? You track that also very closely. Are we at the cusp of a deeper correction in big tech names?
So we took, we reduced our global tech. We are very heavily in tech in our global portfolio. We took a sharp reduction in those a couple of months back. After that, market sort of even rallied a bit, but then it has now corrected significantly. And yes, indeed, I think the issue there is that if you look at the whole AI race, there are several horses in that race, and they are all spending very aggressively to be the winner in the race. And chances are that not all will be the winners. And so, yeah, I mean, then the earnings growth, I know there was also a very massive multiple expansion in the global tech, the large tech names. So that multiple contraction is also going to play in those names as well. So I think, yeah, one has to be very careful in that respect.
Okay. Thank you very much, Bhavin, for joining in. Just counting down to open, Prashant. This is an ongoing story.
Yeah, it's an ongoing story. Bhavin, thank you very much, and hope you come back as we track, as you reevaluate your portfolio and holding in IT stocks, and I think everyone else is doing that as well. Thank you for being here. I think about 60 seconds to go for market open, and we will just be hitting the actual open. The pre-open is settled. It's not bad. It's not bad looking at all compared to the global screen, but that is to be expected. A little outperformance, nothing to do with India in that particular sense. A bunch of news flow, which is not negative. It is positive. You can argue how positive. I mean, all these deals and the RBI meeting today, we'll see if there is perhaps more support on liquidity, more OMOs, financials perhaps could be in focus on the back of it. So there is stuff here. Well, what do we have? First rates which start to come through. Nifty is down about 50, 60 points lower. The Nifty Bank is down about 40. And you've got the mid-cap index, which is down about 200. The small-cap index is also going to come up on your screens at this point. 1,000 stocks are higher and about 670 stocks 1,000 stocks are lower and 670 stocks are higher at this point in time. Well, you got, the heat map is on, right? 12 odd names which are higher. And I can spot Infosys there. Infosys is in the green. Bajaj Finance, of course, is the top gainer, followed by Kotak. On the other end, you've got NTPC, ONGC, and Tata Motors passenger vehicle business, which is lower. But it's a flat start, 40 points lower on the Nifty. But let's go wider with the broader markets. Nigel, take it away.
Well, that's right, Prashant. As you said, the Indian markets have started lower. But as we were chatting about earlier today, maybe, in fact, India's time has come. And hopefully we outperform from here on. And at least the initial sides are that things are not looking so bad. As you can see, the Nifty Bank, the Sensex, all of them in the red. But actually, the Nifty Bank, that's the one that's actually come off considerably from the lows of the day. But that's the number you want to track, the 600 or 700 stocks that are currently higher in trade. By the end of today, if that number can move closer to around, 1,000, 1,200 odd, your portfolio will be feeling quite good. Let's run you through a few names, though, that are moving around. Metals are coming for profit taking. That's been the outperformer in January, as well as the initial part of February. But that one's come in for some selling. So Hindustan Zinc, because of the silver exposure, that's lower. Vedanta is the parent of Hindustan Zinc, so that as well has seen some profit taking. While Hindustan Copper as well as Nalco, there has been some kind of profit taking on copper as well as aluminium prices, though it appears the trend is still up, going by the demand-supply situation. So all those stocks are a little bit lower in trade. Some other stocks from the tech space. Hexaware, it was down at 6% yesterday. It's down another 10% today. So massive selling is what we're seeing on that particular name. And a couple of earnings reactions as well. Whether you look at Kaynes Technology, we spoke to the management earlier today. They're saying Q4 is going to be super. The street is asking, why didn't you alert us that Q3 is going to be so weak? That stock is down 5.5%, and yes, it was down 5% as well going into its numbers. Krishna Diagnostics, that's the other stock that, in fact, is lower in trade today. That as well is down close to around 4.5%. Page Industry is not keeping it very, very brief. That one came out with its set of numbers. It appears there is some profit taking on that name as well. It's down close to around 2.5%. NCC, the stock has halved from the recent peak. Order book looks pretty good. Execution is going to be tracked from here on. But for the time being, the stock is down close to around 3%. But it's not all gloom and doom. It's a Friday, And there are some freaky stocks that are doing pretty well. Hitachi Energy. In a short while from now, we'll have Mr. Venu who will be joining to detail those numbers. Boom, up close to around 10% in this market. Nykaa. Mangalam is telling us there are some upgrades that are coming in there, 3.5% higher on that particular name. And Data Patterns as well as a stock that's doing quite well. There was one big order win that we got for a smaller company, Talbros. I think that stock as well should come up for you. So there are a fair bit of stocks that are actually in the green in today's trading session. The Nifty, it's still down close to around 20 points. But you take a look at global markets and you'll say, hey, it's not so bad. The Nifty actually is doing pretty well today. But that's the number I'm going to track. 722 stocks advancing. By the end of today, I'll tell you what, 1,200 stocks is what I'm hoping for. Let's see how it goes. Rima, back to you.
The small cap index, Nigel, is down nearly 1%, and the IT index, the Nifty IT index, also lower by 1%, taking its weekly loss now to 6%. And the silver ETFs are selling off and selling off hard now. Look at Gross Silver ETF, SBI, HDFC Silver ETF, Tata, Nippon. Across the board, you can see a sell-off commensurate with the kind of volatility and decline we've seen in silver prices. So that is hurting. On the way up, you've got some moves in stocks like G&G Electronics, IGI. These are some names which deserve mention. LIC too is moving up 4.5% post the numbers. Optically, they look good, but Yash was telling us margins need greater scrutiny. But let's invite Manishi Ray Chaudhary, CEO of Emma Capital Partners, on the show now. Manishi, thank you very much for joining in. Week to week, from Friday's close to today, we're still up close to about 300 points on the Nifty, but we've seen some wild swings. On Sunday, we were down 500 points. On Tuesday, at one point, we were up 1,200 points, but we ended up in the green with a gain of about 600 points. Your assessment of the markets, and also considering the kind of weakness that we're seeing in the US markets, and particularly tech names, where are we headed?
Right. Thank you very much for having me. You know, this volatility that you are talking about, it is partly generated by, this unprecedented degree of, uncertainty that we're seeing across the world. We're seeing that in the United States. We're seeing that across Asia. And there are quite a few factors that have kind of combined together, that have come across together. We have seen uncertainty about the sustainability of AI capex being talked about. Just look at the reaction to Amazon's, $200 billion capex announcement yesterday. We have seen the uncertainty about how the new Fed chairman, Kevin Walsh, would actually handle the monetary policy going forward. We have seen a degree of uncertainty as a consequence about the dollar and therefore bullion, the kind of reaction that we're seeing in gold and silver. So it's rare that you have so many variables that one has to juggle with in such a short span of time. In fact, if you talked about this Friday to Friday last 1 week's movement, India has actually been relatively stable. If you look at just that one week period. In contrast, Hong Kong, China, Korea in particular, they're down anywhere between 7 to 8% during this period. I think partly there is a degree of good news that have come across for the Indian market. Even though we don't know too many details about the trade deal at this point of time, it has done its bit in terms of trying to improve the sentiment, not just about the equity market, but also about the currency. So, yeah, I mean, I would possibly be a bit more positive about India. It would obviously help, if we do get to hear more details about the exact contours of the trade deal.
Manishi, so where would you be focused on? I mean, if this is, we had Pankaj Tibrewal yesterday, right? He's very much here. He's gone on, met companies, and he's looked at the third quarter numbers so far. Guess what? Small cap, some 200 companies were reported there. Earnings growth is 39%. I mean, some resource companies perhaps are outliers and the numbers have been pushed up, but generally it's pretty healthy, right? And he's saying, well, actually, companies are sounding a lot more positive for some reason, mid-December onwards. So if there's a disconnect, where would you look to exploit that discrepancy in terms of opportunities?
Well, I would definitely look at those sectors where we are beginning to see some degree of earnings estimate upgrades. They're very difficult to find in India. There are some in basic materials, the base metal companies where earnings estimates are moving up and the sector is still relatively cheap. There are a few in industrials. We have seen even the government policy pivoting back to industrials and investments from consumption. I would, still be selectively positive on consumer discretionaries. At some point, the massive fiscal stimulus that we saw in 2025 would begin to have some impact on demand. We also have adequate room for the Reserve Bank of India to cut rates more. It may not happen today, but it'll eventually happen over the next 6 months to 9 months. So if I put all these things together, I would be possible. Also, I forgot to mention the banks. In fact, if you do a usual price to book versus ROE, kind of a scatter plot, financials, basic materials, they would be on the bottom of the list. So they are the relatively cheaper compared to their fundamentals. So I would definitely be positive on financials. I would be positive on base metals, basic materials. I would be positive on industrials and consumer discretionaries, but those last two sectors, one has to be a bit selective because of the sky-high valuations that prevail over there.
All right. Hi, Manishi. Good to see you in. Manishi, what about tech? Tech is, seeing a sharp correction, a sharp pullback.
Right.
At various times I've seen in the past that some of these fears sometimes don't play out. And they're very well-run companies. Do you think this time the fear is real and actually it could hit these companies? Or do you think, in fact, they're providing a buying opportunity?
As I've said before, that I'm fundamentally very cautious on Indian tech, particularly the IT service companies. I don't have a single one of them. No emphasis, no TCS in my model portfolio. And what we're seeing now is basically that classic AI loser theme playing out. Not just in Indian IT, but across the world. All these, so-called service providers, their businesses could get disrupted by the new product offerings that are coming in from the LLMs. And this is just the beginning. I mean, we're going to see refinement of those product offerings. We're going to see more offerings which would actually make the job of the service providers a lot easier. So only those companies which reinvent themselves, which possibly, are able to use AI to improve their workforce capability and margins and productivity significantly. Those are the ones that would survive. And as of now, I don't really see such impetus from any of the Indian IT service companies, unfortunately.
Manishi, your emerging market portfolio has investments in Hong Kong, China. You liked many of these AI trades as well. What are you doing with that holding? How has it changed?
Right. So, as far as the AI trade is concerned, and thank you for asking me that question, we are basically in favor of the so-called picks and shovels companies, which are enabling this massive AI capex infrastructure. You have TSMC, you have Samsung Electronics and SK Hynix in Korea. You have several others. You have some of these semiconductor companies in China as well. But what we're really focused on are the monopolies and the near monopolies. Think about it. I mean, a deep learning or, an LLM, which may not choose to go with NVIDIA's chips, and suppose it considers someone else's chips, like, say, Google TPU, whichever logic chips they focus on, it'll have to be manufactured, it'll have to be fabricated at TSMC's fabs. You can't do without high bandwidth memory. There's virtually 2 companies and maybe potentially 3 who are manufacturing them. You have SK Hynix, which has a commanding market share. Samsung is getting there, and you have Micron in the memory space. But some of these companies, SK Hynix, Samsung, they're virtually no-brainers. They're near monopolies at this point of time. So that is basically our focus as far as the AI trade is concerned. There are some adopters in China who are actually increasing their productivity significantly by using AI. Tencent, for example, is an important example in that regard. We are seeing that with Alibaba as well, even though there are concerns about massive investments that it's doing, therefore hurting its cash flows. But yes, broadly, many of these AI plays, they're concentrated in North Asia. They're in China, they're in Taiwan, they're in Korea. And I think that is something India has suffered from, not having those, adequately prominent AI plays.
Indeed. Manishi, great chatting with you. Thank you very much for joining in on Indian IT. He doesn't hold anything in his portfolio and he continues to maintain Indian IT is an AI loser. But let's now invite the management of Hitachi Energy. The stock is surging in trade now and they reported a good set of Q3 numbers. Company's top line went up by 28-29%, profits went up 80%, margin expansion. And Venu, MD and CEO of Hitachi Energy, is now joining in. Thank you very much for joining in. Let me begin with the margin question. Margins at 16.6%, and this is the second consecutive quarter of mid-teen margins. Can you sustain, one, what led to it, and can you sustain it? Say, can 15% be the new floor for margins?
No, good morning, and thank you for having me in your show. And let me just take 30 seconds to demystify our results, as we have been consistently saying this for the last several quarters, in fact, several years in your own channel, that, we have been building the organization in more sustainable and profitable growth mode. And we have been looking at various segments, not only a transmission, but transmission industries, data center, and service and digital. And all those things, efforts of last several years, several quarters is what you can see today in that. And we have been saying that, what we maintain is a double-digit operational EBITDA, and that's what we have been doing it with that. And our revenues are growing because we have a huge order backlog of close to 30,000 crores order backlog, and then we are able to convert those into revenues. And as many of our customers are looking forward for our equipment and our projects, and then we are able to do that. And the offshoot of all that is the margin. And as I said, we maintain the double digit. I won't say whether it is 15 or 16 or 12, but double digit, all that, we're going to have that.
Okay, but low or mid or high? Give us some indication.
No, we don't give any forward-looking information. All that we can say is that we maintain the double-digit EBITDA margin.
Okay, Mr. Venu, I'll just stick with just one more question on that margin before we move on. Good morning, Prashant here, and congratulations.
Good morning, Prashant.
The commodity price inflation is another level, right?
Yes, absolutely.
So how does this work for you, sir?
I think fortunately, this is also part of our strategic focus for the last several quarters, several previous years. We continue to focus on having a price variation clauses fixed in our contracts. As we speak today, more than 70% of our portfolio is having a price escalation clauses. So
flexible price.
We don't benefit and we don't lose either prices going up and down. So we very transparently pass on those things to our customers in that. So from that standpoint, I think we are okay, managing the rest of the portion of the portfolio which does not have the price variation.
So this is all. I mean, basically, you can work around these things, right?
Absolutely.
The other point is this news that Chinese companies may be allowed. That Press Note 3, being put on the sidelines, and them being allowed to participate in tenders. Power, of course, is a big area. They were very active in 10, 15 years back. Is that a risk?
No, I think definitely it's a risk, but what we are looking at and what we are also hearing from the authorities that they're not allowing, they may not allow directly imports. If somebody has a manufacturing setup in India, probably that could be an option there. But what we are looking at is, we are looking at a level playing field. As long as the level playing field.
Mr. Venu, sorry, there is one company with a large manufacturing base in India.
I don't think that's a material in my view. I don't think that's a material.
But they are in the same space? They're in the same space, like in terms of the product range that you were in?
It could be, but the demand is so much, but just having one more factory, even if they have a 30,000 MVA capacity, other things is not going to till the
change too much. Got it.
Competition and all again. Otherwise, also we are saying all we are looking at is the level playing field. As long as the level playing field is there, we are absolutely okay to compete with anyone. Whether it's the Chinese, Koreans, or anyone.
All right.
So we have built up our ecosystem, especially our supply chains, because we have done a lot of localization here. And today, more than 80% of what we produce globally, we produce locally here, and that's going to be our strength going forward.
All right. Hi, Mr. Venu. Good morning. Good to see you, Ben. Second time in a week. Wow. We thank our staff.
Good morning.
Good to see you, sir. Prior to everyone talking about HVDC, you were one of the people who were going on making those comments on HVDC. And now we know what a big opportunity it is. Now, with the last few interactions, you have been talking about this data center opportunity. And I've been noticing that some of your peer groups, whether it's Siemens or the others, they are not viewing it as such a big opportunity. So could you tell us how big an opportunity it is for you? I think the last time around you hinted that maybe it could be 10 to 15% of the total data center capex that is there on offer in terms of an target market for you. So could you quantify it? What is the opportunity for a company like Hitachi? And from there, how much can you get?
Yeah. So absolutely. In fact, I talked to data center when you came to our factory first time into Bangalore 21 or 22. That time we didn't have a visibility. We didn't have the pipeline of the HVDC. But we strongly believe that to manage the complexity arising out of such a large scale grid, you need to have the HVDC built in that, and you can see the pipeline and the order inflows. A data center is absolutely is another big area where we have been consistently saying on that, especially on the air-ready data centers, needs a huge amount of energy, and not only the huge amount of energy, it also need to have flexibility around that. For example, air-ready data centers, so they go from 100 megawatt to 250 megawatt in seconds. So you need to have that kind of flexibility grids built around to take care of the spikes arising out of the thing in that. A query on a chat GPT needs 6 to 8 times more energy compared to in a Google search on that. So that's the power of the AI, and it's like it can work both ways. The AI can also optimize the energy systems, and more energy is required for creating the more AI-ready data centers in that. So coming back to our opportunities, it is actually in India, it is evolving it, especially in the AI-ready data centers are just going to come in. In the world-wise today, the AI-ready data centers, 90% of them are located in the two countries, US and China in that. And definitely India is going to play a major role in that. And this budget providing, tax holiday up to 2047 for using Indian-made data centers will definitely create a more demand on that. From our standpoint, we create an end-to-end. We have the power system studies for that. We have the grid connection. We have also, our technologies will take care of the of these kind of sinks. And roughly around anywhere between 10 to 15%, depending upon that, of data center capex is our addressable market. And
Mr. Venu, there is this new chip, right? I'm sure you've read about it. NVIDIA's, I think it's called Vera Rubin chip.
Yes.
So that's like a breakthrough. That basically means, at least that's what they're claiming right now, that you can cool these chips into these data centers at 45-degree temperature, water. So, the temperature at which water is supplied. So you don't need to, if that is true, that is revolutionary, right? All kind of estimates will change then. You don't need that much. This power demand thesis because of data center, it'll all change. But we'll have to see if it really works, right? You'd agree?
It might, absolutely. It might. It definitely not going to be 8 to 10 times, and it will somewhere fall in. There will be some disruption. There will be some new things in that. But even assuming that it would take a factor of that, the need for the data
is huge.
In India, and that's where we are betting on that, and we are creating our supply chains in anticipation of this demand.
Got it. Mr. Venu, we had many more questions, all of us, but we're out of time. There's the RBI policy, so we're on a clock here. Thank you for joining us. Good luck, and really appreciate it. Uno Minda is the next management we're speaking with on the program. They reported an inline set of third quarter numbers, and let's get them in terms of the numbers and, of course, the outlook as well. Sunil Bora is Group CFO, Uno Minda. Sunil, good morning. Great to have you with us here. Thanks for joining us. I had to start with this India-US and India-EU. The FTAs, the FTA with the EU, and of course this deal with the US. In what way does this change things for the Indian autocom sector, and what is the tangible kind of benefit that you see?
So Prashant, you are right. In terms of both the FTAs with EU and US, definitely opens up a lot of opportunities for exports from India. We have been seeing that a lot of the auto component players like us have been exporting to EU and US, and now with this stability in terms of tariffs and clarity, and also tariffs going down, definitely it will open up a lot of opportunities. Like for example, we have also been in discussion with some of our customers, but because of some of these tariff situations, things have not been progressing as one would have expected. But definitely, once now we have this clarity, things will speed up, and it will definitely open up a lot of opportunities for exports of auto and auto components.
Sunil, 20% top line growth, but recently when we look at the auto sales numbers, it looks like the entry-level cars have done better. And that impacts the value proposition for yours. Yours is a premiumization play. What should we expect in terms of volume value growth going forward?
No, definitely, you are right in terms of the vehicles being sold. Definitely, with the GST cut, it was expected as well that it will trigger more entry-level two-wheelers and four-wheeler sale to be more, and that's what the data actually has been suggesting. Because there, your kit value obviously is lesser in the entry car versus a premium car or a premium bike or whatever it is. Having said that, there has been change in terms of the adaptation of a lot of these premium features. So as the cost goes down, as the volume increases, even these premium features, which say, for example, used to be in D segment cars or a 350cc bike or a 250cc bike, they've been coming down to B segment, C segment, etc. So the adaptation has been increasing. For example, like airbags. Airbags used to be like penetration was very less. Now it has been consistently increasing. Same goes for alloy wheel and some of the lights. So as we move forward, we do expect this premiumization play even to get into some of these entry-level cars. May not be in the base models or base models of the two-wheelers, but definitely in terms of the upper models of those same segments. So as we move forward, we do expect this momentum to continue. As you know, we have been significantly expanding in terms of our product profile as well, and building our capacities in line with our customers. So we are pretty confident that this growth momentum definitely will continue. We'll not be able to give you actual growth numbers because we don't normally talk about the OE volume, but definitely our endeavor has consistently been on an annual basis, whatever industry grows, we consistently grow at least 1.5 times or more. And we're pretty confident that we should be able to deliver that.
Hi, Mr. Bora. Good to see you in, sir. And, hoping business is doing pretty okay. That said, how do you see the business evolve from here on? If you tell us the content per vehicle that you're dealing with currently, both two-wheelers as well as four-wheelers, and how do you see that number scale up? Give us a broader time horizon, say in the next 12 months as well as 24 months. How do you see this improve? Because you have been hinting about this in the past.
Yeah. So, Nigel, there are some of the products which currently are in the development phase, which gets into the production phase somewhere in the next calendar year. If, for example, sunroof will get into production next year, some of the EV components for four-wheelers will get into next year. Some of the two-wheeler components also will get into the next fiscal year. There are a lot of these products which will get into SOP in end of 27 and early 27. So this consistently will help us improve our offering into per vehicle, which will actually translate into the actual realizable kit value. And on top of it, some of the existing products also are seeing some premiumization. Switches getting into haptics-based switches, or horns getting into sort of mechanical horns to electrical horns. LEDification for lamps has been a consistent journey for last few years, and we have been seeing that benefit out of it. So the sensor adoption is increasing. So all in all, definitely we are very, very optimistic as we move forward.
Sunil, short conversation today, but thank you very much for joining in. We're just waiting and counting down to the RBI MPC. And before that, there's one story that we'd like to tell our viewers, because sources tell CNBC TV 18 that the India-US trade deal is unlikely to have any adverse impact on India's farm sector. This was a crucial point which led to the delay between, the agreement between India and US. So let's just get some clarity in. Abhimanyu joins in with more. Abhimanyu.
Government sources have indicated that the India-US trade deal will not have any adverse impact on Indian farmers, since several commodities have been excluded from the ambit of the deal, which include wheat, rice, soya, corn, sugar and dairy. Also, government sources had indicated that India has committed to buying items from the US which are already imported from other nations, and India imports products like oil, gas, aircraft, laptops, smartphones and goods for data centers. India currently imports around around $300 billion worth of products annually, which will now be sourced from the US as well. India expects to hit $500 billion worth of imports from the US in the next 5 years. It remains to be seen how early this growth is going to be achieved. Also, the Commerce Ministry has indicated that the first tranche of the BTA between both the sides is already ready, and they are hoping to sign a joint statement in the next few days. Also, a formal agreement is being drafted, which will be signed by the mid of March possibly. It has been indicated by the Commerce Ministry that tariff reduction from the American side would take place, would be undertaken via an executive order once the joint statement is signed, whereas India's MFN tariffs, which currently apply to several American products which are imported into India, they would be reduced only when the legal agreement is signed. It remains to be seen how early all these processes are going to take place and how early the deal is going to take shape.
We're all waiting for that final signing and the details. But thank you, Abhimanyu, for sharing what you've picked up. Meanwhile, Commerce Minister Piyush Goyal had outlined the timeline of the deal and the way forward. Listen in.
हमारा पहला ट्रांच बायलैटरल ट्रेड एग्रीमेंट का लगभग तैयार हो गया है। हमारी उम्मीद है कि अगले 4-5 दिन में हम एक जॉइंट स्टेटमेंट यूनाइटेड स्टेट्स ऑफ अमेरिका और भारत के बीच में फाइनलाइज करके साइन कर देंगे। फॉर्मल एग्रीमेंट को मिड मार्च तक साइन करने का अंदाज़ा है, लेकिन 18% जो यूएस टैरिफ्स घटने हैं वो जॉइंट स्टेटमेंट अनाउंस होने के बाद एग्जीक्यूटिव ऑर्डर द्वारा यूनाइटेड स्टेट्स ऑफ अमेरिका कर देगा।
All right, well, time to slip into a short break. Up next, we begin our coverage of the RBI monetary policy, which is set to be announced at 10 a.m. We have a slew of economists, experts, who will be joining in ahead of the RBI Governor's address. Stay with us.
Welcome to our special coverage of the RBI monetary policy. The governor is set to announce it. The decision of the MPC at 10 a.m. and the street, according to our poll, is going with a pause, and we'll tell you why. Inflation is benign, growth is steady, and so the Reserve Bank's focus is now likely to be on ensuring that past rate cuts are transmitted smoothly through the economy while keeping the powder dry. And that's exactly what our poll is also signaling, with 90% expecting the MPC to hold rates in this policy despite having the room cut to cut. There's a very small minority that is still betting on a 25 basis point reduction, but keep in mind the number of people that was actually expecting a cut was a tad higher before the US trade deal was announced. Still in minority, but now the market believes the deal has eased the pressure on RBI to provide any immediate stimulus at the moment. Beyond this as well, 70% believe the RBI will continue to stay on pause through the entire calendar year. Barely a third are even penciling in one more 25 basis point rate cut, and nobody is talking about a hike in 2025. The focus is very much going to be on liquidity, whether that is through more OMOs, that is the wider call, longer dated VRR operations, which RBI has already been doing, or even an operation twist to manage the long-term yield. All of that is on the table. On the currency, don't expect much from RBI because they'll continue to reiterate the fact that stance being, not targeting any specific level. The 10-year yield, now that is seen settling by 40% below 6.7% or up to 6.8% by the end of March. And on the rupee, thanks to the trade deal and the recovery that we've seen, by March end, the levels are seen at 90 to the dollar. CPI and GDP don't expect much change simply because, the new base year revision is around the corner. So RBI will unlikely tinker with that. The economists do see 20 to 50 basis point upside on the new range. So bottom line is neutral policy, wait and watch approach, less focus on rate action, more on liquidity management. Also joining me now is Prashant Nair. Prashant, pretty much a status quo. I think all markets want to hear is some amount of liquidity support.
Some amount of liquidity support, right? But in what way, Ritu? I mean, exactly in simple terms, right? So the RBI is basically, what are they expected to do? I mean, the rate thing is aside, but on liquidity management, I mean, in terms of how this impact, and I think the expectation from a equity point of view is that they will they'll perhaps do some more OMOs, etc., more liquidity, positive for financials. Is that likely?
Yeah, it is very likely. The broader consensus is perhaps around an OMO. CRR cut, there's a very small minority that is talking about it. It is unlikely. Last year, RBI already cut it from 4% to 3%. Unlikely that they'll bring it down any further. But whether they give banks some sort of relaxation on, the capital requirement, tweak the LCR rules, bring some leeway there, all of those are things that are on the table.
It was the policy before last when they announced those range of measures, right? I mean, not the last month, but the one before that.
Around the August or so, when, it was more of a banking policy, less on rates. Last policy, we had a 25 basis point rate cut, which surprised the street, which again tells us never second guess the RBI. We're going in with a pause, but we'll see what the governor announces at 10 a.m. Let's actually also bring in our guests to decode what to expect. We have Deutsche Bank's Kaushik Das, Standard Chartered Bank's Parul Mittal Sinha, and Bajaj Finserv's Lakshmi Arre. Joining in now, Lakshmi, Parul, Kaushik, thanks very much for being here. Kaushik, let me quickly start with you. What is the base case scenario? And on liquidity, specifically 2 to 3 measures that could be on the table?
Hi, Ritu. I think you summarized it well, all the baseline expectations that you spoke about. So we are going with a pause at this stage, given that RBI has done quite a lot, 125 basis points rate cut. And as you mentioned, that after the US trade deal, expectations about the growth outlook has only improved. So over a period of time, you'll probably see FY27 growth forecast being increased, whether RBI does it today or, waits till the new GDP data comes out and April they take a call. But the baseline expectation is that growth, the risk that was there, that has gone out with the UFTA and the India-US trade deal that has come in. On liquidity, RBI again has done a lot from December 5th policy till today. If you see the overnight market rates, it's at 5% now, close to the SDF rate. And a lot of liquidity now, the kind of system liquidity has gone to 5 lakh crore surplus. And that will help to bring short-term rates, which had gone up a little bit in the last few days, back to 5%. And if RBI doesn't suck out that liquidity in the next few weeks through VRRR, that can improve market sentiments. And all RBI needs to do is basically sound that they're not going to do anything immediately and maintain the status quo, and they're monitoring and more or less they're still in favor of transmission of the previous rate cuts to happen for the next several months without giving any fear of rate hikes, at least in 2026.
So basically a wait and watch kind of policy, right? I mean, let's let everything we've done work through the system and then take a call, right?
Prashant, Just the one more thing which Ritu had asked now, whether RBI takes the opportunity to announce today, or given that we already have a lot of durable liquidity, whether they decide to postpone it and announce it as and when they feel the need. I think market is in a good place after the last few days, whether you short-term rates or the long-term rates, which have kind of corrected after the trade deal, and the rupee has also appreciated from 90.
I mean, imagine if we were having this conversation last Friday. I mean, it would have been a completely different kind of picture, right? It's all changed, and that's how fast, I mean, financial markets and all this stuff is moving now, day on day. Let me get in Parul Mittal Sinha as well. Parul, morning. Lakshmi, morning. Parul, to you first. I mean, what's your sense? No, I mean, on rates, I guess consensus is no change, but on this liquidity bit, what will the RBI do?
Yes, so like everybody has been saying, status quo policy, no change in policy rates or even the stance, especially ahead of the new GDP and CPI series expected to be released in this month later on. On liquidity, I don't think the market is expecting additional OMO purchases or even a CRR cut kind of measures, because there is already ample liquidity in the interbank system, and overall core liquidity is quite high in response to the OMO purchases and buy-sell swaps done by RBI recently. In fact, market will look out for any indications of whether RBI will look to manage this liquidity by deploying instruments like VRRR, which will take away the liquidity in the shorter term to manage this imbalance, which is short-term imbalance from the excess liquidity.
But Parul, the question is more on also managing the yield curve. I mean, 6.7 kind of a yield, despite that 125 basis point rate cut coming in. Is an operation twist something that could be on the table, or what do you expect from RBI to manage that?
So, Ritu, I think right now we've seen a good tailwind from the India-US trade deal, and the market yields, which had really ratcheted higher out of fear and out of some negative sentiment, they have calmed down already. So we've seen almost a 15 basis points move lower in rates across all asset classes, be it bonds, be it OIS, be it FX forwards. So in this scenario, we don't expect RBI to deploy more tools from their toolkit to calm down the markets. In fact, given the large borrowing program for next fiscal year, it may be more prudent for RBI to reserve those tools to deploy if the rates start going higher again. Right now, a 6.6%, 6.6 to 6.7 on the 10-year yield is not a very high yield. I think if it maintains at these levels over the next few months, the market will be in a good place.
Okay, 6.65 is where we're at. Keep that level in mind as the RBI announces the policy. But Lakshmi, your quick thoughts as well. What is the base case scenario you're going with, and what will you want to hear from the governor?
Yeah, hi, morning, Ritu. So clearly, base case is certainly for a pause. We have seen quite a bit of rate actions in the past. Let that transmission happen fully through. And in a lighter vein, if that 10% minority that you just showed as part of the poll actually were to be true, and we see a rate cut, there is a very bright chance that our central banker could get poached by the US because they need it more than we do. But that's in a more lighter vein. But seriously, I think markets are not expecting any rate action. But I would say more of LSD, which is liquidity stability and demand for the upcoming massive behemoth gross borrowing program, which has been listed for FY27. So I think that's going to be the critical thing. And of course, more of operational focus. So the kind of open market operations that we've done up until now, clearly yesterday, if you see the aggressive cutoff in the OMO, all that has clearly helped the bond yields. So I think stability on that front is what the markets will watch out for.
What about growth forecast, Lakshmi? You think we'll see a bump up?
Well, unlikely, but I think given the clarity on the tariff and the US trade that is, yet impending to be announced in terms of details, I think something that has to happen will happen post that and not really in anticipation. So very unlikely, super surprised if you see anything anything in terms of a bump up as far as GDP is concerned.
Mood has certainly got a bump up with everything which has happened last few days, notwithstanding, I mean, the global screen, which is, I think, looking a little shaky now. Parul, what do you think? Growth? They'll wait, or you think they perhaps revise it up a little bit?
I think in the commentary, they can mention that growth outlook has improved, but they will wait for the finer details of this trade deal to come out to give a final number on how high the growth outlook can go. Also because the GDP series also is expected to get revised.
I mean, there are many,
Lakshmi, just one thing
in
terms of the global screen, Lakshmi, is there one sharp takeaway? I mean, if you're the governor, if you're the RBI, everything which has happened, what do you know? There is so much. It's like missiles raining down from all directions, right? Is there one sharp? How do you distill it and use it in your policy? Or you just take note of everything and do your own thing?
I would say focus on stability. I think that is going to be operational focus. I think strategic pause and operational focus would be the mantra if I were the central banker.
Okay.
Lakshmi, are you factoring in any kind of, banking measures, whether that is that ECB relaxations that were announced last year, for that to be implemented, any leeway on LCR? Will any of that help banks, and are you expecting that in this policy?
Lakshmi, that's for you.
Okay, sorry, I missed that. So I'd say that none of those, in incremental terms is something that we would expect today, but clearly taking cognizance of what has happened in the past. And let's not forget that, unlike equities, which has just started this month, every month on month, we've been seeing positive net flows by FPIs. So I think that's a definitely positive factor for the markets.
Kaushik, we just have a minute or so to go on growth. Don't you think RBI may just leave it be, given the new series that is around the corner? And also from MOSPI, we already have the 7.4% number. My sense is they will just leave it at that and not even bring it up. Now the next focus will be FY27. Kaushik, quick read on what do you think they'll do on the macro numbers?
RBI will talk about 7.4 for this year. They'll not give any new forecast.
Yeah.
What is more important is forward-looking, because monetary policy is always forward-looking. So over there, the economic survey has already given 6.8 to 7.2. And recently the said that we could even get 7.4 next year, just like this year. So, if you think about it, if RBI talks about a higher growth forecast in this policy, and at the same time, the inflation forecast is not revised down for next year, that could then come as a hawkish signal. Then, market will say then going forward, you don't need to do anything. And beyond that, the next move, whenever it is, should be a hike and not a cut. So if RBI is too bullish on growth, that can actually, hurt bond market sentiments in a negative way. So let's see what RBI does. But the risk is that growth is going to be, forecasted higher than what RBI.
So the risk is that the growth is going to... Okay, all right. We don't have to wait very long. I think the governor is making an appearance on your screens now. And let's cut across.
And I've already witnessed momentous actions on the geopolitical
Risk is a revision because...
front. Amidst heightened geopolitical tensions and elevated uncertainty, the Indian economy is in a good spot with strong growth and low inflation. Inflation remains below the tolerance band and its outlook continues to be benign. High-frequency indicators suggest continuation of the strong growth momentum in Q3 this year and beyond. With the signing of a landmark trade deal with the European Union and the US trade agreement in sight, growth momentum is likely to be sustained for a longer period. Global growth, supported by tech investments, accommodative financial conditions, and large-scale fiscal stimulus, is expected to be marginally stronger this year than projected earlier. However, the confluence of escalating geopolitical frictions and rising trade tensions is unraveling the existing world economic order. Inflation outcomes are heterogeneous across jurisdictions, remaining above target in most advanced economies, prompting divergence in monetary policy actions as central banks near the end of their current easing cycles. Against a global backdrop that has increasingly become more cautious, bond market sentiments remain bearish, reflecting fiscal sustainability concerns. However, equity markets driven by tech stocks remain upbeat. The Monetary Policy Committee met on 4th, 5th, and today to deliberate and decide on the policy repo rate after a detailed assessment of the evolving macroeconomic conditions and the economic outlook. The MPC voted unanimously to keep the policy repo rate unchanged at 5.25%. Consequently, the STF rate remains at 5% and the MSF rate and the bank rate at 5.5%. The MPC also decided to continue with the neutral stance. I shall now briefly set out the rationale for the MPC's decisions. The MPC noted that since the last policy meeting, external headwinds have intensified, though the successful completion of trade deals augurs well for the economic outlook. Overall, the near-term domestic inflation and growth outlook remain positive. Headline inflation during November and December remained below the tolerance band of the inflation target. The revised outlook for CPI inflation in Q1 and Q2 of next year at 4% and 4.2%, respectively, revised slightly upwards, continues to be benign and near the inflation target. The slight upward revision in the inflation outlook is primarily due to increase in prices of precious metals, which contribute about 60 to 70 basis points. The underlying inflation continues to be low. On the growth front, economic activity remains resilient. The first advanced estimates suggest continuing growth momentum driven by domestic factors amidst a challenging external environment. The growth outlook too remains favorable. Based on a comprehensive review of the domestic macroeconomic conditions and the outlook, the MPC therefore was of the view that the current policy rate is appropriate, and accordingly it voted to continue with the existing policy rate. It also agreed to retain the neutral stance. Going forward, the MPC will be guided by the evolving macroeconomic conditions and the outlook, based on the data from the new series in charting out the future course of monetary policy action. You are all aware that in a few days we will have a new series for both GDP as well as inflation. I will now dwell on the assessment of growth and inflation. First, growth. The Indian economy continues on a steady improving trajectory, with real GDP poised to register significant higher growth of 7.4% this year as compared to the previous year. Amidst global headwinds, private consumption and fixed investment both supported growth. Net external demand, however, remained a drag, with imports outpacing exports. On the supply side, growth in real GVA on the back of a strong contribution from the services sector and revival in manufacturing activity is estimated at 7.3% this year. Going forward, economic activity is expected to hold up well in the next year. Agricultural activity will be supported by healthy reservoir levels, robust rabi sowing, and improvement in crop vegetation conditions. Improving corporate sector performance and sustained momentum in informal sector should boost manufacturing activity. Construction sector growth is expected to remain firm. Services sector should continue to be resilient with strengthening domestic demand. Early results from IT firms suggest an improvement in business activity. On the demand side, the momentum in private consumption is expected to sustain next year. Rural demand remains steady with improving agricultural activity and rural labor market conditions. Recovery in urban consumption should further strengthen, with continued support from GST rationalization and monetary easing, among others. High capacity utilization, accelerating bank credit, conducive financial conditions, and government's continued emphasis on infrastructure should give an impetus to investment activity. Moreover, several measures announced in the budget should be conducive for growth. You are all aware that one of the kartavs, one of the pillars in the budget has been on sustaining growth. The recently concluded India-EU FTA and the prospective India-US trade deal, along with several other trade agreements, will support exports over the medium term. Services exports should remain resilient. The spillovers emanating from geopolitical tensions, volatility in international financial markets, and shifting trade patterns pose risks in the outlook. Taking all these factors into consideration, real GDP growth projections for Q1 and Q2 of next year, that is 2026-27, are revised upwards slightly to 6.9% and 7% respectively. The risks are evenly balanced. I may mention that we are deferring the projections for the full year to the April policy, as the new GDP series will be released later in the month. I now come to inflation. Headline CPI inflation remained low in November and December, even as it firmed up by 1 percentage point in these 2 months. This increase was largely driven by the lower rate of deflation in the food group. Excluding gold, core inflation remained stable at 2.6% in December. Near-term outlook suggests that food supply prospects remain bright on the back of healthy kharif production, sufficient buffer stocks of food grains, favorable rabi sowing, and adequate reservoir levels. Core inflation, barring potential volatility induced by prices of precious metals, is expected to be range-bound. Geopolitical uncertainty, coupled with volatility in energy prices and adverse weather events, pose upside risks to inflation. In terms of the headline inflation trajectory, despite the anticipated momentum being muted, unfavorable base effects stemming from large decline in prices observed during Q4 of last year, that is 2024-25, would lead to an uptick in year-on-year inflation in Q4 this year. Considering all these factors, CPI inflation for this year, the current year 2025-26, is now projected at 2.1%, with Q4 at 3.2%. CPI inflation for Q1 and Q2 next year are projected at 4% and 4.2% respectively. Excluding precious metals, the underlying inflation pressures remain muted. The risks are evenly balanced. Again, in view of the impending release of the new CPI series on February 12, as I mentioned for growth, we will be presenting our CPI inflation projections for the full year 2026-27 in our next policy statement in April. I will now be talking about the external sector. Despite heightened uncertainty, global trade remained relatively robust. India's merchandise exports, supported by trade diversification efforts, grew by 1.9% year-on-year in Q3 25-26. Merchandise imports grew by 7.9% during the same period, resulting in a widening of the trade deficit. Robust services exports and healthy inward remittance receipts would, however, keep India's current account deficit for the current year moderate and sustainable. Moreover, India's proactive efforts in pursuing bilateral and regional trade agreements with major trading partners are expected to boost international trade and investment, diversify trading partners, and integrate India into global value chains. Even on the external financing side, gross FDI to India increased at a robust pace during April to November 2025, for which we have data till now. Net FDI too increased as repatriations declined despite a rise in outward FDI. India continues to remain an attractive FDI destination for greenfield projects, as evidenced by a number of announcements made in this regard. However, FPI recorded net outflows of $5.8 billion till February 3 this year. As on 30th January 2026, India's foreign exchange reserves stood at a very healthy $723.8 billion, providing a merchandise import cover of more than 11 months. Overall, India's external sector remains resilient. We are very confident of meeting our external financing requirements comfortably. Now I'll be speaking about the liquidity and the financial market conditions. System liquidity, as measured by the net position under the LAF, which is the Liquidity Adjustment Facility, stood at a surplus of 70,000 crore on a daily average basis since the last MPC meeting in December 2025. There has, however, been an uptick, I may mention, in February, and now it is almost 2 lakh crore rupees. The Reserve Bank undertook several measures to provide durable liquidity in December and January. Based on assessment of systemic liquidity and its outlook, we announced and undertook further durable liquidity augmenting measures in the second half of January and February 2026. In response to the cumulative 125 basis points cut in the policy repo rate, the weighted average lending rate of scheduled commercial banks has declined over this period till December, for which we have data till now, by about 105 basis points. I may mention that the interest rate effect is 94 basis points. Similarly, the weighted average domestic term deposit rate on an average on fresh deposits declined by 95 basis points. This decrease on an outstanding deposit basis is 41 basis points over the same period. Coming to money markets, especially for CPs and CDs, that is commercial papers and certificates of deposits, the rates tightened in January 2026 after softening till December as a result of moderation, as a result of various factors, including moderation in surplus liquidity, excess supply from bunching of redemptions in CPs and CDs in January, and then there is always the year-end effect in the last quarter of the year. G-Sec yields mirroring global trends have continued to harden over the last 8 months due to a host of factors. Going ahead, the Reserve Bank will remain proactive in liquidity management and ensure sufficient liquidity in the banking system to meet the productive requirements of the economy and to facilitate monetary policy transmission. Liquidity management would be preemptive, with sufficient allowance for unanticipated fluctuations in government balances, changes in currency in circulation, and forex intervention, etc. I'll now talk about financial stability. The system-level financial stability parameters related to capital adequacy, liquidity, asset quality, and profitability of scheduled commercial banks continue to remain robust. Similarly, the system-level parameters of NBFCs too are sound, with adequate capital position and improved asset quality. As per latest available data, credit from all sources, it has picked up. It grew at 13.8% as compared to 11.6%. A year ago, it had even come down to 9% in May. Bank credit too recorded an uptick in recent months. This growth is supported by sustained lending to all sectors, particularly retail, services, and MSMEs. Large industries also recorded higher credit growth. Now, as has been the practice, I shall be announcing several measures which aim broadly to enhance, number one, customer protection, number two, advance financial inclusion, three, enhance the flow of credit, four, strengthen the UCBs, promote ease of doing business, especially for NBFCs, and deepen the financial markets. For customer protection, we will issue three draft guidelines. One related to mis-selling, this has been in the works for some time. Two, regarding recovery of loans and engagement of recovery agents. Three, on limiting liability of customers in unauthorized electronic banking transactions. It is also proposed to introduce a framework to compensate customers up to an amount of 25,000 for losses incurred in small value fraudulent transactions. You are all aware that there has been a number of fraudulent transactions for which RBI has taken a number of measures, and we will again in this regard we also now wish to publish a discussion paper on possible measures to enhance the safety of digital payments. Such measures may include lagged credits and additional authentication for specific classes of users like senior citizens. In the financial inclusion space, we have comprehensively reviewed three schemes: the lead bank scheme, the Kisan credit card scheme, and the business correspondent model. We shall issue draft revised guidelines with respect to each one of them. It is also proposed to launch a unified portal for better management of the lead bank scheme data. The limit of 10 lakh rupees for collateral-free loans to MSMEs is proposed to be increased to 20 lakh rupees. This limit has been there for quite some time. Coming to the real estate sector, to further promote financing to real estate sector, it is proposed to allow banks to lend to REITs with certain prudential safeguards. I may mention that lending to InvITs, which are similar in structure to REITs, is already allowed. Now I have four measures for the urban cooperative banks. They are an important link in our financial inclusion effort. The first two pertain to raising the financial limits on unsecured loans and loans to nominal members by the UCBs. We also propose to remove the tenor and moratorium related requirements on housing loans given by Tier 3 and Tier 4 UCBs. Then, to strengthen the managerial and technical capacity of the UCBs, we shall launch a mission which we call Saksham, which stands for Sahakari Bank Kshamata Nirman. This mission intends to train over 1,40,000 participants, officials, members, directors from the UCBs. I now come to NBFCs. There are two measures for them. NBFCs having no access to public funds and having no customer interface with an asset size not exceeding 1,000 crore rupees are proposed to be exempted from the requirement of registration with the Reserve Bank. Moreover, it is proposed to dispense with the requirement for certain NBFCs to obtain prior approval to open more than 1,000 branches. Coming to financial markets, you are aware we had earlier issued revised draft regulations for ECBs, that is external commercial borrowings. These regulations have been finalized. They shall be issued shortly. We also propose to remove the limit of 2.5 lakh crore rupees for investments under the voluntary retention route. Investment through this route, that is the voluntary retention route, in each category of securities, central government securities, state government securities, corporate bonds, will be subject to the investment ceiling for the respective category under the general route. Furthermore, in pursuance of the announcement made by the Finance Minister in the Union Budget of 2026-27, we propose to issue the regulatory framework for derivatives on corporate bond indices and total return swaps on corporate bonds. It is also proposed to issue draft revised guidelines for authorized dealer banks and standalone primary dealers, allowing them more flexibility in undertaking foreign exchange transactions. Now, before I conclude, I would like to inform that Reserve Bank observes the Financial Literacy Week every year on specific themes of financial education. The campaign this year will be launched on 9th February, Monday, coming week. In continuation of our ongoing endeavor on re-KYC of bank accounts, you are aware that we had launched a campaign for re-KYC and financial inclusion earlier this financial year. The theme that we have chosen for this year's Financial Literacy Week is KYC, your first step to safe banking. I urge all banks as well as participants to actively take part in this campaign. To conclude, the Indian economy continues to register high growth despite a challenging external environment clouded by geopolitical uncertainties. Benign inflation provides the leeway to remain growth supportive while preserving financial stability. We remain committed to meet the productive requirements of the economy and sustain the growth momentum. Thank you, Namaskar, and Jai Hind.
That is the Reserve Bank of India, as expected, not changing rates. It is a unanimous, decision by the MPC to leave the repo rate at 5.25%. The stance unchanged at neutral, but as far as the macro forecast is concerned, there have been some tweaks, although RBI refrained from giving out any forecast for the full FY27, either on GDP or CPI, on account of the revision, the revision that is expected with the new base series getting changed in the coming days. So as far as CPI is concerned, for the current year, there's been a 10 basis point upward revision. It was earlier 2%. Now it is 2.1%. And for the next 3 quarters, that is Q4 onwards, there has been an upward revision in the CPI numbers. So what was 2.9% for the fourth quarter is now seen at 3.2%. What was 3.9% for the first quarter of the next fiscal is now 4%. And what was 4% for the second quarter is now seen at 4.2%. On growth as well, as expected, RBI for FY26 has left it at the number that we got from the economic survey and the first advanced estimate. 7.4% is the growth number for the full year. For FY27, we only have the first half numbers, and that is 6.9%. 6.9%, an upward revision from 6.7% below. And Q2 is seen as 7%, which is again an upward revision of 20 basis point on liquidity. I think that is going to be the big disappointment. Not much said by the RBI governor, no mention of OMOs, only that they will continue to keep it comfortable with various measures as and when needed.
So I think that some of the stuff, it's basically it's absolutely as we discussed earlier, nothing at all. And towards the end, there was a few announcements with regards to NBFCs, bank branches, etc., etc. Housing loan, there was something, etc.
For urban cooperative banks.
Urban cooperative banks. So I think it's banking and more kind of sort of that kind of policy in terms of look at the market reaction. Nothing. Yields have not moved. Markets have not moved. Bank Nifty has not moved. We have SBI's Ashwini Kumar Tiwari with us. We also, of course, have our economists Kaushik Das and Upasana Bharadwaj. We also have Shobit Mehrotra with us. Thank you all for joining us. Ashwini ji, if I can come to you to begin with, Prashant here. Highlights according to you, sir, from the policy.
So the rush at the end, as you rightly mentioned, is something we are still absorbing. Those were the highlights. There was no change in the policy as we expected. So therefore, the announcements on banking, which is customer protection, financial inclusion, the raising of the ceiling of the MSME collateral-free loans, and of course, we are expecting the final ECB guidelines. So quite a lot of announcements towards the end. And we haven't had time to go through all of them in the detail. We will wait for the more details to emerge. But I think the focus, both of the government through the budget and of the RBI, is to push growth. And you are aware of the budget announcement of the Committee on Banking. So we will wait for those terms of reference. And I think there's a lot of focus on growth, having sorted out the FTA and the US-India trade deal. The focus comes back to growth, and banks have to play an important role in this.
Tiwari, just from what you've heard, and you said you will need to absorb it in terms of the exact specifics, but doesn't look, this is all, of course, aimed at more liquidity transmission and more credit in the system, as you said, but doesn't seem like an outsized impact in that sense, right? For any segment of the, be it NBFCs or banks, right?
Yeah, no outsized impact. But I think the most important and the best policy is, which is slightly boring, which is continues on a regular path, which gives consistency to the economic outlook and to the markets, not having too many changes. So I think in that respect, it's a very stable and a consistent policy. And whatever changes are announced, they are to make things better for customers, for banks, for all the market players. The corporate bond derivative is also a very important announcement, which we have to see the final guidelines and the total return swap. All of them are important announcements, but nothing outsized, nothing very, very earth-shaking, as you say. And we don't expect that to happen also.
But I'm wondering, Mr. Tiwari, why you're not sounding a little more disappointed, given that nothing was announced on liquidity and with deposit growth, lagging loan growth. The transmission, isn't that going to be a problem? And the second question was also on some of the measures announced, but first, if we could get your reaction on that.
So as the governor very clearly said that they will be dynamic, and as and when needed, they will take liquidity measures. They have done OMO yesterday itself, and they will do in future also as required. He said that as the government balances move, as the payments move, they will take further steps. So we don't expect full announcements all in this policy. As things evolve, they will take steps as required. And I'm sure that liquidity will be on their radar. This is the last quarter where a lot of taxes have to be paid. Liquidity is generally under constraint. And therefore, I think measures will be announced as and when needed. Not necessary that they should be done today itself.
Mr. Tiwari, just one more quick question on, one of the non-policy measures was the fact that the collateral-free loan to MSMEs, the limit for that is proposed to be increased from 10 lakhs currently to 20 lakhs. What kind of, additional credit do you think that could unlock for a bank like SBI?
So I think the collateral-free loans anyways, with the CGTSME having come in and that ceiling has gone up tremendously. So that there was no dearth of offering collateral-free, loans to MSMEs. What changes is that up to 20 lakhs perhaps will not require the cover as well. And therefore, to that extent, the fee which is paid by the customers, MSME customers, will not require to be paid. So for smaller customers, I think this is a good step in terms of being more viable loans, which they will get. And this will unlock a little bit. I don't think it is going to do a lot, but it will make the credit more affordable for the MSMEs, I mean the smaller SMEs, and therefore to that extent we feel that there could be some more pickup in this.
Upasana, your quick read of the policy and what you got in terms of, the next steps. Are we in for an extended pause with the kind of upward revision that we've seen to the CPI base? Of course, a lot of it is going to be, affected by the fact that the base year changes. We'll get new numbers. But what is your read? We're in for a long pause from here?
Yes, at the moment, if we read the numbers, there is a slight upward revision to the inflation reading, and there is also an upward revision to GDP numbers. In this kind of a context, of course, like you said, we will have to wait for the next GDP and the CPI readings, which are revised, whichever way. But for now, it appears that RBI's focus will largely be on liquidity, and more or less we are done with the rate cutting cycle. We will be seeing a prolonged pause from now, unless there is a dramatic change in the trajectory suggested by the new CDs.
Okay, and Kaushik, on liquidity, you were factoring in about 2 trillion is in the first quarter. Perhaps now that'll come outside of the policy. You still hold that view, and anything else that stood out for you, Kaushik?
Yeah, so the first thing is I think RBI has done the right thing to not kind of give the FY27 GDP and inflation forecast for the whole year, given that we'll get a new series of GDP and CPI. And they have done the right thing to hold rates. And what they have also shown, and what the governor mentioned, that yields have hardened in India, partly also a reflection of the global interest rate cycle also having turned and interest rates having gone up. So it's not something idiosyncratic to India or we should panic. And therefore, if you've seen India 10-year bond yields, I think have gone up from 665 to 670. But I don't think RBI is too much worried on that. And that is a good way of communicating to the market that, all these yields are also a reflection of market sentiments, and RBI will not come and try to, reduce it too much by doing certain, liquidity operations. Having said that, I think, as Mr. Tiwari mentioned, that March we have advanced tax outflows and all these things which will come into play. And therefore, I think there will be a need for more liquidity infusion. But at this stage, what we discussed, RBI already in the system, we have 5 lakh crore, surplus liquidity. What is more important for markets over the next 2 weeks is to see whether RBI is sucking out that liquidity or not. If RBI doesn't suck out that liquidity through what we call VRRR, that itself will be very positive for the market, because short-term rates will then remain closer to the SDF rate between 5.25 instead of staying above 5.25. So if you remember in June, when RBI cut the interest rates by 50 basis points, after a couple of weeks, it started doing VRRR to withdraw some bit of excess liquidity. And that led to fear about transmission, not happening and all that. So we need to wait and see whether RBI sucks out that liquidity or not, which is there. And if it doesn't happen, that itself is positive. And over a period of time, I think, it is a question of timing. RBI will have to announce more OMOs because of the demand supply dynamic of the budget as well. But overall, I think it's been an excellent announcement, and RBI has shown kind of stability in its announcement, and markets will move on from here. The reason I said the risk, to growth being revised up, the risk was the bond market, not equity markets. As you've seen, these have hardened with both inflation and growth forecast being revised high.
Yes, in fact, let's pull up the 10-year bond yield. It was 6.65, at the start of the policy. It's gone up by about 4 basis points. Now you have it at 6.69. So if you could have, the 10-year yield up for you. There's a little bit of a hardening, because we didn't really hear much from RBI on specific liquidity, injecting measures. I think that was a tad bit of a disappointment. But Mr. Tiwari, good for you for now. At least no rate cuts have come in. So margins will remain protected in the near term.
Yeah, margins will remain protected, but I would take this opportunity to bring out some other measures announced, which I could not say in the first instance. One which very important announcement was on allowing banks to lend to REITs. Now, this is a 2 lakh crore market, but growing at 25% and expected to reach 25 billion by 2030. So I think this is a very, very important announcement. We will wait for the guardrails he mentioned. But I think along with InvITs, REITs, these are the ways to go to unlock capital from productive sectors like real estate. So this is a very, very important announcement. Also, I think one other thing which RBI has been focusing on, but it needs to be continued, is the fact that we need to protect customers better from digital frauds. And therefore, this announcement of small value transaction frauds, compensation to be paid, senior citizens to be protected. So we'll wait for those details as they come in. But I think those two are again very, very important announcements from a banking landscape perspective.
Okay.
I just want to highlight, you pointed out yields, right? So I just checked out Ritu, the Nifty Bank. So the reaction actually started, I think, around the same time, 10:30 onwards. 10:30, the Nifty Bank was at 60,000. It's basically come off about almost 300 points now on the Nifty Bank. I mean, I think an intraday will tell you that story. So maybe at the margin, there was some expectation. Markets are always hopeful. And it's their job to expect. Policymakers must do what they think is right. So there's a little bit of a drop-off which has happened. I mean, some 270, 280 points, and that is 10:30 onwards, because I guess the markets were waiting till the last minute to see if there is something. But obviously, it's been a steady kind of sort of holding pattern kind of policy. Ritu.
Well, we'll have to see. It's not good news. I mean, yields hardening is not good news for the economy, not good news for the banking system. Could be a bit of a treasury hit we might see in this quarter because of what's been happening. But Shobit, thanks very much for patiently waiting by. Give us your quick takeaways, any additional information you've been able to, get out from the statement that we've heard so far. And, going ahead, what is your sense? Is there any other, is there a chance of any further rate cuts, or are we in for a pause?
I think the policy was on expected lines. It's a status quo policy. There were some expectations on liquidity front that RBI may announce some relaxation on LCR or some other measures to improve the liquidity for banks. But I think the RBI is drawing comfort from growth resilience, and they are quite confident that private consumption would sustain the momentum which has been seen. Nothing much needs to be done. So I think post this policy, market would get around to the view that further cuts are far away, if any. It's going to be a very long pause with only intervention coming from RBI in the form of providing liquidity. So medium term or in the coming fiscal, market has to contend with a very large borrowing program, over 17 lakhs crores of gross borrowing number. So it is going to be tough. I think once the SDL borrowing number also comes out for the fiscal 27, market would find it difficult to absorb that kind of a supply of both GSEC and SDL, which it has to contend with. So short to medium term, I think bond yields will continue to remain under pressure unless the global backdrop completely changes and we see growth slowing down globally and risk of environment or risk of sentiment spreading globally and coming to India. So only in that case perhaps we'll find some degree of comfort for bond yields, but otherwise bond yields are seemingly heading higher from where we are today because of the large pressure of supply which is likely to hit in the coming year.
Yeah, it could be almost 30 trillion if you account for the state SDLs as well. But Mr. Tiwari, quickly, I know you have to leave. The governor is going to be addressing the media shortly. I'm wondering if banks like you had any clarifications that we could put forward to the RBI. Any questions you would have of the governor or anything you'd be keenly watching out for?
It's too short a time to actually ask any clarification today itself. And you all have been very good spokespersons for all of us banks. So I think you already have questions you will ask on liquidity and other stuff. Nothing at the moment. I think it's as everybody's mentioned, it's a steady policy. The only thing I would say, I know the yield should be lower, but I think as the large borrowing program comes into play, the focus actually is more on the capex side. So as that starts to happen, the growth will be further strengthened, and into that sense, it will be a good higher borrowing, if I can call it that. So in that sense, overall, it will settle down. Nothing more at this point of time. We will wait for all the announcements and the details which will come out in due course.
All right, Mr. Tiwari, thank you very much for joining in with that. We'll let you, leave us at the moment and hope to catch up again as we get more details from this policy. We'll slip into a short break, but don't go anywhere. We're back to continue to analyze this policy and also take a look at the markets when we return. Welcome back. We're continuing our coverage of the RBI monetary policy. For viewers that have just tuned in, the Reserve Bank of India has left the repo rate unchanged at 5.25%, left the stance unchanged at neutral. But there's been a bunch of revisions on the macro forecast and, some measures for banks and NBFCs to ease the credit flow in the economy. We still have Upasana Bharadwaj, Chief Economist at Kotak Mahindra Bank. And, we also have Kaushik Das, Chief Economist at Deutsche Bank with us. Upasana, in the few minutes of time that you've had in the break, any additional takeaways that have come out for you from the read-through of the governor's statement?
I think, Ritu, broadly, I would say that, much of what the governor has said has been in line with expectation and a very balanced one. While, yes, we could have seen unchanged inflation and GDP numbers. That is the only change that has happened. Otherwise, I would say at the moment, whatever the guidance that the governor has provided is a fairly balanced one. We should not read too much into it. But overall, I think the broader theme going ahead will be focused on liquidity and how the frictional and the durable liquidity will have to be managed going ahead, how the sentiments will have to be managed going ahead, maybe through verbal intervention as well if required. But otherwise, I don't really see much of a change. I just want to point out it was a consensus, unanimous view on a pause. So I think that also points towards the fact that most of the members do believe that they are done with the rate cutting cycle and we will be seeing a prolonged pause. So I think these are aspects to be kept in mind. For us, what we look at is now that the US-India trade deal has tentatively been announced, let's put it like that, at least there is some kind of headwinds which have faded off. And if the FPI flows were to begin, then probably the need for durable liquidity, at least into this year, will reduce significantly. So I think at this point, we don't really see too much room for OMO or additional buy-sell swaps or so in this quarter. Going ahead into next year, of course, going by simple structural requirement of liquidity, there will be need for additional OMOs or liquidity measures, but we don't really see that to the magnitude that we've seen this year. I think if things stabilize and flows stabilize, then the balance of payment will start looking slightly better into next year, and hence the need for durable liquidity infusion will be limited. But at the same time, as Kaushik was mentioning earlier, I think at this point, markets were more worried that if RBI was to introduce a VRRR, that could have acted as an adverse factor here. And the good thing is that very prudently, they have refrained from announcing anything on the VRRR front. I think they should delay this for some more time so that they don't unnecessarily unnerve the market. And that's how I would put across today's policy.
Well, the RBI certainly seems to be in the favor of keeping these liquidity announcements completely outside of the policy, manage it day to day. But Upasana, very quickly, before I go to Kaushik, RBI's number for inflation and GDP is 2.1% inflation for this year, an average of about 4.1% for the first half of next year. And on GDP, 7.4% this year, 6.95% average for the first half of next year. What are your internal estimates and, how do you gauge what RBI has given us?
Ritu, I think it's broadly in line. Just the only trouble is that we will be seeing a shift in these numbers in a week's time for inflation particularly. But actually for H1, we are at 4.1% inflation, which is broadly in line with RBI. A 10 basis here and there for each quarter. But broadly, we are at 4.1%. So I don't think there's much difference there. Maybe on the GDP side, we are a little on the softer side. We do believe that there could be a 20 basis downside to the GDP numbers in H1. Our full year numbers are at 6.5% for now. But again, as I said, we'll have to wait for the new series to really finalize these numbers.
Okay, Kaushik, you have the last word. What are your GDP and CPI numbers, compared to what RBI has announced? And any final thoughts? Anything you'd want clarity on from the governor when the press conference starts?
Yeah, so Ritu, a couple of things. One is, I think this policy is kind of indicating the forecast and everything that the rate cut cycle is behind us. I don't know why people are expecting rate cuts. On one hand, you're saying growth will be above 7%. If you see the chief economic advisor saying growth will be close to 7.4. And then you're saying that from April, June itself, inflation would be at 4% and then going above 4% mark in July, September. And when the October, December number forecast comes, you'll see inflation would be above 4.5%. So you're talking about an economy which is continuing to grow at 7% plus, with inflation now going to go above 4%. There's no question of giving any rate cuts. The maximum that RBI will do is basically ensure that the transmission of the 125 basis points rate cuts of last year, that continue into the market to the extent possible. But beyond that, market is telling us that the next rate action, whenever it is, maybe 2027 is when I have a rate hike from RBI in April. The next move, a rate hike and not a rate cut. So that's the first thing to remember. Second, on liquidity, what you can ask and what will be more interesting for the market is that currently, as I told you, we have durable liquidity of about 5 trillion INR, which is much in excess of 1% of NDTL. Whether RBI will look to kind of reduce some part of that liquidity through VRRR. If they don't use that, that itself is a very positive kind of sentiment for the market, because the short-term rates will be then anchored lower than the repo rate. But we have seen in the past, that when liquidity becomes too much in surplus, RBI has used this VRRR to reduce some liquidity, because they have a neutral stance as well, so they can do that. But if they don't do it this time, that will be very good for transfer. They have used the word for the first time, I think, they normally use proactive management of liquidity. Now they have used the word preemptive. RBI will remain preemptive with liquidity management.
Correct. Yeah.
Does it mean that they'll give more, or does it mean that they will suck out liquidity when it is too much of surplus? That is what you need to clarify when you ask the governor during the press conference.
Sure, Kaushik. All right, Kaushik and Upasana, thanks very much for joining in with your thoughts. That is as far as the Reserve Bank of India policy is concerned. No change on rates. That's at 5.25%. No change on stance. That remains at neutral. A whole bunch of revisions to the macro forecast. The CPI for this year is upped from 2 to 2.1%. And for this first half of the next year, again, a bit of an upward revision coming in from RBI. On the GDP front, again, this year's forecast left at 7.4%, and for next year, it's been upped to an average of about 6.95%. That's where we're at as far as RBI is concerned. A bunch of measures for NBFCs and banks as well that we'll continue to analyze for the day. But for now, we'll wrap up this special coverage on the monetary policy. Trading Hour will take all the action forward.
Good morning, you're watching us here on Trading Hour. I'm Mangalam Malu, with me is Hormas Fatakia. We come to you live from the CNBC TV 18 Motilal Oswal studio. And it's been a down day so far. In fact, the Nifty, as we speak, is just about holding on to that 25,500 mark. We're below yesterday's low, below the previous trading session's low as well, and just about 1,000 points away from the budget day low. Too far away, but obviously over the last few trading sessions, we have seen a big gash. From the highs that we hit on the day, the India-US trade truce was announced. From there itself, we've seen a near 700 to 800 point correction on the frontline index. So nearly half of those gains between, the budget day low to the day that, India-US trade truce was announced, we've given up half of those gains, of those, 2,400 sort of point gains, now down to just about 800 to 900 points. The broader markets have it worse. 2,100 stocks in the red for just about 666 stocks, which are in the green. And this because no material respite has come from the RBI policy. Yes, they've kept the rates unchanged. There's no incremental liquidity support that has come in as well. So it's a pretty status quo policy. The street was hoping for some sort of support coming in some sectors, but maybe that hasn't come by. Paytm is one of those stocks that I'm tracking very closely because there's been no relief or no comment yet on the PIDC thing, for which Paytm saw a big decline. So right now as well as we speak, the stock is down about 3%. The only couple of stocks which are doing well right now are the tobacco stocks. So we have Godfrey Phillips, which is higher, and alongside that we have ITC, which is higher as well. Why are these stocks higher? Because obviously they had seen a big knock in all of January because of the big hike that came in taxes. Now the street believes higher prices would be effective from Feb 1. So assume 4 or 5 days worth stock. The new stock that comes by will have higher prices, almost 20 to 25% higher. There is no confirmation yet from the dealers, but that's what the street is baking in right now, which explains why these two stocks are the only few islands of green that we're seeing in an otherwise ocean of red. Hi, Hormas.
Hi, Mangalam. This week has been the perfect test of the optimist versus the pessimist. How you look at the market. The optimist would say, oh yes, we are still up for the week. The pessimist would say, well, you're still down almost 700, 800 points from the highs that we made after the trade deal was announced. But of course, a status quo policy coming in from the RBI, the broader markets at the lowest point of the day as well. Let's get in Ajay Srivastava of Dimensions Corporate Finance Services, who's joining in now. Ajay, good morning. Thank you for joining in. The RBI policy, well, on expected lines, but it just serves no purpose to a rate-sensitive sector like real estate, which has already been battered in the first, say, 40-odd days of the year. What do you stay away from a sector like this, and what do you make of the other rate sensitives as well?
See, what did you expect? If you look at it, what did you expect of the RBI policy? Look at the government yield, they're up. The government could borrow 17 lakh crore this year. If you look at now, forget this year. Now look at the next fiscal year. It's got still larger repayment borrowings coming up to year 3031. The amount of money the government has to return back to the investors, the debt holders, is going to be going up. So there is no respite on the debt side. So, what can the RBI governor do at the end of the day? And that's the point, the expectation is what she'll do. He can't take the rate up today. He can't take the rate down. Of course, it's a dumb idea because you already seen the yield. So, what do you expect of the poor fellow? The only thing, and I think the only important thing is one should have looked at is what's his ideas about how the government debt will be funded, what will be the trajectory of it, how will the yields be covered. I think he was silent because I guess he doesn't know what's going to do with it at the end of the day. So be fair to the guy. The problem is not his. He has been given it to it. He has to manage it. Nothing he can do. Indian interest rates are going to go up. Now, that's a reality. He didn't want to say it today. He will say it the next time or maybe next time that we will see a 1% interest rate increase in the next 6 to 9 months. And that's a reality we should bake into our financial projection. Equity markets are showing that already, which is very sensible. Look at equity markets. They're smart. They're already apprehending that interest rate will go up. They're showing it. So let's not get into the fact, could he do anything? I don't think he could do anything. He has enough OMOs. Look at the last 2 months. Every third week, there is an OMO sitting there. He's done dollar swaps at the end of the day, $10 billion swaps. He's shoved liquidity down our throat like nobody's business. But you can't change fundamentals. The fundamentals are the Indian interest rates have to go up for equilibrium to come in and foreigners to bring the debt into it. There is no other solution to it. Sooner we bite the bullet, the better it is.
So what happens to the equity markets until then? Because like you said, equity markets are smart. They're pricing that in. When interest rates go up, they're not good for literally anyone in the equity markets, right? Because the denominator for the future, present value of future cash flows, that itself increases, the discounting factor increases, the valuations have to come down. It's not that we're particularly cheap, we're at par with, say, 10-year averages for the index level, and a little lower than par for a lot of the mid and small caps, which have seen a 50-60% cut already.
You're right, absolutely correct. And that's what I'm saying. The market is telling you all at the end of the day that with all the, euphoria that sits around the various treaties, this, that, and so on, economic fundamental of demand, supply, and what you said, valuation prevail. Short term, there may be euphoria. Short term, there may be, you feel, go down, market goes down. But end of the day, this year is going to be the toughest year because what's happened this year, if you look at it, last year, last quarter, all investors made tons of money in commodities. This year, an average investor is fighting against regulatory authorities. People have to understand what's happening. The regulatory authorities, if you look at the margin in MCX, today the silver margin is 74%. Now, if you're in a futures market, are you apprehending that the silver will go down to 55,000? No. So there is a concerted attempt out there to take your investor returns out in favor of the corporate market. That's what is. So when you said what will go up, I think what will go up is the commodity prices, if they're cooled down by this methodology, should give a lot of fair, tailwind to our producer companies, the auto companies, the solar companies, and so on. I think they should do a better job this than last year because commodity hits last year were huge. So the loss of average investor in the commodities market is going to be gain to some of the industries. And that's all about I can say. So you are fighting, as an average investor, you're fighting central banks, you're fighting regulatory authorities, you're fighting margins, and your odds of making a return have fallen this year quite dramatically. Last year, we all made good money in commodities. This year, we started with a horror story. Let's hope, and I sincerely always hope, I'm optimistic, I'm invested in the market, that we should do better, things will change, but looks tough. And I simply say that I have certainly more gray hair than money in the bank at the end of last 60 days.
Well, Ajay, since you mentioned things would be tough, would it be tougher for IT? You touched that sector with a barge pole now, considering what all has been transpiring over the last few days across the globe now.
No, only one reason. 3 years I've been saying this. 3 years I've been saying this consistently. Indian IT management should be sacked. They have been negligent. They have been like a bureaucrat. They have made money for themselves and given dividends and this thing and invested nothing. Zero. Look at the investment done by Infosys, TCS, Wipro and all is zilch. Look at the dividend they gave to the shareholders and look at TCS. Just think about it. You're an investor. TCS is giving out dividends so the Tata Group can put money in an airline. Just think about it. You could not find reason to invest in TCS, in technology, and gave money out of dividend to invest in airline. Is that something sensible, anybody? So I think we have brought it on our own self. That's the only thing I can say. Nothing global has done to us. We could have done what Anthropic has done. We could have been part of Perplexity. We could have done many other things that's happening in the world. We could have been the front end of AI. They had the money. They had the money in the bank, zero borrowing. But what did they do? So it's not about IT environment. It's the management of Indian IT companies, which I think is squarely responsible for putting India into such a difficult position. And, project 3 years down the line, if your remittances fall, we have nowhere to go. We are a deficit nation at the end of the day on trade side. So these guys, government should be pulling the guys up and the promoters and the management and saying, guys, what have you gone and done? And can you do something about it? Trump hosts all the time, the IT companies sitting there. And if you remember the discussion, he asked, how much are you investing? He asked Mark Zuckerberg, how much are you investing this year? I think that's the dialogue the government needs to have with these companies or force them down the throat that they need to invest for India. They can't give dividends and pay off airline debt, which is the most ridiculous way. So that's IT is a problem, is not the company, is the management.
Right. Amidst all of this, what do you do with the consumer space then? The government has done all it can by reducing the interest rates over the last few days, last few sessions, the RBI. You had the tax rate cut that has come by. Then there was the GST cut that has come by. Rural economy is looking slightly better than urban. The consumption stocks, they haven't done much over the last 2-3 years, so they've seen time correction. Do you think staples is a place to invest?
No, unfortunately, no, because valuations are very high, growth loads is very low. So when you compare the valuation of these companies with what they're growing today, the disparity is huge. We are still very happy with P's of 50s and 60s in this country. And when Microsoft goes to 30, it faces a 12% correction. So I think Indian investor, particularly mutual fund, have been guilty of putting money into companies with absurd valuations. Absurd valuations is the only word I can say. And it is showing up all over the place now. So issue is not the companies are not doing well or they've improved or the GST cut. The issue is the base rate at what you enter into a share, does it give you comfort to make a return? And that is where too much of money with mutual funds, irresponsible investing, and I'm really saying irresponsible investing, has led to this. Why would you put money in a Swiggy which is losing cash every day? Think about it. Which mutual fund does it? Indian mutual funds do it at the end of the day. So India's problem is not companies not doing well. They're okay, in the global market, the 5, 6, 7% growth rate. Let's not expect them to do 20%. The problem is shareholder is valuations. If I enter at a PE of 50 and a growth rate of company of 7, how do I make my return? You saw what happened to Trend. You saw what happened to DMart. You saw all the retail stocks. People are buying at valuation of 130 Ps. So you have to live with it. I think there'll be more time correction, and you will see opportunities coming up because market has to correct for investors to make a return in this environment.
So in this light, what gives you the comfort, Ajay, to make an investment right now?
I think, there are segments. As always, there are good parts and bad parts. There are monopolies. For instance, stock exchanges are a monopoly in this country. You can't do anything. If you want to buy commodities, you go to MCX. If you buy the stock market, you can go to the BSE or NSE. You can't go anywhere else at the end of the day. It's not like America, where you can, even firms can do intra-trading square off. So therefore, if you have a stock exchange monopoly, India is there. Volume may go up in a quarter, go down in a quarter. But over a 2 to 3 year period, Indian volumes will go up at the end of the day. So you are in a monopoly status. No debt company, nothing major to be done, no foreign competition to come in. What a brilliant space to be in. So I think those are good spaces to be in. Healthcare. Now again, healthcare is a very good space to be in, whether it's hospitals, but the valuations killed the whole thing. Everybody piled into it. Ps became 70, 80. And now you're seeing last 1 year is a time correction and some correction in the value. But technically speaking, hospital is a greater segment to be in India because you can't build a hospital overnight. Mining industry, sure, it will have its own vicissitudes of prices. It's the greatest place to be because you can't build a mine in 20 years at the end of the day. And all products are linked to US dollars. India's rupee will depreciate, that will make a... So mining industry, metal, not ferrous, non-ferrous metal industry is a great place to be. Hospital is a great place if corrections happen on price. Stock exchanges are a great place to be. Autos, we are the best in the world in auto. We'll be exporting to everyone. The biggest advantage of FTA will come to auto industry. So if you're not in auto, I think auto is the place where you can be. And I expect in my lifetime, 3 to 5 years, exports of auto companies will be more than the Indian domestic market sales. And that will change the way the valuation of these companies will happen. It's a great place. Our auto ancillaries are a great companies. So auto space is perfectly fine. So there is optimism also. As I always say, I'm invested in India. The question is, which pockets are you invested in and whether your calls pay out at the end of the day. And I'm repeating my saying, I'm heavily invested in bullion. I'm heavily invested. I now started investing back in silver again at the end of the day because you can't take it away. You can engineer a price correction. You can't change the fundamentals. And long term, investors will win. Short term, you could have brought us down at the end of the day as block-up investors by putting that absurd 74% margin. Long term, you can't change the dynamics of silver and gold industry. So it's not so bad also. We need to make our living, right?
Right, we take that point. Thank you so much for
Thank you very much.
Speaking to us, Ajay. With that, we'll take a short break. In fact, as we do that, there is some recovery that we've seen in the frontline index. In fact, when we started the show, the Nifty was below that 25,500 mark, and now it's recovered a good 70, 80 points from there. And the reason for that are three. One is Reliance, the top weight on the frontline index. The second is Bharti Airtel, the second highest weight on the index after HDFC Bank. And the third one is ITC. So we've been speaking about a couple of these, heavyweights batting for the Bulls. These stocks have put their hands up, or rather bats up, when it mattered, and all these stocks are actually doing well, limiting the losses that the frontline index has posted. Take a short break. Astral, the management, joins us post their third quarter numbers.
Fly Emirates, fly better.
Welcome back. So now just 75 points lower is where the index is, led by the names that Mangalam just highlighted a few minutes ago, be it Reliance Industries, ITC, Bharti Airtel, all of them leading the recovery seen from the lows of the day. Continuing our conversation with corporates, Astral reported a mixed quarter this time around, but to discuss the road ahead, we are now being joined by its Executive Director and CFO, Hiranand Savlani. Mr. Savlani, good morning. Thank you for joining in. Your volumes were 16.8%, fairly good, and within the range as well that the street was projecting. What is the situation that you are seeing on the ground currently, and do you believe that based on what you have witnessed so far, does that improve in the fourth quarter going into the final quarter of the year?
So if you see the industry dynamics, the industry is not growing that high. But because Astral did a lot of decentralization in the recent time, so because of that, our volumes were excellent. And we are expecting that the volume will further inch up because the industry was passing through a very tough time. Last 3 years, if you see, the polymer prices were going down. And this is the first quarter where we are seeing that at least now the bottom out is being taken place. And from here on, the prices have started going up. So that will help us in the further growth into the volume. So we are expecting better volume than what was there in the Q3.
Right. So Q3, you posted about 16.8% volume growth in the plumbing segment, and value growth was 8.3%. Obviously, the deficit was because of the lower PVC prices. And since then, in January, if I remember correctly, it's increased by about 7 rupees per kg. Do you think, you will exceed your volume growth despite higher prices? And if you could break your Q4 targets, volume and value-wise.
So see, normally whenever the price rise is there, there is a lot of restocking take place in the street. And secondly, there is a genuine uptick in the demand. So which we are seeing from the December onward. December was excellent number, January was good, February has started with a very good note. So because of that, it looks very clearly that even if the higher price also, we will be able to surpass the volume what we have done in the Q3.
And I'm sure you must be sitting on some low price inventory as well. What kind of margins can you target in the fourth quarter because of that? And going forward for FY27, what's your volume and value growth guidance along with margins, if you can give it?
So I think definitely we are sitting with a sizable low inventory cost. So that is going to benefit us in the Q4. So margin should be better in the Q4. And even in the historically also you see the Q4 in our industry is the peak. We are generating the maximum volume in Q4. So economy of scale advantage will always be there in Q4. And now with this advantage of this price rise, so it's a double advantage to us. So definitely Q4 will be much, much better than what you have seen so far. And next year, I think once we will close this year, based on that, we will give our guidance.
And what about top line? Mr. Savlani, you had mentioned double digits for this year. You're at 8% right now for the first 9 months. Do you cross them?
It looks like that we will be closer to that.
All right. What about your adhesives and paints business? The paint industry, the biggies have reported their numbers, and it's not particularly good, impacted by extended monsoons and, a shorter festive window as well. But you've managed to grow over 20%. What led to that? And, what's your plan here? Are you making margins profit? Have you broken even here?
So right now we are in a growth phase because if you see that we opened up the 4 new states and from there we are trying to catch the volume. That is why you can see that in this quarter we have grown by 21%. So going forward also, we are targeting that maybe one more year, EBITDA may not be that lucrative, maybe a lower single digit kind of level next year, but top line growth will be very high because we are at a very, very nascent stage of the business and our base is very low. So on that low base, growing higher percentage will not be a big challenge. And then economy of scale will start playing and then that will help us to generate the EBITDA positively.
Does the same apply to realizations as well, Mr. Savlani? Since you mentioned you are on fairly decent low-priced inventory right now, when do you expect the realizations to recover?
I think Q4 onward, you will see the realization will start picking up.
All right. So, and just a final question from a medium to long-term standpoint, what kind of revenue mix are you expecting coming in from, the PVC plumbing business? How much of that comes in from paints, adhesives, and even your bathware division, which has done well, just about broken even? What's the contribution target from these places?
So I think from here on, we are expecting that other businesses will keep generating between 33 to 35% kind of ratio, and the plumbing will generate 70 to 72%, 73% kind of, 67 to 68% kind of contribution. Bathware is doing very well. You can see in the number also that the last quarter we have grown by 36%, which is a very, very encouraging number for us. And the way we are seeing the acceptance is increasing in the project level. Going forward, we are going to even grow much better way, because initial journey is always tough, because it's the trial kind of taste will be there in the market. Once they will taste our product, then we can start getting the bigger ticket size of project. Initially, they will give me maybe 1 or 2 tower. But afterward, once they will taste our product, they can definitely give us the full projects also. So that revenue jump will be very high, maybe 1 year down the line from here. Because right now, still at this growth also, we are at a testing level, I can say.
All right. We take that point and wish you good luck for all of that. The next couple of quarters look good for you, and the medium to long term for all your non-PVC sectors as well. The market continues to roar higher now. We have the Kotak Mahindra Bank stock. That's the one that should come up for you. That's spiked to the high point of trade. And alongside that, we have HUL as well, which is higher. Remember, among all the FMCG companies, HUL hasn't reported its numbers. The numbers on the 12th, which is next week, Thursday. And that stock too has moved higher, and the Nifty has now reduced its deficit versus yesterday's close to just about 50 points. Below that, in fact, as we speak, the Nifty is going closer to that 25,600 mark at a time when we started the show with sub 25,500 on the frontline index. So a good recovery is what we've seen. More of the markets on the other side.
Well, it's a good time to do a quick market check. Then, as we can see, the Nifty is down close to around 50 points. But as we mentioned earlier today, that 20 DMA is extremely important, both for the Nifty as well as for the Nifty Bank. And as we speak, I can see both those two indices actually have seen a bit of recovery from the day's low. When we started trade, there were close to around 700 stocks that were advancing. Take a look at that number. It's around 830. So to be very, for your portfolio to feel good, actually, by the end of today, you'll want that number actually to perk up a little bit. The problem is the IT stocks. And a lot of them, thought that we had a budget surprise coming in there in budget 2026. But that's got offset because of the tech burst that we're seeing globally. You have TCS, you have Tech Mahindra, Tata Elxsi, all of them are selling off. So massive market cap erosion is what you're seeing. Even Persistent and Coforge actually are seeing some selling pressure. Add to the list a couple of auto ancillary names. If you look at Uno Minda, well, that stock is lower in trade. So let's get that one up for you on the screen. Samadhana Motherson as well, that's down close to around 3% or thereabouts. And Poly Medicare, there's a big opportunity out there. But for the time being, the stock actually has halved from the top. So that stock as well posted its numbers. Let's get Poly Medicare up for you. That one as well is seeing some. The stock started off in the red, but actually that's seen a bit of a recovery from the lows of the day. On promise that Q4 is going to be absolutely spectacular. They did, close to around 2,000 crores thereabouts in the first 9 months, and they're saying that in the, the final quarter they'll do around 1,700 crores. Let's bring in some good news then. Hitachi Energy, solid numbers. Mr. Venu sounds very, very confident about the path ahead. The street likes it, not cheap, but they like it. Some rub-off effect it seems on Siemens as well. That stock is up close to around 4% in trade. A few more winners should come up for you. LIC, Nykaa, as well as Data Patterns, all reacting to their numbers or a day post the numbers as well. The street likes it out there. Cigarette smoking, yes, it's injurious to health, but I don't know what's going on there because you have a couple of stocks. Godfrey Phillips, the stock is bursting away, up close to around 10%. Big Boy ITC as well, it's taken support at around 310 odd, and that one as well has perked up big time at around 320 rupees odd. Metal stocks, well, they are melting. You have Hindustan Zinc that's under some pressure. You have Hindustan Copper as well, that's down in trade. But guess what? Vedanta, that stock, the last time I checked, there was a big recovery of close to around 3% from the lows of the day. All that glitters is Vedanta, it seems, in the metal pack because that's the lone warrior that's fighting in there. Physics Wala is another stock that's lower in trade. But net, the markets are down, but a good recovery from the lows of the day. And if you compare us with what's going on in the globe, actually the picture is looking quite good. The important number to track will be this one. The number of stocks advancing. By the end of today, we are calling for 1,000, 1,200 odd. If that happens, your portfolio will feel quite good. But that's it from me. Back to the trading hour team.
Well, take that, Nigel. There has been a fair amount of recovery from the lows. You speak about ITC and Godfrey Phillips. What we understand is that maybe one of the two companies, and my sense is it's Godfrey Phillips, has printed the new prices and delivered it to the stores today as well. We are in constant touch with ITC as well to try and find out whether that price hike of around 20 to 25%, which was impending over the last month and a half, ever since the hike came by, has happened or not. So we're in constant, connect with the dealer channels and all of them to try and find out a confirmed increase, whether the price has indeed been increased on tobacco or not. And the street is actually on the back of that betting on ITC. And that's not the only outperformer. We're currently seeing some support coming in from Reliance, Bharti Airtel as well, ahead of the conference call post their numbers that came by yesterday after markets. So these stocks doing well, and the Nifty Bank has strong support around that 59,500, 59,400 mark because you have the 20 and the 50-day moving average, and the Nifty Bank today has recovered from those levels as well. Nifty 2, today's low, 25,491. What is the 20-day moving average? 25,450. So it's maintained that, and now the 100-day moving average is something which has to cross past because yesterday that's exactly where it closed. The put-call ratio at one point was 0.71, indicating oversold zones, and now it's inched back to 0.83. And we are seeing some action at the 25,600 call. If call writers will have to cover their positions, so we'll track that.
We'll track that, and 25,590 is where the index currently lies now, 55 points lower as we speak. Some good movers, as Mangalam just highlighted, but one segment that hasn't done well all through and through has been real estate, and even today is no different. Most of the stocks trading with losses. Signature Global down 4, Oberoi Realty down 2, most of the others too trading with losses of anywhere between 1 to 2%. So real estate, after no significant announcements in the RBI policy, continuing to underperform. Take a short break. We'll be joined by S. Ravikumar of Cognizant on the other side. Stay tuned.
You want to talk business? Meet me in the On-Board Lounge.
$25,600 is back on the Nifty, and the leader of this recovery has been ITC at the highest point of the day now. After having its worst January possibly on record, the stock has begun February on a positive note, 4% higher now on the stock. At the highest point of the day is ITC. But continuing with our conversation, Cognizant reported its calendar revenue growth guidance ahead of expectations. We're joined by S. Ravi Kumar, the CEO. Ravi, before we get chatting about the result on the tech wreck that you're seeing globally now, is this overblown or is this a cause of concern?
Look, it's a little irrational and illogical to think that this brilliant, extraordinary technology we have in our hands will magically, get plugged into businesses and there's going to be value there. It's not going to happen. It's not happened before, and it's not going to happen in the future. In the last 1 or 2 years, we had $600 billion of AI infrastructure being built by the hyperscalers and the frontier model companies. That value has to drift to businesses, and the drift is going to happen in a slow and steady fashion. And this is a contextual, it's a contextual technology. It sits around the LLM versus software written in the past, which was value around the microprocessor. So you need contextual engineering to ground this technology in the business, in the heterogeneity of business, to understand the hustle of the company, to understand the work patterns, the flows and everything else. It has to integrate into the operating and physical layers of enterprise landscapes.
But, there are two concerns. One is the increase in revenue deflation from the current 2 to 3%, maybe to, say, 5 to 6%. And second, that there will be no added uncertainty into client decision-making process until the AI architecture settles down. Do you think this is likely?
It's a very simple philosophy. I have 2 swim lanes on my strategy. The first swim lane is, how do I apply AI and create more productivity on the software we wrote for the last 25 years, which is more deterministic systems of record, layers of value which are logic-driven and algorithmic-driven. So are we going to do it in newer ways? Yes. The throughput we are now getting from our developers at the bottom of the pyramid is very high. In fact, we went from code assist platforms which support synchronous productivity improvement for developers to asynchronous productivity development. What I mean by that is, a software developer is using the tooling to increase throughput, but building agents around them and actually asynchronously delegating them. I call it macro delegate. And then steering them, I call it micro steering, to actually get nonlinear productivity. And when nonlinear productivity comes on traditional software or classical software, you're actually going to consume more, you're going to take the backlog off, and you're going to take the technical debt off. So that is the first swim lane. Is that going to be deflationary? It's going to be deflationary, but it's actually going to create, because it has elasticity, it's going to create more throughput or more consumption.
Ravi, your constant currency revenue growth of 4 to 6.5% in 2026, which includes inorganic contributions of 150 bips. How is the demand environment looking right now?
At the start of last year, the midpoint of our guidance to the start of this year, the midpoint of our guidance, we went up by 150 basis points. So it is better than organically. So it is better than last year's guidance we originally gave. We beat that guidance. We upped the guidance in end of Q3, and we beat the guidance which we had last year. We improved our margins. We had an expansive margin, and we had 11% EPS growth. So last year we did 6.4% revenue growth, 11% EPS growth, and our margin went up from 15.3 to 15.8. So we kind of ticked all the boxes. This year, we are again starting higher than last year, and we are hoping that we continue on that same trajectory. If you take the comparative group of 10 providers, tier 1 providers, we went in 2022 from being at the 10th spot to the 8th spot to the 6th spot, and now we are in the winner's circle, as we call it, which is the top tier performance. So we want to continue on that journey, and we think as we progress in this year, with the tailwind of 28 large deals, we have done $100 million, 28 large deals. We have done one in Q4. We did a big $1 billion deal. We did 2 $500 million deals. So we think we have the tail velocity as they get to transition and get to production. We're going to see more traction in Q2 and Q3, and it'll help us this year. Now, coming to the macro still remains uncertain. It is, it's dynamic, and we believe discretionary is In pockets, good. For example, in financial services, discretionary is pretty good. We did very well in financial services. We did 9% in Q4. And for the full year, we did 7%. It's our largest vertical, so we feel very excited about it. The second largest vertical is healthcare. We did 6.5% there. So that also is in a good, and both of these are organic because both healthcare and financial services didn't have any contribution from inorganic. So the top two verticals for us overall are in a good trajectory. The rest of the discretionary has not picked up, but the AI spend can trigger a capex cycle, and if it triggers a capex cycle, that will actually trigger a discretionary spend cycle as well. Our opportunity is not just on discretionary. Our opportunity is also around consolidation. Remember, the first swim lane is more consolidation, wallet share swap, and the second swim lane is net new spend. A lot of work is happening in the first, and the second is just taking off. So we're dependent on both. One is consolidation, and the second is new spend cycles.
All right. Thanks a lot for that, sir. And we'll take this, forward itself. In fact, layoff plans in the US, they've hit their highest January total since the global financial crisis, while hiring intentions reached their lowest in the same period. Rima joins in with more on that. Rima.
Thanks so much for that. As you rightly pointed out, January layoffs just hit their highest level since global financial crisis in the US. US employers announced 108,000 plus job cuts just in the month of January, and this is double compared to last year. And if I compare it to December of last year, we're looking at it skyrocketing more than 200%. And this marks the highest January layoff count since 2009 and one of the worst single months since late 2025. The author of the report, this report comes in from Challenger in Grey, and the Challenger's take is, generally, we see a high number of job cuts in the first quarter, but this is a high total for the month of January. It means most of these plans were set at the end of 2025, signaling employers are less than optimistic about the outlook for 2026. And you know what's more alarming? It's not just that 1 lakh plus number in terms of layoffs for January. Hiring intentions also hit an all-time high. Plans are to hire just 5,300 workers. And this is the lowest January total since Challenger began tracking this metric in 2009. Now, where do we see the biggest layoffs? Well, three key companies. One is Amazon, UPS, and Dow. And they've announced sizable cuts. For UPS, the number stood at 30,000 as the company shifted towards high-margin healthcare logistics and away from Amazon delivery. Amazon was the other one, 16,000 job cuts. These were largely corporate roles to remove bureaucracy. And then was Dow Inc. They laid off about 4,500 employees, 13% of the workforce, specifically to implement AI-driven automation. But you know what? Overall, it's not just about AI, despite the narratives. AI-related layoffs were just about 7% of the total cut, 7,624. The dominant drivers were contract losses, what we saw in the case of UPS, general market economic uncertainty, and then old-fashioned restructuring, cost control. Layoffs were also attributed to overhiring, organization flattening the bureaucracy, etc., and not necessarily as an AI replacement. And the sad part is it's not perhaps ended in the month of January, because in February, and this is not a part of the data, but we know in Washington Post, Jeff Bezos has ordered a painful restructuring where he's cut 300 out of the 800 journalists. That's nearly 40% of the newsroom. The metro, sports, book sections were essentially hollowed out. So, this time, I think the take is that it doesn't feel like just disruption. It's also de-risking, because when hiring dries up alongside layoffs, what does it tell you about the confidence in the economy?
Take that point, Rima. Fairly poignant. What we'll do is take a short break, come back on the other side, we'll mull over what Rima said and also get you an update on the bond markets with Manisha Gupta after the RBI policy.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. Shifting focus to the bond markets. Over to Manisha Gupta with more.
Well, RBI has kept policy rates unchanged on expected lines there. And the meanwhile, you have seen a reaction coming from the government bond yields, which have hardened by 4 basis points following the MPC. While the no OMOs have been announced by the RBI, but RBI in its statements did assure that the central bank would remain proactive in its liquidity program and ensure sufficient liquidity in the banking system. It also said that they would meet productive requirements of the economy and facilitate monetary policy transmission therein. Well, RBI also, within its statements, has reiterated what was announced for the bond market in the FY27 budget therein. RBI says that they will issue norms on the corporate bond indices derivatives, and they will operationalize corporate bonds when it comes to bond measures and announced during the budget, that is, and will issue framework total return swap for the corporate bonds therein as well. Interestingly, government also seems to be lining projects worth nearly 31,000 crores therein, funded mainly through its green bond proceeds in FY27. The government is signaling a heightened focus on sustainable financing. So there's various interesting things that seems to be happening around bonds, whether it's about state bonds or corporate bonds, and a new framework is something that this industry seems to be awaiting at this point in time.
Manisha, thank you for that update there. The markets now have recovered almost everything that they lost all through the day. It's been a very, very swift recovery in the final 30 minutes of this trading session, and led by one stock, that is ITC. 5.5% higher now on the stock, continuing to build on to those gains. It's the biggest single day gain that the stock has seen in the last 18 months. The last time the stock had gained this much was back in July of 2024. So very, very swift move seen on ITC after the worst January on record. The stock has delivered in today's trading session. Of course, in line with what Godfrey Phillips has done as well. Godfrey Phillips has seen double-digit gains in today's session. So among the top gainers on the Nifty 500 is Godfrey Phillips. So 12% higher on that stock now. So good going for Godfrey Phillips. What's also doing well is Data Patterns. That's up 7%. LIC is up 7%. Nykaa, after the upgrades that have come in after the results, that's up 6% as well. So a lot of these consumption-oriented names, insurance names, defense stocks led by Data Patterns doing well. And of course, Kotak Mahindra Bank has moved to the highs of the day as well. 3.5% higher on Kotak Mahindra Bank. That too is contributing to the gains on the Nifty. The recovery seen on the index at the highest point of the day is Kotak Mahindra Bank. Take a leave on this edition of A Trading Hour from Mangalam and me. Thank you for watching. Halftime report on the other side.
Hello and welcome to our continuing coverage on the RBI monetary policy, which has decided to leave the repo rate unchanged by a unanimous vote at 5.25%. The stance was unchanged at neutral, but one of the MPC members, Professor Ram Singh, dissented and wanted it to be left at accommodative. That's the action on rates, no action rather. Where the RBI did act is to change some of the macro forecasts. But listen in to that press conference, which is being addressed by top RBI officials after the announcement of the policy.
Swaminathan J, Dr. Poonam Gupta and Shri Shirish Chandra Murmu. We also have with us today Executive Directors Dr. Ajit Ratnakar Joshi, Shri Sanjay Kumar Hansta and Shri Indranil Bhattacharya. I also welcome my other colleagues from the Reserve Bank. Before we begin, we have a few housekeeping announcements. Sir, there are 24 participants from the media. I request the media participants to please stick to one question so that everyone gets a chance. I also request everyone to switch on the mic while speaking so that those watching the live telecast are able to hear clearly. And once you have finished speaking, please switch off the mic. Sir, with your permission, I will now call out the names.
Yes.
Thank you, sir. I will request Ms. Latha Venkatesh from CNBC TV 18 to please ask the first question. Over to you.
Thank you, Mr. Bridge, and thank you, Governor, for the opportunity. The worry is not so much with inflation and GDP, with the numbers in transition. The worry is with the way in which near-term call rate and repo rate have fallen. Call rate and TREPS rate have fallen way below the repo rate. I mean, they're almost a percentage point between 4.25 and 4.75 actually. So what's the thinking behind allowing that kind of a fall? Before, on the 1st of February, the question we would have wanted to ask you is, how will you manage this large borrowing program? The market was rightly worried and yields shot up. So that question as well. The immediate short-term fall in call rate and TREPS rate, is it intentional? What is your view of how it may evolve? And separately, this medium term, how are you going to help it? Will it be OMO in liquids? What's the expectation?
So let me say, as mentioned in the monetary policy statement, liquidity is something that is our duty to provide. Ample liquidity, sufficient liquidity as is required to meet the productive needs of the economy. That is the first task. And the second task, to be able to ensure that monetary policy transmission happens, not only in the overnight markets, in the money markets, in the government security markets, the corporate, the credit markets, all the markets. So whatever we do with regard to liquidity is keeping this overarching goal in mind. Now, the tools that we have for liquidity, you are aware, we have a number of tools for them, especially, OMOs, long-term, short-term, VRRs, VRRs, so as to be able to ensure that we give liquidity and we keep the overnight liquidity at the policy repo rate. That is the immediate target, to keep it over there, and then hope that this will transmit into all other markets. The transmission, you are aware, has been quite good, especially, till December in all markets. After December, there was slight hardening, as I have mentioned. There was some hardening in the money markets, but overall, transmission has been excellent. We will continue, as I mentioned in my statement, that we will continue to provide liquidity proactively and preemptively. This is not something, that the exact details is not something that we always or by rule mention in the policy statement or only, in the policy statement. Liquidity is a continuous operations that is done. So you have seen that we have provided liquidity even outside the policy statement, as we did, in later when we felt that there was a requirement for liquidity in the second half of January. We followed it up with whatever we had announced in the monetary policy statement. We followed it up with liquidity. So all I can say is that we will continue to provide sufficient liquidity with an aim that the monetary policy transmission happens in all markets.
Sorry to intrude, but there is no mention of the word switches or buybacks by you or by the government. So the market is worried in the medium term. Right now it is a little stupid to ask about the liquidity is so plentiful now. But in the medium term, do these things still,
Are you referring to the government program? I think, again, we have been looking at the gross numbers, which I don't think really, is the correct way to look at it, frankly. The way to look at it is, we have been looking at, 17 plus lakh crore or something. But there are, much more redemptions this year, coming year, next year, than, there were last year. So as a result of that, the gross calendar will obviously, be higher. But if you look at the net numbers, 11.53 lakh crore is the number for this year, government securities borrowing program. Next year, it is projected, it is budgeted to be 11.73 lakh crore. It's only 20,000 crore more, which is, one would have expected at least, if the budget size is going up by almost 9% or so, 8 to 9%. GDP is expected to grow at 10%. One would expect a 10% growth. The growth is much less. We should really be looking, at net. Number two, also, you find that this year or in the year to come, there will be money will be raised also through the treasury bills, which will help, in further. I think it will help, in managing the yield curve better. And we also find that the budgeted numbers for small savings are also, quite conservative. So I think, the kind of numbers, the borrowing program that the government is looking is much on the lower side, and they should be able to raise these kind of resources at very reasonable prices. I'll request Mr. Ravi Shankar, to further add onto the switches, some 2.5 lakh crore of switches have also been planned. That will also, further help on the liquidity and the management of the yield curves.
That's right. And buybacks are not factored in at this point in time. They are factored in during the course of the year. To the extent there will be buybacks, the gross borrowing number to that extent come down. I just wanted to, Governor explained all the factors clearly. I just wanted to draw the attention to this sense that the, gross borrowing is large. We should put them in context. Look at 2007-8. We were borrowing 1.9 lakh crores per year. 2 years later, 2.910, we were borrowing 5.8. 3 times the gross borrowing. Was that managed? That was managed. You look at relatively. Look at 2020, 2021. We were borrowing about 7 lakhs. In 2 years' time, we were borrowing 15 lakhs. Right? So these numbers, go up. If you compare to that, the increase is nothing significant at all. I'm certain Reserve Bank will be able to manage the government borrowing program quite efficiently. Thank you.
Thank you, sirs. We will take some more questions from our left side before we come to the right. Next, I'll ask Manojit Saha from Business Standard to ask his question. Manojit, please.
The trade rates have collapsed, which has created some pain for the non-banks. But at the same time, SDF bank parking in SDF has gone up very significantly, over 3 lakhs. Is there a plan to tackle lazy banking? Is there a discussion on whether you can cap how much banks can borrow from SDF, or widening the corridor, bringing SDF down so that banks are forced to lend to productive resources. And consequently, do you think the CD ratio of more than 80%, 81% is a new normal now, given the constraints of deposits that we have seen?
See, we did review the liquidity management framework. Your question is actually linked to, the liquidity management framework that was done recently, and not many changes were announced. Let's keep in mind that this is a complex subject, because these three markets, your TREPs, call money markets, and the repo market, there is very high linkage. We mentioned that when we decided not to change it. In the medium to long term, there is a very high correlation, and so that's why we continue to target the call money rate, which is called the Walker. Over short periods of time, on day-to-day basis, there can be fluctuations. There can be non-alignments. But on the whole, I think as of now, we are not looking at making any changes immediately. However, as you have also pointed out, there can certainly be different ways of looking at it, which we are at the moment, as I mentioned, we are not looking at whether to change the corridor and how to better manage it. As I mentioned, this is complex. We are right now not looking at making any further changes. With regard to your second question on CD rate, see, this is cyclical. At a period when your credit is more than deposits, it's quite expected that the CD rates will go up. And when at times when credit is not growing so much, then the CD ratios will come down. And we have seen this happen over and over again. There is a time when the CD ratios go up, and then there's a time when the CD ratios come down, depending on where we are in the business cycle of the banks. But I may mention that for us, it's not the CD ratio which is important. What is important is liquidity. There is an LCR framework for it. There is an NSFR, net stability funding ratio, which is there for medium-term liquidity. There is an LCR for the immediate or the 1 month liquidity that we are looking at. Both of them for the banks as well as for the non-bank financial companies are at very comfortable levels. So there is no issue over there.
If I could just add one clarification. There was no mention of INR or BOP deficit in the policy. Is it because you are pretty much comfortable with the trade deals and the inflows and all? Is that the reason?
See, our macroeconomic fundamentals of the country, including the external sector, are very strong, very robust, very healthy. Whether you look at growth, inflation, whether you look at the current account on the external side, or you look at even the capital account side, I think near-term, medium-term outlook is very healthy, is very favorable. You are aware that the government has taken a series of measures to increase our external position. Number of bilateral as well as multilateral deals have been signed. EU, EFTA earlier, Oman earlier, UK, and now the prospective UK deal. All of these will help on the top of a very, very comfortable current account that was last year 0.6% of our GDP. First half only 0.8% of the GDP. On top of this, with all these deals, agreements, it should only further help. Not only on the current account, on the trade side, merchandise and services, but also on the investment side, because a lot of them have investment commitments. Like, for example, EFTA, I think, had $100 billion. New Zealand had $20 billion. On top of that, even on the investment side, the government has been very proactive. It has taken a number of measures. See, these are things, first of all, let's keep in mind, these are in the domain of the government. These are not, in our domain. These are in the domain of the government. The regulators are there primarily to facilitate whatever economic activity is going to happen, whether it is domestically or whether it is in the external sector. But I want to remind everyone that the government has been very proactive, both on current account as well as capital account. Latest example, on capital account being opening up of the insurance sector to 100% FDI. That will help. This year, we have witnessed record deals in the banking space and the NBFC space, about $15 billion, of announcements or FDI, already that has come in. And then a number of other measures that now the government is taking. I was very happy to see in the budget the tax holiday, for example, for data centers. That should bring in a lot of investments in our country. Safe harbor rules were in the works for some time. The safe harbor rules now for IT, I would like to draw attention to all of you and to your viewers. I think this has not perhaps gained, the attention that it deserves. It's a very big move towards tax certainty, simplicity, ease of doing business within our country. All these GCCs, that you see are being set up, they will vastly gain from. And these are only some of the measures, that I have mentioned to you. In the near term, in the medium term, we are, as mentioned even in the monetary policy statement, we are very confident of meeting our external sector responsibilities, whether it is on the current account. You are aware, 11 months, we mentioned 11 months of imports. Now, that is imports. If you look at deficit, it is, my DG tells me, one should be looking at the deficits. Deficit is, if it is $10, $20 billion, let us say, so, we have sufficient reserves for many decades, not, 11 months of import, but many decades of deficit. Similarly, our short-term borrowings, debt, twice the reserves of our short-term borrowings, twice. So on the external side, we are very comfortable, and I did make a mention of that in my monetary policy statement. Thank you.
Thank you, sir. I will request Ankur Mishra of ET Now to ask his question. Ankur, please.
Thank you, Bridget, and good afternoon, Governor. I want your attention towards the inflation growth dynamics. On one hand, when you're talking about growth, you have revised your guidance upwards, and you mentioned about the deals as well, which augurs well. But on the inflation front, you are inching over 4% in the next 2 quarters. But you have also given a caveat that precious metals is accounted for that. So in that scenario, last time when you mentioned the same thing, you used the word Goldilocks, the sweet spot scenario. Are we still in the sweet spot, or you think the situation is slightly different?
We are certainly, in the same sweet spot, maybe even better. Because growth is looking up, growth is looking even better, and inflation is the same. Headline, one is looking at headline, 0.1, 0.2%, 20 basis points here and there is a very small number, point number one. Point number two, it is headline. As mentioned in my statement, it is primarily to do with base effects. It is primarily to do with the volatility in the food prices, core inflation, underlying inflation, barring precious metals, is very benign. continues to be benign. So we are in the same position, more or less same position insofar as inflation is concerned. Growth seems to be better than earlier. So we are in a better position than we were, when we met last. Over that, a number of developments have happened. You're all aware, as to the reasons as to why, we are in a better position now today than we were earlier.
Thank you, sir. I will now request Anup Roy of Bloomberg to ask his question. Anup, please.
Thank you, sir. Sir, Reserve Bank of India is selling US Treasury for some time now. In 2 years, the Treasury holding
Who told you this?
So the data shows that it is down 26%.
I don't know where you have got this data from.
US Treasury data.
No, certainly not. There is no such.
So the Treasury holding data there shows that it is now $174 billion, which is...
See, overall, you are aware that our forex reserves had come down. So as a result of that, overall, when they come down, then all holdings would come down, so they will change. So those are fluctuations on a day-to-day or a week-to-week basis that we give out. But there is no reduction in our holdings of the US Treasuries.
So can I ask another question on the rupee? That so when the rupee was depreciating...
Let's keep in mind that there are, so many other people we are taking their time. So if your question is not asked by others, then we will come back to you.
Yeah.
Okay?
Thank you, sir. Next, I will request Hamsini Karthik from Money Control to ask a question. Hamsini, please.
Thank you. Good afternoon, Governor and everyone. My question is with respect to transmission of repo rates. It seems to be that bank lending transmission has happened much more effectively versus on deposits. I agree on deposits we've had transmission, but much of the transmission is at the lower end of deposits. The middle segment, which actually matters to the retail depositors, is continuing to remain high. And as an allied, we also saw CD of India's largest bank being raised at 6%. It does put a lot of cost pressure at a time when repo is being on a pause at this point in time, or has reduced over the last 1 year. What are your thoughts around this? And I have a second question, slightly unrelated, but what caught my attention in your speech is your reference to precious metals this time around. We've also seen that gold loans as a segment has gone up by 86%. Much of it is coming due to the price volatility and not really the tonnage adding up to the growth in the segment. At RBI, are you a little concerned, or would you want to look at, how this does not have societal ramifications? Should there be higher auctions as gold prices correct?
So let me correct you that precious metals did find a mention, if I remember correctly, even in the last policy, not only this policy statement. But on the gold loans, we are very comfortable. There is no, we have been reviewing all the portfolios, whether it is gold loans, whether it is MSMEs, whether it is personal loans, all categories, they show good asset quality, low slippages, and no cause for any concern. The LTV ratios for the gold loans are quite low, although, we have a higher limit, going up to even 85%, 70 to 85%, depending on the amount of loan, but the LTV ratios being maintained by the banks as well as the NBFCs are on the lower side. As to policy transmission, your first question, on deposit size, it is expected that, and that has been the case always, that on the deposits, the policy transmission happens slower, because on the advances side, credit side, we have rates which are linked directly to external benchmarks like the repo and T-bills. So over there it is faster, and in the deposit rates it is slower. So that is to be expected. It has improved, it is improving. from every policy statement, we look at it even more closely. We gave out the numbers to you, policy to policy statement wise, but they have been improving, and we are hopeful that they will further continue to improve.
Cost pressures will ease over time. Is that your estimation, sir, in that case?
Over a period of time, certainly, they will decrease.
Thank you, sir. We will now take a few questions from the right side. I'll request Sangeeta Mehta from the Economic Times to ask a question.
Thank you. Governor, could you elaborate on the policy? You have spoken about empowering customers, the mis-selling policy. You have spoken about a lot of things on mis-selling and the unauthorized compensation for unauthorized transaction. On those things, could you elaborate? And on this compensation, I also wanted to know whether if a person gives OTP, will he still be compensated?
I'm so happy to ask these questions. People have been, busy asking questions on markets. But obviously, there are many people in this room who ask questions directly related to customers. And every policy, and even outside, it has been our conscious effort that we continue to improve customer centricity, the customer experience, the customer delight that all of you, including us as customers, expect from banks, NBFCs, and the regulated entities. So, mis-selling, yes, this has been a concern. We have been mentioning it. There have been directions with regard to mis-selling, and this time, we have codified them. We'll be issuing the draft guidelines with regard to mis-selling. Similarly, there is a framework which we will now be taking out for compensation for small frauds, because we have observed that while in value they constitute a very small proportion, but in terms of numbers, I think 65% of them have less than 50,000 or so in terms of amount.
All right, so that was the Reserve Bank of India, top officials briefing the media. No additional takeaways from that press conference per se so far, other than the fact that the governor reiterated that the immediate target is just to keep the overnight rates at the repo rate and then hope that it transmits to other markets. And liquidity management, which is something that the markets were waiting to hear, the governor said, will happen on a case-to-case basis, as and when there is a requirement. And that's something that the Reserve Bank of India has been doing outside of the policy. Let's invite our guests in, to further decode some of the comments that have come in. We have Ashish Vaidya, who looks at the Treasury at DBS Bank India with us. Ashish, any takeaways, for the bond markets as well? We saw the yields hardening because there wasn't any OMO announcement, far from a CRR cut or even, any mention of the use of liquidity tools, at least in the policy. Of course, RBI will continue to do what is needed outside. And we saw some of the bond yields reacting to that. What were some of your key takeaways? And, what sort of measures do you expect, base case scenario, at least on OMOs from RBI going ahead?
So, hi, thanks for having me here. I think policy was on expected grounds. I think one needs to look at the fact that in the last few or almost last 1 month, because of the continuous injection of liquidity by RBI, the liquidity was really comfortable. The fact is, today we are sitting at a surplus liquidity of almost about 4,60,000 crores, which is very comfortable. And given this kind of liquidity, I think till March, you really don't require a large amount of liquidity in the system. So having said that, I think looking at the stable sort of rates and guidance by RBI, broadly, you're not looking at any further monetary, basically liquidity infusion into the system. And hence, the expectation of OMO sort of goes at the back seat. Unless the stress on the dollar rupee continues over a period of time, we're unlikely to see large OMOs in the system for infusing of liquidity. This actually means that the supply will actually, not be absorbed by the central bank, but it will actually be given in the market. And whatever impact you see in terms of 6-7 basis point move today on the 10-year GSEC is an outcome of that. Having said all this, the fact that RBI Governor mentioned, and which is a truth, which is all the global fixed income markets across the world are facing a lot of headwinds.
Yeah.
And yields are generally trending on a higher bit because of overall inflation expectations going up and the probable expectation of liquidity easing from the US Fed. And you note something which is very distinct in this cycle. The US is probably looking to cut rates, but there are various other central banks that are actually increasing rates to sort of manage the growth inflation dynamics.
Yeah.
So this, I think, will actually result in the fixed income markets being in a little bit of a bearish kind of sentiment over the next 6 to 12 months is what my sense is. And that will take the yields higher. And that's what market has actually started to just price it.
Ashish, very quickly, by March end, what is your expectation of where the 10-year may end?
So my expectation would be somewhere about 695.
695.
Because I continue to see that the global fixed income markets will continue to get sell-offs, but particularly in the longer end. So the shorter end will be well anchored, but the longer end will see some upticks across the globe.
Okay, that is a steep uptick you're talking about. Soumya Kanti Ghosh, the Group Chief Economic Advisor at State Bank of India, is also with us. Mrs. Soumya Kanti, your quick thoughts on the policy. Was it along expected lines? And, what's interesting is you have one of the MPC members that wanted the stance to be changed to accommodative. That's a bit of a surprise, isn't it?
Yeah, thank you, Ritu. I think regarding the policy, I think it was along expected lines. So the market was expecting a status quo, and it happened. And also, it's good that the central bank has said that it will look through the data on inflation and GDP before releasing the final forecast for next year. So I think that was also anticipated. Regarding the rate stance in change, I think that member has been arguing for a change in stance, just to ensure that to give a comfort to the market that even though the global uncertainties, this is my understanding, even though the uncertainties in the global world could actually significantly increase in the second half of the current fiscal, which we are anticipating, the central bank, the only way of the Reserve Bank of India could be to cut on the rates. So I think that is one of the reasons why the stance change was argued. Okay. One thing which I find it very interesting in the statement is that the central bank, the RBI Governor, and I think said very clearly at the beginning of the statement, along with the DG, was the fact on the gross borrowings numbers. In fact, if you look at the gross borrowing numbers, I have the numbers from FY7 till FY27 in front of me. In FY7, the overall gross borrowing was 1.9 trillion.
Yes.
Today, this number is at 17.2 trillion. And the net borrowing was around 1.5 trillion in 2008. It has moved to 11.7 today. So I think if you look into the corresponding yield movements also, which are also in front of me, I think the yields at that point of time in FY7, it was actually at 7.8%. And today the yield is actually at 6.7%. Yeah. So my sense is that even with a 5 to 6 times jump in the overall gross borrowing, I think from 2 it has moved to around 18, so around I think 7-8 times jump, the yield actually have declined. So I think this market appetite will keep on increasing. So I don't see any reason why the Reserve Bank will not be able to manage the borrowing. It has managed it very successfully during COVID times. I think India has borrowed at the lowest rate. And the second important thing is that in the statement, which he made a clear statement that the RBI monetary, the liquidity injection will be preemptive. Yeah. And one point which he mentioned was that it will also take into account the unpredictability of the government cash balances, which I think is which has been the elephant in the room. So I don't see any reason why liquidity management will be reactive. It will be continuing to be preemptive and proactive. And the statement which the DG and the governor made in the press conference, which I can understand, is that was a clear the sense of purpose in terms of not being comfortable with the current yield levels. And that's why it was clearly said that the domestic yields are actually tracking the global yields. You can't manage all the global uncertainty. But I don't see any. And also he talked about the buyback, which I think is a point we have been also mentioning from day one, that last year also there was a 90,000 crore buyback. I don't know why the markets don't understand the buybacks don't happen in the budget. They happen outside the budget. And over a point of time, the 17.2 trillion, I can tell you, will come down to around 16.3 trillion or 2, given the RBI holding of papers. So I'm not concerned about the budgeted borrowing numbers. What I'm concerned, of course, is the yield movements, given that there is a significant amount of global uncertainties.
You know, Mr. Ghosh, but if the markets were that comfortable that the 17.2 lakh crore borrowing figure is not going to be issued, there will be buybacks, and also the net borrowing figure is similar. The reaction in the bond yields has not been as much as we've seen in the past years. And now the RBI is saying it is going to address friction points, whether that is government cash balances or even account for the fact that there will be forex interventions. Why is it that we're not seeing bond yields react accordingly?
No, I think, markets always move ahead of times. I think there has been, the central bank also has said in the past that OMO, if you remember, it was said that the yield curve is a public good, and the central bank also said that it is more concerned about liquidity management. So, and at the end of the day, the OMOs or liquidity management is always the cause, and the yields movements are an effect. So maybe the central bank has emphasized more on the cause in the last couple of policy, and not talked about the yield specifically. So now that they are trying to address the yields in terms of in terms of managing it, maybe the markets will react with a lag. But of course, there are concerns in the market, the 17.2 trillion, and of course the concerns, which are basically, I think the concerns in the market are also during the SDL. The good thing is that I think, and that actually is an outside, that the discussion which could happen outside separately, is that the Finance Commission has actually recommended a lot of regulatory steps for the SDL market. So I think over a point of time, I think these things, once it settles in, will clear the nerves in the market. But as of now, with borrowing numbers of around close to 29 to 30 trillion gross borrowing numbers, even though the central bank will be able to manage it successfully given the past 1.5 decades record, I think the markets are a little bit apprehensive. So that's why yields are moving up. My sense is that, and this yield movement is also, I will not blame the markets fully, because it's also tracking the global uncertainties. You know that how the metal prices have been behaving in the last 7 to 10 days. Complete volatility and flip-flop movement. On the US dollar also, it was declining. Now it is going up. And there is no belief that it will continue to decline. It may even start to, I think, depreciate. So overall, it's a complete hodgepodge situation. And I don't see yields stabilizing significantly immediately if I track all these developments in one go.
Well, let's hope the participants are paying attention to what you're saying, Mr. Ghosh, and we see some softening from here on. Pranjal Bhandari, Chief India Economist at HSBC, also joins us now. Pranjal, hi, thanks for being here. Start quickly with giving us some of the key observations you've made out of what has come out of the RBI policy, and whether your read is with the kind of forecast that we have, we're in for an extended pause from here on.
Yeah, I do think it's an important policy because it gives a clear pivot that RBI is going to be steady on rates from here. So far it's been playing like a T20 match, but I think going forward it's going to play more like a test match model in which it is not the primary baton holder of growth. And I think he made it very clear, the governor also in the press conference made it very clear, that the growth baton in a way has been passed on to the government, not only because everything that they announced in the budget, and you can see that the fiscal consolidation in the budget is much lower than before, so there'll be more growth positive going ahead, but also because of all the trade deals and over time that will add to growth. So RBI does not have to be the big stimulator of growth at this point of time, the way it has been over the last year. So I think this is a very important policy from that perspective, that it's going to be steady monetary policy from here. And in a way, the fact that they increased their growth and inflation forecasts even before the new data has come, they could have said that, no, we'll do it all together in April. Even before the new data has come, I think also gives an indication that they want to give this very clear signal to markets that at least in terms of rates, they want to sort of be steady from here onwards. But having said all of that, I won't call this hawkish in any way. I think every time the governor was telling us something like inflation forecast is higher, he was also giving you the rider that it's only because of precious metals. And one thing which a lot of people haven't noticed is that one MPC member, Ram Singh, is still calling for a change in stance from neutral to accommodative. So overall, I would say steady from here. Bond markets might think of this as a little hawkish. It always happens when somebody is raising inflation and growth forecast. I won't call it hawkish, but I would say just steady from here.
Okay, not hawkish, steady from here. Ashish, quickly to wrap up with you, what's your expectation? Extended pause, steady from here. And of course, we noted that one of the MPC members did call for a change in stance to accommodative, but that's what Mr. Soumya Kanti Ghosh pointed out has been his stated view.
No, so I agree with almost everybody else on this panel. Plus, so basically extended pause for quite some time. Having said that, the global volatility, I'll sort of reiterate, will actually play its own role in terms of managing the market cap of debt across the world. So right now, the debt across the world is almost 400 trillion, and you see what happened in the metals market. The margins were actually some other securities, the value of which fell, and that created all sorts of liquidity turbulence. It's very important how the underlying actually behaves, which are actually used as margin, and that could trigger a liquidity squeeze across the world is what I'm really fearing from an overall global macroeconomic standpoint. But let's see, because eventually if the market caps of, say, the equity markets or the debt markets actually come off, it will lead to a liquidity squeeze event. And that is where I'm saying the markets, the fixed income markets across the world are preparing for a sort of a slight shock. And that's where the yields you've seen it actually sort of moving north and rising.
All right. Thanks very much, Ashish, Mr. Soumya Kanti Ghosh, Pranjal Bhandari, for being here with us to help analyze that RBI monetary policy. On that note, we have to slip into a short break, but don't go anywhere. The news and updates will continue right here on CNBC TV 18.
and welcome to Halftime Report. I'm Ekta Batra and with me is Sonal as well as Vinny. Well, it is turning out to be a dull day for the markets. We have had the FIIs sell or come back to the selling table in terms of the equities at this point in time. But for the markets post the RBI policy, we have the Bank Nifty, which is down around 269 odd points. And for the Nifty, yes, we've recovered from the day's low, but on an absolute basis, we're still down around 100 odd points for the Nifty, and the mid-cap index is down around 0.7%. So dull day. Let's see whether there's any kind of respite in the second half of the trading session. The RBI has kept the rates unchanged this time. Hi, Golds.
Hi, afternoon. So yes, decision of the RBI, that's what everyone was watching out for. We had that come and we heard the presser as well. But in terms of the moves today for the market, like you said, very muted day. Advance decline ratio, that's clearly in the favor of declines today versus advances. So let's see where that's going to be headed in the second half of the day. But as of now, a wide gap that has continued through the trading session so far. Which sectors are managing to hold on to some bit of a green? We have FMCG. Look at that. Nifty FMCG is the top sectoral gainer. It's up 1.6% in the trading session. Apart from that, everything is actually trading in the red. IT continues to be the top sectoral loser. The pressure is continuing on the IT bank. We have PSU banks, that's down as well. Autos not doing well. Pharma also among the top sectoral losers. And talking about pharma, we have Jubilant Pharma also, which has reported their numbers. As of now, the stock is down 4%. We'll wait out for more internals there. But revenue
has been very subdued as compared to what the revenue has done. Revenue is in double digits, but look at the way the margins have crashed this time for them. So 13.6 versus 15.4%. That's primarily possibly the reason why the stock is down 4% and the net profit down 44%.
Okay, take that point. Earnings will keep coming in. But guys, I don't know about you. I'm going to really enjoy the weekend because it's going to be a weekend after a long time, clearly. It's been a busy week. And RBI announcements, that is something that we are analyzing. They've allowed banks to lend to REITs as well. The aim is to broaden the credit access for this particular sector. Ramesh Nair, the MD and CEO of Mindspace REIT, Business Parks REIT, is joining in to understand what this would mean. There was some update in the budget as well. Ramesh, good afternoon. Thank you so much for joining in. Well, to promote this financing in real estate sector, it is brought at par with InvITs. Earlier, banks could lend to InvITs, now to REITs as well. Can you tell us how does this change things for the sector? How was funding done for REITs earlier? Does it change your cost of capital? Give us more sense about this change.
So this announcement definitely will improve credit flow, definitely increases financial stability. Also, from a diversification of financing point of view, with this, the REITs get access to long-term funding at the REIT level. Banks can create 10-year plus instruments. Also, that's long-term. Short-term also, there could be improved capital kind of new things applicable for REITs. One thing to be noted here, Ekta, Vinny and Sonal, is this is third big reform which the government has announced this year. So a few months back, the equity classification. After that came the pension investment equity classification as well as sponsor rating decision. And now today the RBI lending decision. So previously banks could lend to the SPVs, not directly to the REITs. Obviously, we need to look out for the fine print which comes out to look at what exactly is going to be the interest rate impact. But overall, a very welcome move which the REIT industry has been asking the government for the last 2-3 years.
Okay, take that. Just follow up on that, Ramesh. You spoke about the fine print that is required right now. What is the current cost of capital that you have, and where all are you getting this funding from? I'm assuming it's corporate bonds and debt level financing that's happening.
So the current cost of funding in the last 9 months has definitely come down thanks to the interest rates drop. Our cost of funding was around 8.1% last March, which last quarter came down to 7.5, which this quarter has come down to 7.39. So we've definitely been beneficiaries of a lower interest rate environment. So and 74% of our debt currently is fixed. A year back, that used to be around 50%. And the balance is variable. When it's the 74% which is fixed is typically NCDs, while the bank is the balance which we get.
Ramesh, what does this mean in terms of incremental acquisitions for Mindspace?
So acquisitions, obviously all these kind of new funding mechanisms will give us better of capital, which will help us do even more acquisitions more aggressively.
Ramesh, like you mentioned, a lot of announcements have come in for REITs. And in the budget also, they spoke about the proposal to recycle assets of PSEs through REITs. What does the fine print say for this? How much will this help the market? And will there be a capital support also from the government for this?
Definitely. On the budget day, that is a very important announcement again, which the government made. There will be, the government has done it for national highways. We're looking at other government assets on the infrastructure side. So from a real estate side, this announcement from, which is Central Public Sector Enterprises, this will again definitely help the REIT industry.
Okay, all right, Ramesh, thank you so much for joining in today. Always a pleasure speaking with you. So that's the word coming in from Mindspace Business Parks REIT. It gives more venues for financing REITs, and earlier it was done at SPV level. Now it can be given directly to REITs. That's the word coming in from the CEO. We'll slip into a short break. When we come back, we'll get you more on the markets and stock-specific action on the other side. Stay tuned for that.
Welcome back to Halftime Report on CNBC TV 18. MRF has reported its numbers right now, and the stock has seen a very sharp spike up. Net profits, 691 crores versus 316, so almost doubling in terms of net profits over there. We're waiting out for more numbers that will come in. But as of now, a sharp spike up is what's come in the stock price as of now. Look at it. Day's highest point, that spike there after the numbers. We'll watch out for that. But other than that, we have, Godfrey Phillips. Then we have ITC. These are moving around in the trading session today. They too are choked up in trade. Apart from that, Hitachi Energy. Look at that. That reported its numbers. Strong set of numbers that's coming from the company. And that too is among the top gainers of the Nifty 500. Concord Biotech also, as well as LIC, is something that should be on your radar. But MRF as of now, good growth in terms of revenue as well, 15% growth there. Profits also seeing double YOY. But that's all the time we have on this edition of Halftime Report. Thank you so much for tuning in. Up next, a business lunch to take you through all the market action.
Stocks slide further. Mid-caps are bearing the brunt as declines are outnumbering the advances by a significant number. Healthcare and PSU banks continue to be the big drags even as FMCG and utilities eke out gains.
A stronger than expected show by Airtel Africa boosts Bharti Airtel's Q3 performance, but Tata Motors passenger vehicles Q3 is marred by the disruption at JLR following a cyber attack.
The stellar quarter from Nykaa, revenues growing above 20% for the 13th straight quarter, margins at the highest ever. The beauty segment is the key driver, but losses in fashion has also narrowed.
RBI keeps interest rates and its stance unchanged, but ups its expectations for GDP growth and inflation in the first half of FY27. The central bank also eases credit to MSMEs, allows bank lending to REITs, and pledges safeguards and compensation for digital transactions.
And silver slumps to nearly $64 an ounce, wiping out over 40% of its value from the peak before staging a bit of a recovery. Gold prices also take a knock, but the other big sell-off is seen in cryptocurrencies, with Bitcoin halving from its peak in October. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV18 Motilal Oswal studios for the final time in what has been a never-ending week. I'm Hormaz Patakia, with me Arundhati Ramanan. Arundhati, good afternoon.
Good afternoon, Hormaz. I'm celebrating it's Friday, but you know, the monetary policy has come in. Rates have been unchanged, stance unchanged, but the markets all in the red.
The markets are in the red, and it's, well, if you are an optimist, you would say that you are better off than what you were at the start of the session. And especially considering what the US futures were doing earlier in the day, they have been extremely volatile as well. The recovery that came in at noon has been sold into, and the banks are the ones that are doing that. ITC, of course, trying to hold fort at one end. Of course, that too has come off slightly from the highs of the day. And it's seeing a bit of a recovery as well. So holding on to gains of around 5% is ITC. But the others, the banks, are the ones that you need to talk about. But 25,540 is where the index currently stands. It's very close to that psychological support of 25,500. Of course, we'll end the week higher, but the bulls will be disappointed, especially because you are now, around 800 points off Wednesday's high.
Absolutely. And, you know, just to point out, Hormaz, it's like a two-way market, right? We've got the FMCG stocks that are supporting on the upside. We've got ITC that's gaining 5%. We've got, HUL as well, which is also gaining in trade. But on the downside, we've got all of those IT stocks, right? There's no respite for them. The index still in the red, 1.8% lower. Persistent Systems, Coforge, LTI Mindtree, all falling between 2 and 3%. The top story this evening, the Reserve Bank of India's Monetary Policy Committee has decided to keep the repo rate unchanged at 5.25%. The RBI also revised the expectations on GDP growth and inflation going ahead. Take a look.
The revised outlook for CPI inflation in Q1 and Q2 of next year at 4% and 4.2%, respectively, revised slightly upwards, continues to be benign and near the inflation target. The Indian economy continues on a steady improving trajectory, with real GDP poised to register significant higher growth of 7.4% this year as compared to the previous year. Amidst global headwinds, private consumption and fixed investment both supported growth. Net external demand, however, remained a drag, with imports outpacing exports. On the supply side, growth in real GVA on the back of a strong contribution from the services sector and revival in manufacturing activity is estimated at 7.3% this year. Going forward, economic activity is expected to hold up well in the next year.
That was policy, but the one stock that was contributing to the Nifty recovery, still holding on to gains, is ITC. And along with ITC, Godfrey Phillips has also zoomed higher. And Godfrey Phillips, in fact, is seeing double-digit gains. It's up almost 11%. And that higher-priced cigarette packets have now been introduced, is what sources are telling us. Manglam is here with more on this. Manglam.
Well, ITC is the top Nifty gainer, and Godfrey Phillips too is gaining in double digits, as we understand that, the higher price cigarette packs have now been introduced in the market. Remember, on Jan 1 itself, when there was a government notification that came in of 40% GST and substantially higher excise duty on tobacco with effect from Feb 1st, had these stocks under pressure all of January. The street was, expecting a price hike to the tune of around 15 to 30%, in some cases even 40% to come by for the companies to mitigate the impact of this higher tax. However, the street was awaiting any sort of clarity that came by post-budget as well, and there were no tweaks. So which is why now the companies have gone ahead and introduced these higher priced variants to their supply chain. In fact, I was, accessing some of the products coming in from a few of the companies. So Godfrey's 97mm pack now is at 300 rupees versus 240 rupees a pack. 25% hike is what it is. And CNBC TV18 has reached out to the companies as well. We are awaiting their detailed response on the quantum, the nature and the structure of the price hike. But the price hikes have been taken. These stocks are flying on the back of that. Though, two important things to note. Will there be a volume hit because of these higher prices? And do these higher prices cover the entire extent of the tax hike or not? Because if they don't, then there could be a margin hit to these companies' next few quarters' earnings as well.
All right, Mangalam, many thanks for those details. Now, a lot of stocks are buzzing on the back of their third quarter numbers. Ria is here with all of those details. Ria?
Well, yes, let's start off with data patterns first. The revenue has gone up by roughly 48% on a year-on-year basis to 173 crores, and this is versus an estimate of 32% growth. Margins have also come in very strong at 46.5% versus estimates of 38%. So a good performance overall for the company. Hitachi Energy as well reporting a good set of numbers. Revenue has gone up by roughly 28.5% compared to the previous year. Margins have also expanded quite significantly, coming in at 16.6% versus just 10.3% in Q3 of last year. For Nykaa, they have reported a net profit of roughly 66 crores this time around versus just 26 crores in Q3 of last year. So there's a big jump on the net profit front. Revenue has also increased by roughly 27% compared to the previous year. For Astral, the net profit has gone down by roughly 5.5%, but revenue has seen a fair amount of growth at 10.3% compared to the previous year. Volumes in the plumbing business have also seen healthy growth at 16.8%. For NCC, the net profit has declined by almost 37% compared to the previous year. Even the revenue has gone down by 9%, and in fact the company has also withdrawn its revenue and margin guidance for the full year FY26, and the stock is taking a hit in today's trading session on the back of that. For Mazgaon Dock, net profit has gone up by roughly 9% on a year-on-year basis. Revenue has also seen healthy growth of roughly 15% compared to the previous year. For Kaynes Technology, net profit has come in well below estimates at 77 crores. Revenue also below estimates at 804 crores, and the FY26 revenue guidance has also been cut to roughly 4,100 crores from the earlier guidance of 4,400 crores, and the stock is resultantly down in trade today. Physicswala has also reported its Q3 numbers, net profit going up by roughly 10% on a year-on-year basis, and the revenue has also seen an increase of almost 34%.
Ria, thank you for that update. There are a couple of more stocks just before we take that break. Two divergent moves. One of them is Jubilant Pharmova. Numbers came out just a few minutes ago. That stock is down after the numbers were out. And the other one being MRF. And that, Jubilant Pharmova has actually recovered from the lows of the day. You get more details on this in just a bit. But look at MRF. That stock has zoomed ahead now, 7% higher on the stock. In fact, 8% higher. And after a very, very strong operating performance in the quarter, EBITDA was up 68% from last year. Margins have expanded to 17% as well, and good going for MRF. Take a short break, but just as we do that, here's a quick sneak peek into the stocks that we will be addressing on your stocks in just a few minutes from now today, where you will get fundamental and technical experts giving you advice on the most talked about name this time around, Kaynes Technologies. Of course, you'll have views on Delivery, Tata Tech, Cyient, DLM, and a lot others just in a few minutes from now, starting 2 p.m. only on CNBC TV 18.
Fly Emirates, fly better.
Welcome back. You're still with us on Business Lunch. Sources tell CNBC TV 18 that the India-US trade deal is unlikely to have any adverse impact on India's farm sector. Abhimanyu joins us now for more on this. Abhimanyu?
Government sources have indicated that the India-US trade deal will not have any adverse impact on Indian farmers since several commodities have been excluded from the ambit of the deal, which include wheat, rice, soya, corn, sugar and dairy. Also, government sources had indicated that India has committed to buying items from the US which are already imported from other nations, and India imports products like oil, gas, aircraft, laptops, smartphones and goods for data centers. India currently imports around $300 billion worth of products annually, which will now be sourced from the US as well. India expects to hit $500 billion worth of imports from the US in the next 5 years. It remains to be seen how early this growth is going to be achieved. Also, the Commerce Ministry has indicated that the first tranche of the BTA between both the sides is already ready, and they are hoping to sign a joint statement in the next few days. Also, a formal agreement is being drafted, which will be signed by the mid of March possibly. It has been indicated by the Commerce Ministry that tariff reduction from the American side would take place, would be undertaken via an executive order once the joint statement is signed, whereas India's MFN tariffs, which currently apply to several American products which are imported into India, they would be reduced only when the legal agreement is signed. It remains to be seen how early all these processes are going to take place and how early the deal is going to take shape.
Abhimanyu, thank you for that update there. Take a short break. On the other side, the US job cuts surged the highest level in January on record. More on this after this break. Welcome back. Now, the layoff plans in the US hit their highest in January for any January month since the global financial crisis, while hiring intentions reached their lowest since the same period. Rima is here to tell us more on this. Rima.
January layoffs just hit their highest level since global financial crisis in the US. US employers announced 108,000 plus job cuts just in the month of January, and this is double compared to last year. And if I compare it to December of last year, we're looking at it skyrocketing more than 200%. And this marks the highest January layoff count since 2009 and one of the worst single months since late 2025. The author of the report, this report comes in from Challenger in Grey. Andy, Challenger's take is, generally, we see a high number of job cuts in the first quarter, but this is a high total for the month of January. It means most of these plans were set at the end of 2025, signaling employers are less than optimistic about the outlook for 2026. And you know what's more alarming? It's not just that 1 lakh plus number in terms of layoffs for January. Hiring intentions also hit an all-time high. Plans are to hire just 5,300 workers. And this is the lowest January total since Challenger began tracking this metric in 2009. Now, where do we see the biggest layoffs? Well, 3 key companies. One is Amazon, UPS, and Dow. And they've announced sizable cuts. For UPS, the number stood at 30,000 as the company shifted towards high-margin healthcare logistics and away from Amazon delivery. Amazon was the other one, 16,000 job cuts. These were largely corporate roles to remove bureaucracy. And then was Dow Inc. They laid off about 4,500 employees, 13% of the workforce, specifically to implement AI-driven automation. But you know what? Overall, it's not just about AI, despite the narratives. AI-related layoffs were just about 7% of the total cut, 7,624. The dominant drivers were contract losses, what we saw in the case of UPS, general market economic uncertainty, and then old-fashioned restructuring, cost control. Layoffs were also attributed to overhiring, organization flattening the bureaucracy, etc., and not necessarily as an AI replacement. And the sad part is it's not perhaps ended in the month of January, because in February, and this is not a part of the data, but we know in Washington Post, Jeff Bezos has ordered a painful restructuring where he's cut 300 out of the 800 journalists. That's nearly 40% of the newsroom. The metro, sports, book sections were essentially hollowed out. So, you know, this time, I think the take is that it doesn't feel like just disruption. It's also de-risking, because when hiring dries up alongside layoffs, what does it tell you about the confidence in the economy?
All right, Rima, thank you so much for those details. Now, earlier today, we spoke to Ajay Srivastava, the managing director of Dimensions Corporate Finance Services, on the tech sell-off globally and how that can impact IT stocks. Srivastava criticized Indian IT companies for their lack of investment in AI and spoke about how that could negatively affect the sector. Take a look.
The Indian IT management should be sacked. They have been negligent. They have been like a bureaucrat. They have made money for themselves and given dividends and this thing and invested nothing. Zero. Look at the investment done by Infosys, TCS, Wipro and all is zilch. Look at the dividend they gave to the shareholders and look at TCS. Just think about it. You're an investor. TCS is giving out dividends so the Tata Group can put money in an airline. Just think about it. You could not find reason to invest in TCS, in technology, and gave money out of dividend to invest in airline. Is that something sensible, anybody? So I think we have brought it on our own self. That's the only thing I can say. Nothing global has done to us. We could have done what Anthropic has done. We could have been part of Perplexity. We could have done many other things that's happening in the world. We could have been the front end of AI. They had the money. They had the money in the bank. Zero borrowing. But what did they do? So it's not about IT environment. It's the management of Indian IT companies, which I think is squarely responsible for putting India into such a difficult position.
Candid as always, Ajay Srivastava. We take a leave on this edition of Business Lunch. Just before we do that, don't lose sight of the currency. Even as the markets are recovering, the rupee has now slumped to the lowest point of the day. From Arundhati and me, thank you for watching. Midcap Radar on the other side.
You want to talk business? Meet me in the On Board Lounge.
Good afternoon. Welcome to Midcap Radar live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Vivek Iyer. Another down day for the markets. It's a 200-point cut on the Nifty that we are working with. Below that 25,600 mark, mid-caps again are sulking and underperforming the benchmarks. That continues to be the story, the underperformance that happens in the broader market.
That's right, and it's the last session in a 6-day long week, so that's also something another.
We're rejoicing that.
So it's been a very event-heavy week, and markets after multiple up days where we actually saw the Nifty move higher significantly post the trade deal announcement has actually grinded down lower. But a lot lined up on the show, some important corporate conversations. So let's start off with the top headlines. Stocks recover from the day's low but trade flat. Mid-caps bear the brunt of the selling. IT and PSU banks are the big drags, even as FMCG and utilities eke out gains.
Hitachi Energy shares surge over 13% in trade following the Q3 numbers. Company's margin improved 600 basis points during the quarter. Management tells CNBC TV 18 they are maintaining their double-digit operational EBITDA guidance.
Nykaa shares rally over 6% after delivering an over 20% revenue growth for the 13th straight quarter. Nomura upgrades the stock to a buy rating and believes that the stock remains attractive at current valuations.
Shares of housing finance company Aavas Financiers slipped nearly 6% in trade following its Q3 results. The company cut its full-year AUM guidance from 18% to 15%.
Kaynes Technology shares decline as the management cuts its full-year revenue guidance. Speaking to CNBC TV 18 earlier today, the management said that the full-year revenue guidance has been cut to 4,100 crore from 4,400 crore rupees earlier.
All right, those are the top headlines that we are tracking. Let's talk about some movers. While broader markets are lower, there are select stocks which are surging in trade on the upside. Goodyear is one of them, up 8.5% as we speak. We did have MRF's numbers posted just a while back. That stock also surged on the back of those numbers. That stock should also come up for you on the screen. It's 8.5% higher after a good set of numbers. So the reactions have been on extremes as well. We do have Nykaa. We just spoke about it, up 6%. Mahanagar Gas is the other one. Embassy Developments, that is one name which has been surging after falling almost 60% from its 52-week high. So that stock should also come up for you on the screen. A lot of these tire stocks are doing well today, post MRF's numbers, be it Goodyear, be it CEAT, and MRF, of course. Now,
MRF came out with a good set of numbers. Apollo Tyres were an operational beat. CEAT 2 was a good set of numbers. But the meme doing the rounds with MRF has been the very small dividend that the company has given. So MRF has given a 3 rupee dividend, but of course, operationally, very strong set of numbers, over 8.5% higher. You did mention, Nykaa, but look at some of the consumer discretionary names today. Our colleague Mangalam, just told us about how some of the cigarette companies had gone ahead and hiked prices or are looking to hike prices. On the back of that, have a look at ITC, up almost 5% after the steep fall it's seen since the start of the year. Godfrey Phillips, as our director shows, up 10% today, bounce back seen as far as Trent is concerned, and United Breweries Sue doing a little bit of recovery after the kind of recent sell-off that is seen. From the telecom pack, we did speak about Bharti Airtel, but have a look at Bharti Hexacom too. On good volumes, that particular stock has rebounded quite sharply. ARPUs for Bharti Hexacom at almost 253 rupees. That particular stock high up almost 5%. Hitachi Energy, we spoke about it earlier, but look at the kind of margin expansion the company delivered, 600 basis points expansion and very strong commentary, when the management joined us earlier today, 12.5% over 21,000 after the worries that the street saw, especially regarding Chinese competition. On the other hand, Page Industries has cooled off a little bit. Volume growth or something that the street didn't like. Poly Medicure, another name from the broad end of the markets, that particular stock, margin slipped sharply on a year-on-year basis. So that particular stock too fell off. But one stock doing very well today is LIC. This is following the Q3 results. The insurer's retail AP grew 61% during the quarter, while its VNB margin expanded too. Our colleague Yash spoke to the management of LIC on their Q3. Let's listen in.
I have been repeatedly maintaining the stance that we don't give guidances, but still, we are looking at a continuous improvement on our performance. So the two areas which we have been focusing from IPO days is on the product mix as well as on the channel mix. On both we have shown a considerable improvement in the current year over the previous years also. Our share of non-par has also gone up, as well as our share from bank assurance has also gone up this time. So the product mix has certainly helped in improving our VNB margins. And I expect that to continue a bit more. You talked about the 9 months period of 18.8% VNB margin, whereas in the Q3 alone, we have shown a margin of around 21% plus. So we expect this improvement in margins to happen in the next quarter also, and we end up, there will be some improvement over the current numbers when we close the current year for March.
Okay. Some color in terms of if you've shaped a product mix in a certain way, and you expect your AP growth to be certainly higher in that sense. The VNB outcome?
No, the APE growth is something which we have been continuously focusing. The share increase has been a focus from the IPO time till now, and we have reached 36.8% as of now. If you find from Q2 to Q3, there has not been a big variation. So we think we are consolidating at this range. Though there can be some more improvement, but not a very big improvement in the share percentage. But VNB margin improvement is something which we have been continuously focusing on. We have been rationalizing our expense ratio also.
Correct.
So we'll expect some more improvement in VNB margins.
Okay. So VNB margins, I think the last conversation that we had, you had said that, we expect to do better than what we did last year. Last year, if I'm not wrong, it was about 17.8% on the VNB margin side. For the first 9 months, you've done about 18.8%. 100 basis points improvement, at least, from as compared to the last full financial year. Where do you see this ending for the full financial year?
As I told you, there cannot be too much of an increase in a quarter, but we'll be continuously focusing on improvement in the VNB margins. I expect it to go up a bit more. So certainly, in the last quarter, we have done 21%. So if we have something around that for the current quarter, the overall for the year numbers will go up from wherever it is now. It will be certainly improving, and there will be some improvement. I don't want to exactly quantify it.
So I'm assuming about, even if you do the same thing that you've done in quarter 2, in quarter 4 as well, the overall yearly VNB margins would go to about 19.5%. Is that a fair?
You can draw your inferences, but we are expecting it to be improved over the last year as well as the current quarter. That's
okay. Okay. One thing that I want to understand with respect to GST impact, now the street seems to be asking a couple of questions. With respect to GST impact, despite the half of your book being on the group side where there is no impact, the current number which has come on the GST side seems to be on the higher side, is what the street seems to be a little worried about. How would you put that into context? Why is it high despite half of 50% of the book being on the group side where there is no impact?
See, there are 2-3 things. One, on the group side, we literally have very little commission. So the group is mostly direct. And the individual has got the intermediation involved. So you cannot exactly take it as 50-50%. We are continuously analyzing it. The current estimate that we have done is the number that you are talking about. We expect it to be rationalized, or it will get into an optimum kind of a thing as we go along and we do the complete analysis for the entire financial year.
Okay. And how much do you see in terms of rationalization on the GST impact also? As you said, you're constantly analyzing it.
No, it's a continuous effort. It has been just a quarter, so we have to arrive at what exactly is the exact amount of reversal that is going to happen. So initially, based on the initial reaction, this is the number that we have talked about, but a complete analysis will be happening before the year end, and we'll be able to arrive at the correct figures. It may be I don't see too much of an improvement, but there will be some improvement on that aspect as well.
Okay. Another thing that I want to understand on the VNB margin and the variance there, as far as the operating assumptions are concerned, on the VNB walk side, there has been a cut of about 280 basis points, whereas on the economic assumption, there has been an increase of about 190 basis points. Now, the street seems to be worried that it is the benefit of yield curve which is sort of offsetting the damage which came from the operating variance side. That happened, and it's a big variance in terms of the difference that has been put. Is there a fear of that being repeated again? Because this is, of course, from the previous year, but is there a risk of it happening again in terms of the large number of variants?
We are trying to rationalize the expense ratio. See, the operational part consists of expenses and also the assumptions on the withdrawals as well as on the other expenses that are going into that. So we have been continuously working on rationalizing our expenses, which has been quite visible over the last few quarters. This quarter, this input tax credit not being available has put some strain, which we are very confident that will get rationalized and also which will get absorbed on the overall reduction in expenses that we are continuously focusing on. So I feel that going forward there will be improvement on this area as well.
Okay, all right, that's the word coming from LIC. With that, we'll step into a short break. When we come back, we'll be joined by the management of Godrej Properties on the other side. Stay tuned for that conversation.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. Let's get to another corporate conversation now. Gaurav Pandey, MD and CEO of Godrej Properties, is joining us now. They reported a strong Q3 in terms of bookings and collections as well. Gaurav, good afternoon. Thank you so much for joining in. Strong bookings in Q3 and 9 months. Will this trend sustain? What was the contribution from sustained sales this time?
We've had quite a stellar performances across markets, whether it is South India for that matter. We've had very good performance across projects. In North also, we had a lot of projects, a mix of both launches and sustenance, and also in markets like Pune and the likes of it. From a launch and sustenance, generally, if you see for the last few quarters, a rule of thumb has been between 1/3 of our volume to maybe sometimes half of the sales is sustenance, and it's largely emanating because we have a very different structure in Godrej Properties where we have a dedicated sustenance sales engine which kind of delivers consistent sales performance, whereas as and when we get launches, the launch percentage tends to become slightly better.
Gaurav, in that case, how does the launch pipeline look like and how will you fund the upcoming launches?
We are, because of the fantastic BD effort by our business development team of the last 3 odd years, we've added about lakh crore plus inventory from say FY23. So we have something like 1,35,000 crores worth of inventory available. So a lot of action packed up, some of which we'll see action in this quarter itself, and some of which we'll see action continued next financial year. I'll maybe mention some of the top of mind names that come to my mind, which are in this quarter, and their phase activations will continue next year, as well as some launches that can happen to next year as well. So maybe a bit of a gist. In North, we will see something very exciting in this quarter actually itself, which is a project by the name of Godrej Arden. It's in a Sigma sector of Greater Noida market. Then we have a residential pocket in Godrej Golf Links, a new opening that will open up. It should hit within this quarter. It could also move to next quarter, but high probability within this quarter as well. Then we have a very exciting launch in Gurgaon, a 7.5 acres parcel, a fresh parcel in Golf Course Road market. It's probably a best parcel in Golf Course Road market that will open up very soon. Then in markets like South, we bought a series of acquisitions, some older and some new. So we'll have something in Banagata coming up very soon. We will have quite a few launches in Whitefield and Sajapur micro market. We bought recently, if you would have noticed, last quarter 30-acre parcel in a micro market, Kada Agra. And this is like a 3,500 crores potential booking value. That should hit the market next financial year. And then we bought something in Hyderabad recently in auction, a prime piece of land of 5 acres with a potential booking value of 4,500 crores. That should hit the market also next financial year. In Mumbai, we have a series of launches. I think Worli will continue with a massive top line of 10,000 potential crores of revenue in the next few years. We've just scratched the surface from a potential point of view. So I think we'll see a lot of launches and activation that particular project itself, of course, with higher price markups as we will continue to launch more projects. We have something in a lot of inventory left in periphery micro markets in Panvel. We launched some clusters in Panvel next financial year. We're targeting to launch the first commercial sale product in Mumbai in Panvel micro market. And then we have some activations left in projects like Reserve. In Pune, we've recently bought a very exciting piece of land with a potential top line of 2,000 crores. It's an 8.5 acres of land in Mahalunge. So yeah, that has been one of our hot favorite markets. We are the number 1 player in Pune. That should hit the market. And then again, there are quite a few launches in different micro markets of Pune. Ahmedabad will see a launch.
Okay, all right. So that's a long list. And you interestingly spoke about launches, especially in the NCR market as well. And we've been seeing some slowdown, right? Stocks have been falling. We've seen the real estate index come up from the highs as well. Honestly, tell us, are we beginning to see some slowdown here?
I mean, there are two very interesting points you've brought up. One is the stock price, and then the is a market sentiment in NCR. I'll take both of them. Please just remind me if I miss out a perspective. I think on the NCR market, I think there's a crazy amount of euphoria that started post-COVID. I think the speculative demand is what was making a lot of talk of the town. So any developer which was looking that as the core demand bucket would of course see some amount of hit, because that is an easy froth market, I would say. But anything which is more end user driven, which is in the right micro markets of Gurgaon, is doing pretty well for us and for our competition as well, a peer group as well. Noida, you'd be surprised, is from a percentage growth point of view last year, probably, if my memory serves me right, was the highest growth market of India from a percentage growth point of view. It has done exceedingly well for us and for select group of peers, because the land itself is heavily regulated because the government supplies the land. So again, the demand is a much stronger perspective to drive price growth and volume growth over there. But moving beyond NCR and talking something more on the stock price, I think it's these are things which sometimes even amazes me. If you see our pure operating performance and you see some of our metrics, so I think it's a matter of time that if our operating performance continues as robust, some of these are sometimes sentiment driven, sometimes these are driven beyond the sector as well, to be very frank with you, like the trade negotiations were also kind of impacting equity markets in general, and there was a view that this could impact discretionary set of businesses. But I think it's a matter of time. Some of the companies that are doing very good in operating performance and are consistently doing that. So I'm proud to say that for the last 10 quarters, we're the only company in Indian real estate. For the last 10 quarters, we've always done at least 5,000 crores above a booking value. For the last 4 sequential quarters, we have done 7,000 crores and above. So I think we've worked on our operating principles very strong. So I think stock prices sometimes takes time to adjust to the reality of operating performance. And I think we will be hopefully for very good performance on the stock market as well very soon. A fun data point, we were looking back in history. There have been probably 5 times when a stock has moved downward by 45%. And each of those times, we've come back whether like 100% growth within 1 year and a 200% growth within 3 years. So if the performance is going to be consistent, I think it's a matter of time markets will recognize that.
Well, thank you so much for joining us and giving us a sense of how Q3 panned by and a sense of the upcoming launches and how you'll be funding them as far as FY27 is concerned. Well, we'll now slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned.
Welcome back. Some recovery in the markets. The Nifty is now down 0.6%, but above the 25,600 mark. We'll keep tracking markets for you. But for now, we'll take your leave on this edition of Mid-Cap Radar. Stay tuned. Your stocks when we return.
Hello, good afternoon. You've tuned into your stocks on CNBC TV 18, coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much, as always, for tuning in. In terms of the market, we have recovered from the day's lowest point. We're at 25,600 levels as of now, about that mark, down almost 16 points in the trading session. Now, let's see if we actually come back in the green in the last 1.5 hours of trade. As of now, I do want to highlight Siemens numbers that have just come in, and you can see them flashing at on your screens as well. Seems like a bit of a weakness that is there in terms of the numbers. One-time exceptional loss, obviously, due to labor code is at 74 crores. But overall, analysts' expectations right now for Siemens was much higher than what we saw on the screen. So margins were at 11% that you saw on the screen. That has seen a bit of a, subdued performance versus what the street was expecting. So if you pull up Siemens stock, we've seen that fall coming in. Also, I'll wait out for more details in terms of the press release as well. But as of now, Siemens doesn't seem like that great set of numbers. Revenue is up 14%, 3,830 crores. What is the order book coming in? What is the capex guidance? All of that is something that we will be keeping an eye out on. But on the flip side, we had another capital good company that reported the numbers yesterday. That was Hitachi Energy. That was a very, very strong performance that came in there. So Hitachi Energy buzzing away in trade. Siemens down in trade. Order backlog is now at around 43,000 crores for the company. So watch out for that. In terms of the capex guidance, I believe they have reduced their capex guidance, but we'll wait out for details on that front. But as of now, this is a show where we solve all your stock-related queries, and we're going to be doing just that with Shaina Mukadam, independent market expert, as well as Vaishali Parekh, Vice President Technical Research at Prabhudas Leeladhar, to answer all the stock doubts that you all have sent us. Hi, Shaina, as well as Vaishali. Good afternoon. Thank you so much for joining us on the show. Let's get started with the queries for today. The first one is coming from Bharat, who's writing to us from New Delhi. He's holding 10 shares of Kaynes Technology. Price is 3,540 rupees per share. Right now, it's at 3,624 rupees, the stock. So they're making a little bit of profit on this one. But Shaina, what should the viewer do? Hold or sell? Shaina, when you look at it today, Kaynes Technology also in the morning, the numbers were not that great. And they spoke about, just achieving 4,100 crore revenue guidance, which was a bit of a cut also from what one was expecting or what they had guided for. So what should they be doing now?
Afternoon, Vinny, afternoon, Vaishali. See, actually, there are two things over here. One is that valuations are expensive, despite the fall that we've seen in the stock in the last couple of months. Even now, if you look at it, compare it to EV by EBITDA 1 year forward, it's still about 22 to 25 times, now depending on what numbers they will come out for the Q4. Having said that, the market does not give any concessions to stocks where the valuations are expensive and the numbers are very disappointing, which is actually what Kaynes Technology numbers were. Even if you compare it on a QOQ basis, the revenues were lower, profits were lower. And yes, they did not meet the guidance that was given. And we were, at least I was expecting something like a 50 to 60% growth on revenue, where actually the growth has been much, much lower. So now we'll have to see Q4. Having said that, I think the major reason what I believe has been given is that the competition from Chinese, the realizations have actually been impacted because of competition from Chinese products and imports from there. So that is a big risk actually that could continue to impact Q4 as well as some quarters going forward. So I would say book half. Investor should book half the profits, half quantity, hold the second the other half, and look to average. I would say not before it corrects by another 10% if you're looking at it at pure valuations. But looking at the opportunity over the next 3 to 4 years, yes, with OSAT, semiconductors, the capacity coming in slowly and gradually, the revenues will start jumping up over the next 3 to 5 years, hopefully, and that should support a good improvement in the stock price. So I would say book half, average again if there is any correction, and you can hold it for the long term.
Okay. Book half, the remaining you can hold it for the long. Let's move on. Vaishali, your view on the technical front?
Hi, very good afternoon, Vinny, Shaina, and all viewers. So as I think you've rightly asked at this level for Kaynes Technology, we've seen this erosion right from 7,500 levels to now. after making a low at around 3,300. I think this level is very crucial. It's at a make or break level. And today, post results, we are seeing that it's attempting to give a bounce back. So I would say follow a stop loss, but continue holding, because once the stock moves above 3850, technically, I think it is ready for a good up move, make it towards 4,500 to 5,000. So according to me, 3,300, 3,200 is a very good support level. So now how you want to juggle this is your call, depending on your time period that you want to hold the stock. But this is how I would look at for a longer term perspective. I would say keep accumulating, because the risk reward ratio is very favorable from here on.
Okay, Shali, we'll continue to hold. That's a word on the technical front. Next query for today, we have Aditya Patil, who's writing to us from Mumbai. He's holding 50 shares of Sign TLM. Price is 703 rupees. Wants to know the long-term prospects for the stock. Shaina, your view?
Well, the stock has corrected a lot because of the disappointing numbers that they have been reporting. But to some extent, that more or less was expected. It's a small EMS company because they had made a couple of acquisitions, if you see in 2023-24. And that actually continues to see some bit of write-offs costs that are being written off, and which is impacting the overall profits. I would say, but I would still say continue to hold, but don't average now. Wait for the stock to stabilize. I would say FY27 and 28 will be much better, because not only are they going to add a number of new logos, but also they are looking in a big way to increase their revenues from defense. So I would say that that is a good opportunity in autos. So I think these are good opportunities over the medium to longer term. So I would say continue to hold, average at much lower levels if you want to average it.
Okay. And Vaishali, your view for Sign DLM, what should they do? Long-term perspective and averaging as an option, what level would you suggest?
With China, because in this stock as well, we have seen a good erosion coming from 500 levels to now at 346. So seeing the chart of all time periodicities, I think 330 makes a very good support. So continue holding, though there is no sign of reversal, but 330 acts as a very good support. And having said that, if the stock shows signs of reversal, this can give a bounce back up to at least 410. So that's how, for now, this would be my view.
Okay, let's move on then to the next query for today. We have Sunil, who's writing to us from Hyderabad. He's holding 150 shares of GNFC, and this is at a price of 520 rupees a share. They're making a loss on this one. The other one is 200 shares of GSK Pharma. This is at a price of 2,510 rupees. So they're making a loss on both the stocks right now. Wants to know the long-term story for both these names. Should they continue to hold this, or maybe look at some other names? Shaina, your view?
I would say can continue to hold both the stocks. GNFC, because valuations are very attractive. Though the investors losing money, and also in terms of budget, it didn't really, the subsidies were slightly lower that the government provided. And so it didn't really sort of give you that budget pop that we expect normally for fertilizer stocks. Having said that, it is one of the world's largest ammonia-based, urea-based fertilizer company. And valuations, if you look at it, is just about 6 times EV to EBITDA if you look at FY27. So, and balance sheet is very strong. So I would say continue to hold. They also have good plans in terms of expansions going forward. For GSK, of course, it's like a multinational. They are continue to introduce the parents' new products into India, including the vaccines, which is a good positive for the longer term. GSK Pharma is expensive in terms of pure valuations, but of course the balance sheet is strong, and this is going to be a steady return type of stock in terms of stock price, in my view. But you could continue to hold both of them for the longer term.
Okay, continue to hold both of them for the long term. Is that the word even on the technical front, GNFC as well as GSK Pharma? Vaishali?
Yes, I would say so, because overall we've seen a good beating coming in almost all these stocks. And now I think both these stocks are showing signs of bottoming out, and the support levels are also pretty close. So I would say just continue holding. And if it's a long-term perspective, I'm sure you will get good returns from here.
Okay. Can hold both these. Long-term perspective, you can get good returns, but this is the long-term view that you've asked for, and that is what both our experts have given you. But on that note, we're actually going to slip into a very short break. After the break, we'll come back with more of your stock-related queries. Welcome back to your stocks on CNBC TV 18. Surely keeping an eye out on the markets as of now. Muted day of trade is what we are seeing, and the Nifty just at 25,600, about that level, just holding on to that. But let's keep it going with all the stock-related queries. We have Shaina Mukaddam as well as Vaishali Parekh, who are still with us to answer all those doubts. Next query for today is come from Varun, who's writing to us from New Delhi. He's holding 55 shares of Tata Technologies. Price is 1,017 rupees per share. He's an NRI investor, so wants the medium term as well as the short term view. Shaina?
Well, he's lost a lot of money, but still, actually, there's really nothing too much I can say for the shorter term. I don't think he's going to recover any bit of his losses. In fact, it's likely to continue to consolidate. You saw the third quarter numbers, they were pretty disappointing. Revenue was low, and of course, the profits were impacted by the labor code. Now, management is comfortable saying that they will do much better in Q4, 10% growth in revenues. But even then, I think valuations are expensive. So I would say it will continue to consolidate for the medium term. But the promoter group is so strong that it becomes difficult to see a sell outright. So I would just say it's a neutral stance if you're a long-term investor.
Okay, let's move on. And, Vaishali, short-term view for Tata Technologies, anything on that front, anywhere sort to a recovery or something sort of that the viewer can view or wait for or hope for in the short term, or medium term is the better bet right now?
Well, short term, I would say the trend continues to be on a downward trajectory. And only thing I can say is that, yes, the near-term support is 605. So short-term view exit if these levels break. But medium-term, I think this does have a scope of further downside going towards 580, 600 levels. And let's see what happens from there on. For now, there is no clarity that it is ready for a reversal. Only thing I can say that 605 short-term support.
Okay. 605 is the short-term support. That's the only support level there. But yes, better to hold on than to the medium term, at least if you want to recover there. Let's move on then to the next query. Sriram Raghu is writing to us from Chennai, holding 30 shares of Patanjali Foods. Price is 217 rupees per share. They're making a profit on this one. They don't mind holding it for a longer term as well from here on. Shaina, your view?
Yeah, so post the bonus issue that we had in September 2025, the stock has been correcting. Results are next week. I expect a steady growth in terms of revenues, and the management is actually pretty confident. Like over a 3-year period, they are investing in the food park, which is for herbal in the industrial food and herbal park in a big way. And so they are talking of big growth over the next 3 years, like current revenues. I say, let's say FY27, they could do about 48,000 crores of revenue. They're talking of 50,000 in the next 3 years. So over the, over 3-year period, good growth in terms of revenues, 10 to 12% growth in revenues. Also, the composition that they are talking of, they will try to increase their non-food FMCG products in a bigger way, higher growth rates expected. So that could actually improve the overall margins. Now, and they're talking of bringing down their oil revenues to about 50%. So I think overall, if you're holding it for a 3-year period, in comparison to some of the others, not ITC, but in comparison to some of the other FMCG stocks, Patanjali Foods is attractively valued in terms of their EV versus their revenues. So I would suggest continue to hold it for the medium to longer term.
And Vaishali, your view and suggestions that the viewer should keep an eye out on in terms of levels for Patanjali Foods?
Definitely. So actually, disclaimer, we've just recommended this stock to our clients today. So I agree with Shaina, even on technical grounds, the long-term trend is intact, very much at support level. So I would say 480 as a support. And to the person who's already holding it, keep a trailing stop loss. Today itself, the stock also is showing furthermore strength. And if it's for a positional trading strategy, I would look at a target of 560, 580 to start with. And from there on, we can have a relook. So view is positive. Do continue holding.
Okay, view is positive, continue holding. Let's move on. Next query. Ambika is writing to us from Mumbai. She's holding an few shares of IEX, not mentioned exactly how many, and this is at a price of 229 rupees. Wants to know if she should continue to hold this or book her losses right now. Shaina, your view?
I would say that, after the correction at current levels, I would suggest if you're a long-term investor, continue to hold. Couple of reasons. One is, of course, the quarter numbers were pretty strong in terms of volumes. They did about 16%. And if you saw the January numbers that were reported in terms of volumes, the power trading volumes have gone up by about 18 to 19%. So that shows that Q4 will be better. The overhang over here is the expectation of market coupling that could come about in the next couple of months, and that could create a pressure both in terms of their transaction revenues as well as in terms of their market share. Having said that, the company is throwing up good cash on a quarterly basis, and that could help it support the long term growth. The volumes overall could grow because the overall share of electricity trading in India is very low compared to international players. So I would say if you're a long-term investor, continue to hold. It's a decent stock to hold for the long term.
Decent stock to hold for the long term. You can continue to hold. Don't get out right now. Vaishali, on the technicals, what's the view there? Are we expecting any recovery in the recent times or maybe just a long-term view?
Seeing. After seeing this corrective move, I would say continue holding because now that you've held on for so long. But conviction in a reversal comes only above 130. So if that is so, and if it's sustaining above 130 levels, then you can see a further move coming up to 140, 150. So I think this stock is just good for a trading strategy, following strict stop losses because every day is a new story. It gives a indication of a strength, and the follow-up targets are just not achieved. So I would say just keep taking it as a trading strategy.
Okay, keep taking it as a trading strategy. That was the last query for today, ladies. So thank you so much for joining us, Shaina as well as Vaishali. Hope you all have a great weekend. And viewers, thank you so much for sending us your queries. Keep sending us your queries. We'll get them answered. You can see the email ID as well as the phone number at the top of the screens. But just a quick word, BEML has reported their numbers. They've reported a net loss this time of 22 crores. Expectation was a profit of 48 crores. Revenue also is largely in line with what we're expecting, but margins, a sharp decline there, 0.3% versus our poll was 8.9%. So we'll wait out for that. We've seen that sharp fall coming in. Seems like a miss over there, at least in terms of the margins and the profits of the company that we've seen so far. But with that, thank you so much for tuning in. Up next, day of closing bell to take you through the last hour of trade.
Welcome to India's #1 budget headquarters. Decoding key policies, delivering market-shaping insights, and unlocking the potential of India's growth blueprint. Beaming live from the CNBC TV 18 Motilal Oswal Budget Headquarters.
The Taiwanese index is down 1.5%. The Hang Seng is down almost 1.75%.
Nasdaq down 1.6 odd percent. S&P down about 1.2 odd percent as well.
We will do in the quarter 4 about 1,700 crores so that we can take up the quarterly number to about 4,100 crores.
90% of the respondents expecting the MPC to hold steady despite having the room to cut.
We don't have anything in writing that we are out of the race.
Nifty is down about 50, 60 points lower. The Nifty Bank is down about 40.
Near-term outlook suggests that food supply prospects remain bright on the back of healthy Kharif production.
It's been a down day so far. In fact, the Nifty, as we speak, is just about holding on to that 25,500 mark.
All rate and TRIPS rate have fallen way below the repo rate.
Liquidity is something that is our duty to provide.
We've definitely been beneficiaries of a lower interest rate environment.
Is the lowest January total since Challenger began tracking this metric in 2009.
Event-heavy week and markets after multiple updates where we actually saw the Nifty move higher significantly post the trade deal announcement has actually grinded down lower.
Well, that is the day so far. And, you know, the global screen was red. And the question that we put out in the morning was, can the market here outperform? It can't go in the other direction, but can it outperform? And it is outperforming. There is no doubt. We're down about 30 points. So it's a pretty flat day. And you woke up with absolutely, you know, a rout as far as global markets are concerned. This is Closing Bell. We're coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Rima and Nigel. Guys, hi. Afternoon.
Aye, and Asia has closed down with a cut of more than about 1.5% for the Kospi, for the Hang Seng. Europe right now is in the red, but the cuts are not deep. We've got a cut of about 0.5% on the CAC, the DAX. FTSE is also slid close to about 0.4%. The DAX is mildly in the red. And the Dow Futures is on the flatter side. But the problem is IT. The Nifty IT index is now down close to about 2%. And week to date, the sell-off has extended itself to a 7% decline on the Nifty IT.
120 minutes, guys. Going to be into the weekend. Where's the excitement? Come on, let's go. You know, and the markets as well.
120.
120 minutes, right? I mean, you're here for ERT, I hope.
Yeah.
So, I mean, I'm just giving take a little 90 to 120 minutes. You better be there for ERT, given the kind of tech route that we've had. But I think the biggest positive today is the breadth of the market. You know, when we started off, when we were doing that morning check with regard to the number of stocks advancing, it was 600, 650, 700. And I was saying by the end of today, we go home with 1,200 stocks will be good. A lot of people messaged me back. That's why I realized that I actually said that. And currently it's around 1,050. So that's good news. And you know, the pulse of the market you're getting by looking at stocks like, say, Kaynes. The numbers are very disappointing. No two ways about it. There are plenty of things to point out there. You know, whether it was the numbers, whether it was with regard to the working capital cycle. Take a look at the stock. It's up 3% as we speak. It's up close to 8% from the low point of the day. It went into its numbers weak, yes. But on another day, that stock could have easily been down as we speak. But the street is willing to look ahead. Give it a chance and say, quarter 4, they promised 1,700 crores. Let's go by that. So they've bought into that clarification. I think that's giving you a sense in terms of the market mode. India is outperforming today. India has outperformed this week. And hopefully we continue that kind of outperformance.
You know, Nigel, I think I'm just looking at the Kaynes intraday. The move started at about 1 o'clock. The call was at about 1 o'clock. So I'm just wondering, have they said anything apart from what they told us in the morning on the call? Because it was at 3,500 at 1 o'clock and now at about 3,700. So like kind of vertical move after that. So we'll try and see because the F5 26 sort of, you know, margins, revenue, etc. They put out when we spoke with them earlier in the morning. Well, let's just quickly run you through what's lined up here on the program. So MPC, of course, absolutely in line. And we'll get you some details there. Nifty is, of course, around 25,600 as we speak. ITC, you know, big correction from the highs. It's up about 4.5–5%. And that's a Nifty heavyweight. It's pulling its weight if you look at the contribution to the Nifty. And this is not just ITC, but Godfrey Phillips as well. So coming up, more details there in terms of what's happening. Technology is the other story. IT index, just a washout with this week. in that sense. So that is the other bit which we will discuss in some detail as we have through the course of the last few trading sessions now. The small cap index has also recovered. 2:1 still declines to advances ratio, but much better than the morning. Nykaa is the other one. Strong positive momentum, of course, after the numbers which came through. Well, LIC is the other one. Lots of stuff, right? LIC is the other one. Stocks up 8%, but there is niggling aspects in the result, which Yash will address in just a bit from now. MRF, of course, strong numbers, stocks up 5%. So it's a packed next 1 hour coming up. How should you position yourself in the last hour? That's the question. Mitesh is with us with exactly that. Mitesh, good afternoon. Good to have you here. What should one do? What's the advice?
Yeah. So me, I think, Prashant, I would understand that the market hasn't broken 25,500. I talked about buying around those levels. We kind of managed to hold 25,492 being the low, that level, and bounce back. And there's no sign of a strong reversal on the intraday charts, but this bounce back means that, as I said, there's a good chance that we could test 25,800. Now, on the stock side, Prestige is a buy. Prestige is a buy with a stop at about 1520 or targets of around 1600. And Siemens had a breakout yesterday. Looks like day before yesterday. Looks like a pullback going on over here. So good levels to enter. Keep a stop below 31.35 and then look for target of around 3300.
Thank you very much for that. ITC, Godfrey Phillips zooming in trade as sources say that the higher price cigarette packs have been introduced in the market. Manglam joins in with more on this story and what it means for the stock.
Well, ITC is the top Nifty gainer, and Godfrey Phillips too is gaining in double digits, as we understand that, the higher price cigarette packs have now been introduced in the market. Remember, on Jan 1 itself, when there was a government notification that came in of 40% GST and substantially higher excise duty on tobacco with effect from Feb 1st, had these stocks under pressure all of January. The street was, expecting a price hike to the tune of around 15 to 30%, in some cases even 40% to come by for the companies to mitigate the impact of this higher tax. However, the street was awaiting any sort of clarity that came by post-budget as well, and there were no tweaks. So which is why now the companies have gone ahead and introduced these higher priced variants to their supply chain. In fact, I was, accessing some of the products coming in from a few of the companies. So Godfrey's 97mm pack now is at 300 rupees versus 240 rupees a pack. 25% hike is what it is. And CNBC TV18 has reached out to the companies as well. We are awaiting their detailed response on the quantum, the nature and the structure of the price hike. But the price hikes have been taken. These stocks are flying on the back of that. Though, two important things to note. Will there be a volume hit because of these higher prices? And do these higher prices cover the entire extent of the tax hike or not? Because if they don't, then there could be a margin hit to these companies' next few quarters' earnings as well.
Thank you very much for that. Mehrboob Irani is now joining in. Mehrboob, before we get chatting about ITC and your take on the story, what's your view on the market now? And how have you analyzed the moves that we've seen over the last couple of days?
The view has been quite consistent. I think let's understand one thing, that what India as a market has undergone. We have not only underperformed absolute basis, but look at the way the investors have struggled. They've not seen money being made last year. They moved from secondary market, parked their money in the IPO market. 70-75% of the IPOs are giving them negative returns. Those stocks are now stuck in the demat accounts. Then as a late Latif, they came and bought into precious metals, and they came off sharply from the highs just a day before the budget. And then there was a whammy of the hike in futures and options, STT. Even if the investors were not too concerned about that, the mood suddenly became negative. Thanks to Donald Trump and Narendra Modi's trade policy, the mood became a little bit better. But check up yourself. I think I would say that we are right now in a revulsion period in the Indian equities outside the Nifty, where blood has started being seen on the street, and possibly this could increase over the next 1 to 3 months, God forbid. But that, I'm quite confident, will provide a great opportunity to investors to identify good quality stocks where there are not any takers, supply is continuing, demand is not there. You will get it a begging valuations. Go and pick them, and just a change of sentiment, you call it, or a turn in the stock price, and you will make a quick 20, 30, 40, 50% returns from the lower base in quite a few decent quality stocks in the second half of 2026. I stand quite, correct me if I go wrong, maybe 6 or 8, 9 months later, if and when we talk to each other on the channel.
Right. Mehrabun, you began by saying this down drift perhaps continues for the next 2-3 months. So you expect pressure broadly to continue, broader markets. That's the view?
100% yes. I think it always happens. I call it a revolution period. The point is that not many takers.
My only question was when you say
when they sell.
No, my only question was when you said, right, I mean, you can make, aren't you kind of sort of then playing against the, those quick 20-30% can happen, but if the broad trend is lower, as you say, then you kind of sort of in a way, if that is the view, then you're picking pennies, as so to speak, in front of a steamroller. I mean, if the trend is lower, which is what you began by saying, so how does one reconcile that, or should one wait for market to kind of sort of settle down a little bit?
No, I will answer that question. Prashant, you have spent quite a few years in the market, and so have I. I think there is an element called impact cost, which not many understand. The impact cost is when you are selling a 10, 20, 30,000 shares only, a PMS house sells or big investor sells, and there are not many takers. The stock on just a small volume of 20, 30,000 shares falls by 5, 7, 10%. And that is because the market is too shallow. 95% of stocks listed on the markets cannot take this volume in a bad market. And then you get those stocks at very attractive valuations, go and do a possible SIP. Like if I want to buy a particular stock, I buy 10, 15% right now, and maybe the balance 75, 80% will follow over the next 10, 15, 20 days, or maybe over the next 2, 3 months. And then I wait for the tide to turn. When the tide turns, I promise you I'm going to make good money. That is what investors need to do. Just don't shun the market. Look at the stocks which you like and start picking them up in small lots at the moment. If there is some more blood coming, then you will get it. Maybe it's lower valuation or slightly higher valuation. But the tide is not going to possibly turn immediately, but as and when it turns, there is decent amount to be made because quite a few stocks have taken a hit of 40, 50, 60% from their highs and even more. So there is an opportunity coming. I'm not saying you're going to make money overnight, but money certainly will be made. And my guess is it's coming in the second half of 2026, maybe with some more blood flowing over the next 1 to 3 months. That's exactly what I meant.
Got it. All right, Mehrabun, stay with us. Mangalam is back with us first to tell us about Nykaa. The numbers look quite good. Brokerages as well are quite impressed with that. Mangalam, run us through the fine print.
But it's a solid performance that came in from Nykaa. 13th quarter of mid-20s revenue growth and the highest ever EBITDA margin that the company had posted. Remember, we knew their top line and the GMV values from the company's third quarter update already. So the room for surprise was on the EBITDA, and there was a massive upbeat out there as well. So 27% growth in the beauty GMV and 31% growth in the fashion GMV led to a 27% growth in their overall revenue. But the EBITDA of the company grew 63%, which implies a margin expansion of nearly 200 basis points from 6.2% all the way up to 8%. The net profit, which nearly moved about 160% from 26 rupees all the way up to 68 crore rupees. Remember, this has an element of an exceptional of 10 crores as well. You add that back, the net profit actually is around 78 crore rupees. Beauty segment, 27% revenue growth, 70% operating performance growth. Fashion as well showed an 18% revenue growth and on the verge of break-even, as the company had earlier guided for. Towards the end of this financial year, they will be breaking even. And all their other segments as well, like the e-superstore, Nykaa, Man, etc., all of them doing extremely well. The standout performer for them this time around was the Nykaa's own brands, or House of Nykaa, which saw big growth coming in brands like Dot & Key, K-Beauty and the likes.
Right, Mangalam, thanks so much for that. That's another stock that's clearly building on to some strong gains. Mehrabun, good to speak to you after a while. Your view on Nykaa, it's been a flip-flop. A lot of excitement earlier, then the stock pulled back. Now these numbers look good. Some brokerages as well, quite impressed. The stock is gaining. Buy into it or stay away?
No, honestly, I'm not tracking it at all. I think I was not very positive on the stock when it got very high valuations, and since then I've never looked at it again. Admit it.
Okay, all right. What about the EMS plays, Mehrabun? Any view on the stocks? they were the stocks that people really loved in the last 12 to around 18 months. And then they've corrected 10, 20, 30%, 35% as well in some cases. Any of them, find a mention for you? And Kaynes, we had the management earlier today. They clarified that Q3 was a washout, which actually sell-side analysts were quite disappointed on. No alert, no kind of heads up given out there. But they're promising Q4 is going to be a star. Your view?
Honestly, I think this particular space is definitely interesting. But what had put me off, and I was quite vocal about it on your channel, was the valuations. There was a Pied Pipers who came and spoke about quite a few stocks in the EMS space. And they were given valuations, I think, which possibly you will see the same price maybe 5, 6, 7, 8 years later. Now that they've corrected, the question is it still value for money? And I feel we are still some time away from that. As a space, and considering that there were some proposals in the budget which are positive for the space, I certainly like the space. But even now, after the correction, none of the stocks in the space merit attention from an investment angle at the moment. But certainly a space which will do well over the time to come. The point was the valuation was too steep. It's corrected. People are getting attracted to it. Maybe there could be an opportunity here and there. But I still feel the valuations are a little bit steep, not too comfortable to go and park in money in this little bit of dirty environment in the market at the moment.
The Nifty IT index, though it's corrected quite sharply, is still about 15% away from its 52-week low at the index level. Mehrbun, do we get there? I mean, which camp are you on when it comes to the Indian IT space? The bearish camp, which believes there is going to be valuation pressure, more earnings downside, or do you think the fears are overblown, the fundamentals are fine, and at some point stocks will be attractive?
I think I have answered this before also. Over the last 2 years, disclosure, I'm not owning a single IT stock. And despite the sharp fall in the price, I'm not enthused to put in any money in this particular space at the moment. We have to understand and accept that we have been a little bit backward in introducing new things as far as the space goes. Not many things have been done. The question is, are these companies good? Answer is yes. Is the balance sheet good? Answer is yes. But where is the trigger for me to go and buy? Just because the stocks have come down does not merit investment necessarily. There could be value ultimately at the end of it all, because 10 out of 10 voices on the street are negative right now. And when that happens, some value emerges. I'm not disputing it, but I personally am not too enthused. I've been negative on the space for quite some time right now. And the only thing which is attracting me is that everybody now on the street is negative. So somewhere there will be an opportunity coming. But as of now, not too enthused to either recommend or to buy.
Okay. All right. Quick word on MRF. The stock, because of its size, it's moved 10,000 rupees in a single day, up close to 9%. Numbers look quite good. What's your view?
Brilliant numbers. I would say about 110, 120% improvement in consolidated net profit, operating profit up nearly 70%. But if you compare it year on year, we also have to accept one thing, Nigel, that last year, the same quarter, October to December, was a tough quarter because of increase in raw material prices. And that's why you are seeing, while the revenue growth is 15%, operating profit is up 70%. Now, definitely you can commend the management, but as a valuation, I think it always enjoys premium valuations. There is a strong brand they have, a very solid balance sheet, a very old company, never had any problems of any debt. So it always gets a premium valuation. Now, considering that if you want to take an exposure in the auto sector or related to auto sector, I think MRF would not be a bad bet. It would be a decent bet if you ask me. The stock had corrected well enough, and I'm quite sure the market would be enthused with the numbers which were just announced an hour and a half ago. But whatever be the right now for the price after this results have been announced, I think it would not be a bad bet to go and put in some money if you want to park yourself in the auto space or auto NCDD space or the tire space.
Okay, all right. Mehrbun, this is, we just want to put out a story. Stay with us. Sources tell CNBC TV 18 that FMC Corporation, which is a global company, their India commercial business is drawing strong strategic interest. I mean, the fact that the India business is on the block is known, but Rachna is picking up information about who could be interested parties, and there are more than a few listed entities. Rachna, over to you.
That's correct. Sources have told CNBC TV18 that the race to acquire FMC Corporation's India commercial business is gathering pace, with multiple Indian strategic players evaluating the asset. Now, people familiar with the matter say that UPL, Dhanuka Agritech, Coromandel International and Crystal Crop Protection are likely to be interested in the India business of this American company, with more strategic players expected to join the process as it moves forward. Now, sources also indicate that the deal value could be around $450 million. This is after the write-downs FMC took as a part of preparing for this asset for sale. However, the final valuation, bid structure and transaction format are still being worked out. Now, FMC's India business, which is on the block, includes branded crop protection products, a pan-India sales and distribution network and long-standing relationship with the distributors and farmers, making it a strategically attractive asset for all the companies that we just mentioned who will be looking to scale up quickly. Now, FMC has already classified the India unit as held for sale in its FY25 accounts, formally signaling its intent to exit the commercial operations in the country. Now, the company has also said that the India sale is a part of its 2026 operational priorities aimed at strengthening the balance sheet. FMC is targeting $1 billion reduction in debt through a combination of asset sales and licensing agreements, while sharpening focus on its core global portfolio. CNBC TV18 has reached out to all the companies mentioned, and we are yet to receive a response.
Rationale, thank you very much for that. I mean, it's not market moving yet, but it's not a small number. I mean, at least the deal value, which is pegged, and it depends on, the bids which come in, et cetera, but $450 million. So we will see who sort of does put in the bids, but we've reached out to everyone, and as Rashna said, we've not heard anything back in that sense. Now, Mehraboon, before we wrap, anything, open-ended question. You want to just leave us with the idea or the construct of an idea?
Well, I would say we should all be waiting for opportunities, and the opportunities have started coming in. And in fact, as I mentioned earlier, Prashant, I'll make it very clear, I started nibbling at stocks. There are spaces which I just want to avoid, especially most of this recently listed IPOs, the new technology business and all this type of things, because there was a fad over there. I'm not saying they're bad businesses, but the point is the valuations, there is no comfort. But there are opportunities here and there. I think it starts with banking and financials. Like in banking, for example, there are names which may not be the most attractive names for people, but there is too much of value. A name like a Jammu and Kashmir Bank, they just need to raise capital and the stock will be higher, I'm quite sure about it. Or a Karur Vaishya Bank, a Bank of Maharashtra. If you look at this stocks right now, I think they have corrected a little bit. And I think the downside is not there, if you ask me. And ultimately, there will be an upside. But as and when the market tide turns, the opportunities also will change. So there are stocks which are possibly slightly higher beta, which may be a little bit worrying because people are right now seeing blood on their portfolio. It's not easy to ask them to go and buy. But there are those names like a Bank of Maharashtra or a Karur Vaishya or Jammu Kashmir Bank type of thing in the banking space where I feel there's a decent opportunity. Go and buy them. Do an SIP for the next 1 to 3 months or go and buy them lump sum. You won't lose money and certainly there will be an upside. But there will be many stocks which will outperform this fairly steady stocks by a wide margin as and when the tide turns. So if you have names in your which on your buying list, and if you feel that for some rhyme or reason because of the lack of depth in the counter and some selling happening and the impact cost taking place and the stock comes down sharply, just go and buy them. Like for example, I like a name like a Timex or a Wanbury, which announced results yesterday. Timex announced good numbers 3 days ago and the stock is down 20%. Now, I don't see it falling much. Clear disclosure, Prashant, I'm holding the stocks and I have no intent to sell. In fact, I'm planning to add to my holdings.
Okay, Timex is one of those ideas, but I mean, across the range of stocks, Mehraboon telling us that he's starting to nibble. We'll take a break. Rupen Rajguru is with us. Mehraboon, thank you very much for joining us in the program. Always a pleasure having you here. Rupen on markets, of course. He's head of equity, investment and strategy at Julius Baer on the other side. Stay tuned.
Fly Emirates, fly better.
Welcome back. Let's put the spotlight then on the top movers in the market this Friday afternoon. Harmis joins in. Harmis.
What a recovery that has been from the start of the trading session, and one stock that has contributed to that big time is ITC, and it has been the lead contributor to this Nifty recovery and the subsequent up move. 4.5% higher now on the stock. At one point was up almost 5.5 as well. Double-digit gains seen for Godfrey Phillips as well in today's session. And take a look at the volumes at which the stock has gained. Almost 6 crore shares now have been traded on ITC in today's session. The 20-day average being close to 2 crore, so almost 3x its 20-day average. It'll be interesting to see the delivery volumes on Monday. Godfrey Phillips too, 60 lakh shares traded. The 20-day average is just 3.5 lakh shares, so substantially higher volumes for Godfrey Phillips, as is for ITC as well. A lot of positive earnings reactions that have transpired even despite the broader market pain that you're seeing, and MRF is now up 9% after its results. A very strong operating performance. LIC, you don't see a 7% surge very often on this stock, and despite this move, the stock is still below its IPO price. Hitachi Energy too, 14% higher in today's session. And look at the volumes here. MRF is not a very heavily traded stock. It still has 50,000 shares being traded today. LIC has had 1.5 crore despite the lack of free float. Hitachi Energy too has seen almost 8 lakh shares being traded, almost 4x of its 20-day average. And lastly, Apollo Pipes is one name that's the top gainer on the small cap index today. It's 17% higher, the biggest single day gain in 9 months. The last time the stock gained this much was back in May of last year. And if you take a look at the volumes as well, it's gained in 3 out of the last 4 trading sessions. Volumes are the highest since January of 2018 in today's session. So at 7-year high volumes is Apollo Pipes. 30 lakh shares have been traded today. The 20-day average is just 60,000 shares. So significantly higher volumes. The stock is exactly at its 100-day moving average, which is at 309. The 200 DMA is still far off. It's still at 362, but at an important level is Apollo Pipes. But for the month of February, the last 10 years, positive returns in only 4 of those.
Okay, all right. Thank you very much, Sharmas, for that. Rupen Rajguru is with us, Head of Equity Investment and Strategy at Julius Baer. Rupen, good to have you with us here. Thanks for joining us. The global screen perhaps is the one which is of a little bit of worry. I guess we can attribute the lack of follow-through after the India-US to the global screen. I don't know if that's the right thing to do, but I mean, it's very comfortably blame the global thing, the global shakeout or whatever you want to call it. What's your sense, Rupen? Will markets hold, sustain? Because so far, perhaps it's a bit more steady, and the downward drift perhaps stops. 25,500 is a level. But what can we do on the upside, in your opinion?
Hi, afternoon, Prashant. So yes, day-to-day movements will be there, and it will be very difficult to track why anything is up or down. But if we just zoom out and look through that, India as a market has gone through a pretty, to some extent, painful period of consolidation, which is probably we are now on our 16th month. And typically, if I were to go by history, any correction or consolidation in Indian markets have typically been at around 1 to 1.5 years, so 12 to 18, 19 months. So we are probably there. I think one of the key reasons why the sentiment was had soured vis-a-vis Indian equity, particularly from an FPI community perspective, was because of the Indo-US trade deal, which was earlier expected to be happening as early as May of last year, and it probably didn't happen. And the world was beginning to think that whether we have our leverage vis-a-vis the US and all, whether it's waning and all those stuff. So finally, that is done and dusted. So at least that sentiment, which was negative, which to some extent was also impacting the currency, so that is now done, and hopefully from here on, we at least would have seen the intermediate bottom more so for currency at say 92 odd levels. We are probably at 90.5 as we speak. On the other hand, the fundamentals are on the mend. So we have been seeing that, also this our sentiment coincided with earnings growth deceleration. Our earnings growth declined from a high double digit to as low as 7 to 8%. That is on the mend, and we believe that earnings growth next year would be around mid-teens. So at a margin, and market always looks into rate of change, so earnings are better. And also the sentiment is no longer as bad as what it was some time back. So hopefully other things remaining constant, if we don't get derated or re-rated, if we are able to deliver a mid-teens kind of an earnings growth over next 12 to 15 months, I think suffice to say we can expect such kind of return from the market itself.
So have you made an intermediate bottom in the markets also? The Sunday low perhaps post STT? And what are you buying now?
Hi, afternoon, Rima. So probably I don't follow technicals that closely, but assuming that probably Sunday was the day in which we hit the bottom from a sentiment perspective, right? Because at that point of time, we didn't have the US trade deal. Probably from an FPI perspective or a general market sentiment perspective, while per se budget was not as bad as what market indicated, but from a purely taxation perspective, the market saw a low of that mid or below 25,000 odd level or so. So at this point of time, I think I would strongly believe that would be the bottom for the market. And going ahead, we should also look into which segments would be the earnings leader. And the earnings leader definitely, the one of the key theme what we are looking into for this year is return or comeback of credit growth. So that should augur well for BFSI. that should augur well even for the NBFC. So that will be the leader for earnings growth. And in fact, in today's credit policy also, there was no rate cut. So probably we have also seen the bottoming of NIMs, and at a margin, we would see NIM improvement. So we expect a strong earnings growth for that segment going ahead over next 12 to 15 months. So that will be the leader. Also, the consumer side, while the results have been a mixed bag, but we believe that segment also has seen quite a bit of, I would say, underperformance. And that segment, and particularly premium consumption, is what we like. And that also should be the leader in this next leg of growth, which we would see in the market. So these are the two big segments, which is what we would like. And that is what we believe will drive the market going ahead.
Hi, Rupen. Good to see you in. Rupen, what's the view on tech? You're talking about it being a tactical play. What kind of tactic, though? Tactical buy after the correction?
Yeah, hi, afternoon, Nigel. So yes, for tech, now, for the tech companies, for like AI is, you love it, you hate it, but you can't ignore it. It's very clear. So they have to all wake up and, smell the coffee. Having said that, like famously, Mark Anderson had said software is going to eat the world, and now at least the way things are, AI is actually eating the world. Yes, last 1 week, a lot have happened, and a lot of analysis is gone through. So while if you ask me whether I'm an optimist or pessimist, I would say I'm an opportunist here. Because IT as a segment clearly is no longer a segment which earlier used to grow at around 8 to 10%. So that's no longer there. But having said that, it always provides opportunities. So I will be pessimistic at around 22 valuations PE, and I will be an optimist at around 17 to 18 PE valuation. So we have corrected, but we have not gone into that level. So from a pure market perspective, if the stocks were to correct further, say 10 odd percent, 12% or so, we clearly believe there is a tactical trading opportunity in the stock. So because news flow will be there, and going ahead will be having more and more of news flows. But some of the things, be it from the Palantir's perspective, even if they claim that something they can do it in 2 weeks, which otherwise would take 2 years, it might not be that realistic, and a lot of the things might be exaggerated, and they might not immediately impact them. And in fact, in day after the Cognizant results, also the commentary from the management there was pretty constructive. So there will be opportunities. And as I've said earlier in your channel, that when you get into that level of 17, 18 PE with a good FCF yield, unfortunately, they should be doing more of CapEx. And that's why they would have not got derated. But since they are not doing CapEx and they're giving it back to the shareholder, and now they will be doing more buybacks post the taxation change. So that will also provide a good floor for those companies. So around 17 odd P, a lot of the large companies on a 1 year forward basis would start to look pretty attractive.
Okay, all right. You want to hear this, Rupen? D Street chatter. And Nimesh gets us that every day. Nimesh, good afternoon. Finally, it's a Friday. Tuesday felt like a Friday. Wednesday felt like a Friday. But finally, here we are, a real Friday. So what's the mood, and what are you picking up?
Abhishan, a good recovery in the market, and that's been the theme this week, right? Especially in the broader markets. We've seen intraday recovery in virtually all those days, and a bit of pullback as well. And even when the Nifty was down in the last couple of days, I've been saying this, that the momentum is shifting towards the broader market names, the small cap names, and that's playing out. Even from a flow perspective, that's been the change from the domestic mutual funds, a bit of shift from large caps to the small and mid caps. So that's the trend. Even in today's market, a good recovery in the broader market names. The mid cap index is virtually in the green, and so is the small cap index as well. The other big theme has been the big reactions to the earnings. Look at what has happened to Hitachi today. The street was short in the stock, and it's seen a 12-13% move. So is the case with LIC as well. A big valuation comfort for that stock as well. So a big reaction to those names as well. From a flow perspective, again, a day when I sense is that there is buying interest from larger FIs as well. So maybe you'll see a bit of a buy figure from the FIs, and that's slightly towards the metal names and some select PSU bank names. So bank index has done well, but within that, I believe it's the PSU banks which are well bid by institutions. FMCG is again up today, but that's largely to do with ITC. And we've seen what happened to all the cigarette names, all are buzzing in trade on the back of that price hike. But the big theme seems to be a recovery in the broader markets, and then that too backed by institutional buying.
Okay, absolutely. Now let's get to the stocks, Nimesh, in terms of what you're picking up and the chatter there.
Well, so the first stock is Bharti Airtel. The stock is buzzing in trade today. There is a con call as well at 2:30. But again, the sense is that maybe a large block will come very soon. Remember, the earnings are over. So in the next 48 hours from now, the promoter entity can sell. So the strategic investor is classified as promoter. So potentially a block is likely in Bharti Airtel very soon. So that's the first name. Second stock, this is interesting. Cartrade and Poly Medicure. In the last 2 days, we've seen massive sell-off in both those names. Cartrade in the last 2 days, I mean, today it's recovered. But in the last 2 days, the stock surprisingly was down 15-16%. And so is the case with Poly Medicure as well. Both the stocks are under pressure of late because I understand one long-only fund and FI has been an aggressive seller. Essentially, the feedback is that maybe there is a redemption pressure and it's a common holding in both those stocks by that global fund, and hence you're seeing pressure on both those names. I guess Poly Medicure, even in today's market, is down 6-7%. The third name is Aditya Birla Real Estate. You've seen a massive fall in all the real estate names in the last 6-8 months, and so is the case with AB Real Estate as well. But in the last 2 days, there has been a very sharp recovery. The stock yesterday was up 10%, today is up 4%, largely because I understand the selling pressure from a domestic PMS is largely over, and hence you're seeing a bit of a pullback in that name. And the last name is PNB Housing. In the last couple of days, you've seen a bit of a reaction and a bit of recovery as well, largely because one domestic mutual fund has been accumulating PNB Housing at current levels. It's virtually come to one-time price to book, so a bit of buying is back from domestic funds in PNB Housing.
Thank you very much for that, Nimesh. We will slip into a break on that note. On the other side, we'll get you a few calls from our technical experts. Stay tuned.
Fly Emirates, fly better.
Welcome back. It's a good trading session. The Nifty is now at the day's high and the Nifty Bank as well. So pretty good going on that front. And as I mentioned earlier today, expect India to actually outperform from here on, given the underperformance that we have seen. We have taken support at closer around the 20-day MA on the Nifty and we have bounced back. But I think the biggest positive is that the advanced decline ratio has got a little bit romantic. I say that because they were very, very far away getting into the weekend. Now they're getting a little bit closer. Close to around 1,300 stocks are advancing in comparison to the number of stocks declining. Looks like they may kiss each other before we are done with today's trading session. Now the PCR has moved up to around 0.97 odd. Remember a few trading sessions ago it had gone to around 0.7. So that's around holding around the 1 odd mark because the put writers, their game is on. 25,600 put, just take a look at the premium. Down from 106 to around 66. 25,500 and 500 put. Out there, the premium has come down drastically. No, that's not the one we're talking about. 25,500 put. Let's get that up for you on the screen. It's come down from around 71 to around 41. And also the 25,700 call, well, you could have got the direction right. But the premium on that one has come down from around 120 to around 92. Telling you at around the 25,850 odd mark, the bears are going to come to fight back up because you've got the direction right with the Nifty being up 50 points, but still you're not making money. So clearly intense writing being seen at that level. Individual stocks, some of the stocks that actually got hit, they have come in for a bit of a short covering bounce in trade today. HUL, big move on the upside, open interest down, as is the case with Kotak Mahindra Bank as well. The stock had got slammed a couple of weeks ago. That one's up in today's trading session with the open interest lower. Nykaa, well, those numbers look quite good. So there are signs of some fresh buying as well as some shots that are covering on that name. While ITC, one of the biggest underperformers in the last 1 month or so, there are signs of fresh buying out here, both in terms of delivery as well as in the futures and option space on stock futures. 305, 310 appears to be the buy zone from a bullish perspective. So that's why that stock is up and about. Mitesh Thakur is back with us. Mitesh, give us a couple of trading ideas.
Fink looks like a good bet. It's a stock which has been extremely, going through extreme decline and now trying to reverse. So yesterday was a good move. Today is a consolidation candle, so we should most likely see continuation tomorrow. So 41.15 is the price. Keep a stop of 40.95. Look for target of 40.50. And the other one which I like, that's Torrent Power making a fresh swing high. It was a call earlier as well. That's a BTS with the stop below 14.20 for target of 65.
Thank you. Enjoy your weekend, Mitesh, if we don't speak again. Thank you once again. Let's talk about LIC that continues to build on gains following what was a strong quarter. Yash is now joining in. He's put together some interesting analysis to make sense of those numbers. Yash?
Well, for LIC, the numbers, no doubt, at the headline level were very strong. But we put together some numbers just to understand how the outcome of those strong numbers really happened in terms of the internals intersecting each other. And most importantly, this relates to the VNB performance, or the value of new business performance, and the margins, which are a derivation of that. So just looking at the margin breakdown to start this analysis with, the impact of business mix on the margin was about 2.6%. The impact of economic assumption on the margin was 1.9%. Now, economic assumption is essentially assumption related to yield curve, to external factors away from the business. Here, there was a positive surprise which came in, which impacted the margins positively by about 1.9%. Now, importantly, the impact of operating assumption on VNB. Essentially, this is to do with business itself, but of course, assumption on the VNB. Here, there was a negative implication of about minus 2.8%. The net improvement in VNB was about 1.7%. Essentially, what's good here is the improvement in the business margin on the back of more margin accretive business. That's certainly a positive for LIC. Now, importantly, what's not good, and it's important to talk about that as well, operating variance. As I said, the operating assumption was sharply negative, down 280 basis points for 9 months FY26 and over 500 basis points for the third quarter of FY26. Operating variance essentially reflects the gap between operating assumptions and what the outcome has been. The whole point of this analysis is to say that if not for that economic variance, the positive impact of 1.8%, if that wouldn't have come through, the margins for LIC in the quarter and for the 9 months would have been much lower. What this spells, in absence of positive impact of the yield curve and hence the economic variance, the margins, as I said, for LIC for the quarter and for 9 months could have been much lower.
Okay, all right. Thanks a lot for that, Yash. Thanks for breaking that down for us. Dharmesh Kant, Head Research at Chola Securities, joins us on the show. Hi Dharmesh, good to see you in. Any view on LIC?
Yeah, good afternoon, Nigel. Thanks for having me for the show. We have a positive view on LIC, and we have been recommending this for quite a while. Though stock prices have not moved up, I mean, we have been recommending at 900 levels. It's still out there after today's move. But fundamentally, I think this company merits attention out there just on the valuation comfort which it enjoys compared to your private sector peers. So, Yash has detailed out many of the factors out there, but some of the factors always play out in favor of company for the margins to be better. Going forward, I think Q4 also this will play out in favor of LIC, and Q4 is supposed to be the best quarter for any life insurance companies. In light of all the competition, they have been able to grow their retail APA by 61%, which is a remarkable thing for LIC to do, seeing the size at which it sits around. And at the same time, your VNB has grown by around 31% with margins. I mean, 21% is there, but the management was sounding very confident that they will do a better margin in Q4 than what they did in Q3 and FY25. So I think net, given the fact that it still trades at 15 to 20% of the valuation multiples, which say HDFC Life or SBI Life or ICICI Pru Life enjoys, enough elbow room out there for the stock price to see appreciation, say near to medium term. So we are a fundamental bias for 5 to 7 years kind of perspective for the portfolio bias, but even for trade, I think for next 2-3 months, if somebody is holding 10% kind of an upside from current levels is gettable.
Just a quick word on, we'll have numbers coming through from SBI and Tata Steel. SBI is tomorrow. And any thoughts on these two names?
See, Prashant, the SBI, I think the numbers will be usual around 10-11% kind of profitability growth with stable NPA ratios, which we have seen with the likes of all other companies. What I am looking forward to is the NIMs and the NIA growth for SBI. So how the outlook is there. And the other income, because other income segment for most of the public sector payers were not exactly in line with others. Some saw degrowth, some saw growth. So how SBI has panned out there would be the monitorables. So, but net, I think there would be any negative surprises out there. Tata Steel, we can see a positive surprise because the steel volume growth has been quite decent, and more than that will be the commentary, because this January onwards we have seen price hikes in the domestic market. So how things are panning out there and in their European foray. So Tata Steel as a house we have not been recommending. We have always preferred JSW Steel in the ferrous space over Tata Steel.
Yeah. Stay with us. I kind of jumped the gun there, Dharmesh. We'll actually put out the previews on the other side of this quick commercial break as well. But good to get that view. 9 minutes to go for close. We're going to come back in just a bit. Those previews and more market coverage coming up.
Fly Emirates, fly better.
Welcome back. Just one quick word on Kaynes. That one has recovered considerably from the lows of the day. The reason is I'm looking at a Jefferies note. They're saying the stock trades at around 36 times, which is the 55% discount from the peak that we have seen. So that's about Kaynes. Good recovery is what we're seeing. But the big number that we're looking forward to is SBI. Gaurav joins us to help us out with what to expect. Gaurav?
Well, as for SBI, if you look at loan book growth, it is expected to come better than most of the banks at 13% on a year-on-year basis. It will be in line with the system, and at the same time, deposit growth, it is likely to be around 10% on a year-on-year basis. As a result, if you look at net interest income, we are expecting 8% growth. Now, other income, that is likely to stay stable, and that is the reason why the PPOP, there may be some support to PPOP, which is the reason PPOP is expected to grow almost by 18 to 19% on a year-on-year basis. Now, when it comes to profit, the number is expected to grow just by 4% because remember, in third quarter of FY25, the provisions were very low because of the COVID account that SBI had back then, and that is the reason why provisions may see a sharp increase on a year-on-year basis. Apart from that, if you look at the net interest margins, they are likely to stay stable. Credit cost, as always, SBI has a pristine asset quality and they do not see any kind of stress in the asset quality even going further, and even analysts are not anticipating any stress going further for SBI. But what is likely to impact the stock is the commentary. Now, commentary on growth, that is something that we will be watching out for because remember, management earlier said that the growth will be in the range of 12 to 14%. Commentary on the asset quality, not just for SBI, but for the entire industry. The commentary from SBI actually is a very important thing to watch out for. And lastly, commentary on the margins, because today RBI has kept the repo rates unchanged. So let's see what SBI has to say about their margins going ahead.
Okay, all right. Gaurav, thank you very much. Yeah, you're absolutely right. I mean, the commentary is going to be the one to really watch out for as we come back. Dharmesh, on IT, do you have a strong view on where we go from here? I mean, this week's basically been a complete washout.
Yeah, Prashant, I mean, the difficulty with all the IT companies in general, basically SaaS platform companies would be to sustain whatever they are doing. I'm saying, I mean, this Anthropic thing may not play out immediately, but it's definitely out to be played out in some time. So maybe 9 months, 1 year down the line. So till here, we were talking about how much growth they can do, 3, 4, 5%. And now the talk would be whether they are able to sustain their present margins or not. So Orient Solutions, we have been, tracking, and I have been recommending there. Yesterday, there was a con call out there, and a couple of more IT companies con calls. The commentary from the management was very clear that they have to reimagine, restate, strategize the entire, product offering which they are having, and everything has to be AI built. So the challenge is there, and the expenses are going to mount. And secondly, as we all know, AI is deflationary in nature, so the margins will also get squeezed. So the challenge here with most of the IT companies would be now how to value them. So trading bounces here and there can still happen. But I think the currency depreciation tailwind is the only thing which has been, keeping them afloat. So from large cap and largely most of the SaaS player, we are out of it. The only stock which we have been recommending and holding till now has been Orient Solutions, where I think a fair place there in the offing, 1,700 odd close of around order book is there. And management sounded very aggressive on the data center opportunity because by their own saying, they said that they have not imagined the type of opportunity which will come through 3 or 4 months back. So there, I think things are going to open up in a big way out there.
Product company, as you're saying, not a services company, so you believe it's well placed, though the stock has become half from the top that we saw around 24 months or so ago. Thanks a lot, Dharmesh, for joining in and giving us all those views. By the way, just one quick word on Tata Steel, the numbers that will be expected later today. The key numbers you're looking forward to is the India EBITDA per ton at around 13,300 rupees, and Europe is expected to deliver a loss of around $12 per ton. Well, let's wind down the markets then for you. Today was in fact that sort of a day. You had a couple of names that did a big move in today's trading session. Case in point being a Kaynes. That stock was down 5%. It ended higher in today's trading session. So good move is what we saw. Data patterns, the stock did splendidly well. Up and about. Nykaa as well was a stock that went home with solid gains. And ITC and Godfrey Phillips, smoking is injurious to health. But for those that held the share, they would be quite happy in today's trading session. So good move is what we saw on both those two names. Number of stocks declining were far more than the number of stocks advancing. But the real story was actually that the crisscross lines got closer to each other by the time we wound up. Net, India outperformed this week. India outperformed today. And hopefully, that's going to be the trend that we'll see for the remainder of this year because 2025 we were lagging behind. We'll wrap up on this edition of Closing Bell. Don't go anywhere. The editors are waiting on Editors Roundtable. Stay tuned.
The Lal Street ends higher for the second straight week. The Nifty and the Sensex gain over 1.5%. Mid-caps outperform. However, the IT index was the biggest underperformer, falling 7% this week. Over the next 30 minutes, we'll decode the week on Dalal Street, the big tech sell-off, and put the spotlight on the cement earnings and the way forward. Hello and welcome to Editors Roundtable. I am Reema Tendulkar. We've got a full house today. All the boys are here, Prashant, Nimesh and Nigel. And also joining us is Sandeep Tandon, founder and CIO at Quant Mutual Fund. Guys, finally, it's a Friday. Prashant, I know you've been wanting this Friday for a long time. On Tuesday morning,
I was just thinking that this is the only show where, and when Reema is there, that I don't think, the only time we get called boys, right? Nimesh? Especially you and me.
Yeah.
Nigel, I think. What is a good feeling? But
it's been a long way.
When she said boys, even Sandeep put his hand up.
No, I think, yeah, I mean, the week started, Reema, with
budget.
You know, the midnight budget.
No,
the
budget.
week actually started on Sunday.
Started on
not
Sunday.
Monday.
It's been a long week. Yeah.
And then Monday is that trade deal announcement.
Late night.
So, and it happens very rarely for, I guess, any of us. It never happened. I don't remember if I've ever anchored live at 1 o'clock at night. So this was one of those things where and that was Monday. And that is, I think, the reason why it felt like, when you came back on Tuesday, it felt like, you know, it should be at least.
Have been a Friday.
But it was not. And the point is, the pace did not slacken off, right? Something or the other.
Yeah.
It was that anthropic thing then, I think, which was Wednesday
Global
morning.
tech news, the rout there. And then we ended with the RBI policy and lots of earnings thrown in the middle.
I mean, so, you know, I was just looking at the week-to-week change, which is 3.5% Friday to Friday, last Friday to this Friday. But that doesn't do justice to the lived experience of this week, which is every day was like a, you know, it was just almost felt week-long days, Reema.
Lived experience. I think I like that word. Sandeep, what was your experience this week, every single day?
Obviously, as Prashant described, it's pretty hectic. But finally, there is a smile on most of the faces now, you know, some sense of relief. You know, the trade deal is fine, EU is happening, worst is behind us. We have seen selling exhaustion happening. Okay, rupee also slightly appreciated. So I think that's the reason, like, there are a lot of things to cheer. And if you recollect our conversation, the beginning of the year, I said this year will be very challenging for global equities. My worry was not India, worry was global equities. And that risk is just playing out. And the good news is that India has showcased the signs of outperformance. So I expect the outperformance journey on relative basis will continue for this year, both from a developed market perspective as well emerging market. More damage you see in the region, particularly in the Korea and the Chinese market or Taiwan, okay, a lot of money will shift to India. So I think I'm actually going to celebrate if the region corrects sharply or global market corrects sharply. We should be beneficiary rather than somebody getting worried about that, oh, global markets are again weak, and then we have to deal with that. So it's a very uniquely, I think the data points are so constructive that you have to be constructive first on relative basis. That is the most important thing, because last 6 quarters we have been underperforming on relative basis. So relative basis, things are looking better. And I think with a lag effect, and things will start looking good in the absolute perspective also.
All right, Sandeep, actually that was bang on, right? The chat that we had at Market Forum, you said that the global derating of PE will take place. That's happened. Gold and silver, you were saying a little bit dicey. You're expecting a correction out there. And India will outperform. So tick. Well done, Sandeep. It's a good start to the year for you. But I think let's go across to Prashant to do a quick recap, Prashant, of you know, the week. The week that was, Prashant, has been an exhausting one for you. I'll tell you later what I was doing on Monday night when you were here, but go ahead.
No, I mean, so just to recap the numbers, and it'll come up on your screen. Nifty 3.5% higher, Bank Nifty about 3% up, mid cap index 4%, the small cap index 3%. So everything, you know, everything done, and you finally have some gains to show by the end of it. And I think that was what Sandeep was talking about as well, those smiles, right? Because a lot of stuff has happened, constructive things have happened, and this global thing, we'll see how it plays out. But nevertheless, now IT, of course, Reema is going to address that in greater detail, but Infosys, Tech Mahindra, LTI Mindtree, Coforge, HCL Tech, anything between 6 and 8% cuts. I thought it would be larger, but I guess that's because Monday and Tuesday were positive days, and this entire thing only started from Wednesday onwards. Now, large cap gains, Power Grid was up 14, it was a great week for the Adani Group stocks. Adani Enterprises 10, Adani Ports up 9, Energy Solutions and Power, and I could go on, but you get the idea. Now, the Nifty, the NSE 500 losses, right? Bharat Dynamics, actually a lot of defense names cracked. 18% lower on BDL, Garden Reach down 13%, HAL down 12%, Cochin Shipyard down 10%, and a lot of mid-cap and small-cap sort of, tech names thrown up. So I'm not going to repeat that theme. Hindustan Copper, resource companies. Hindustan Copper, of course, the only pure-play copper company here, 16% down this week. And then what? Cohance was down 11, BEML was down about 9.5%. So that's the defense kind of crack. Now, large cap, the NSE 500 gains coming through. These power transformer companies, right? Apar Industries 19%, Hitachi up 15%, CG Power up 15.5%. Aarti Industries, I mean, that big move after the deal, that Tuesday was very big for it. 18% on Aarti Industries week on week. Balkrishna Industries was up 17. Nykaa, I mean, I think today was, of course, after numbers was a big day. So, I mean, more, but you get the idea broadly where we saw gains. And I'll just leave you with this table, right? 6.5%, nearly, not even 6.5 actually, 6.15% is the NASDAQ fall from the highs this time around. And it feels like, the market's been going one way without a correction. But that is just because, I mean, the momentum, the start of the year has been so strong, but that's not true. Last 12 months, we've had 3 decent sized pullbacks. There was October and November last year when the NASDAQ pulled back 8%. There was the Liberation Day, April, when the NASDAQ pulled back 15%. And there was the DeepSeek. When DeepSeek came out, NASDAQ fell 7%. That was Jan 2025. The point I'm just making is that we've had these corrections and the markets after, 7 to 15% falls has not faltered. It has pulled right back. So is this going to be a repeat of that? Is it going to be something different? And of course, even if it is different, will India relatively outperform? I think that is what everybody will watch. And I think Sandeep's answer is in the affirmative in that sense. But Rima, IT is the focal point.
Indeed, the Indian IT index sold off nearly 7% this week. And the big story is the global tech wreck. And the question is this the start of a greater unwind? First, let's get the numbers. From the start of this year, Microsoft is down nearly about 18%. Software companies, Palantir, ServiceNow, Salesforce, all down close to about 30%. And most of the slide happened this week. Now, what drove the correction? One, the fear of AI. Not what AI is doing today, but what it can do tomorrow. So Anthropic Claude's plugins show that AI can now do sales, finance, legal, analytics without the traditional software layer. So investors are now questioning the business model, the operating model of software companies. And secondly, the capex numbers. Now, Amazon's $200 billion capex spend guidance for 2026 spooked the markets. And to put it in context, just these 4 big tech IT companies are going to spend $650 billion potentially in terms of an AI capex this year. Is this money going to generate ROI? Or are big tech companies perhaps stuck in a game where they need to spend just to survive? For Indian IT service companies, the impact is second order, but it's real. For one, the fear is of greater revenue deflation. 2, client decision-making gets delayed. What happens to the expected FY26 earnings recovery? Does that slip further? And will IT companies, especially the large IT companies, get stuck in this mid-single-digit kind of a revenue growth rate trap? But here is an interesting counterpoint. Cognizant CEO exclusively spoke to CNBC TV 18, and he said AI won't magically plug into enterprises and create value overnight. That has never happened with any technology. AI is a contextual technology. Value only comes when it's grounded in enterprise workflows, processes, and operating layers. And there is a need for IT services companies to act as a bridge between models and enterprises. Brokerages, though, remain a divided house. Now, Kotak says it's plenty of panic over a little flutter. So they're arguing that the reaction was actually disproportionate. The risk stems from the future unknown breakthroughs rather than proven impact today. But Jefferies, on the other hand, is a bit cautious. They believe that currently there will be some more growth pressures. Valuations could correct. There are downside risks to valuation, which is why they have a selective stance. But the pressure that we saw in the Indian IT companies came in from overseas. Nasdaq sold off about 6% in a span of 3 days. But just to put it in perspective, over the last 3 years, this is the kind of rally that we've seen in mega tech companies. Nvidia up nearly 1,500%. You had a 3,000 plus rally on Palantir, 800% on Meta and Broadcom. So just to put the kind of correction that we've had in context with the kind of rally that we've already seen in the last 3 years. So Sandeep, for the last few months, you have been calling for a top perhaps on the global tech companies, saying that there's too much hype, too much exuberance being built in. But as Prashant was saying, right, we've had some corrections in the past, but they've been about 8%, 10%, 15% at best. Do you think we're going to see a deeper correction? Or do you think once again, because this time the AI demand is real, buying will emerge at lower levels? What's your own view?
So the way I will look at all those companies who have potential to act as a AI enabler, okay, who are willing to adapt these things, those are the companies will survive. And I'm sure many companies are putting in the efforts in that direction. So it will be too premature to really conclude and write off Indian IT companies. I'm not extremely bearish, though we also have cut down our exposure significantly in the month of January when we turned cautious on the global market. The first thing we cut down the realty exposure. So, but I will look for a buying opportunity because Indian IT services firms are actually trading in the neglected zone. So if these companies are actually inversely correlated with the AI bubble, okay, if you see correction happening continued in the US market or the Taiwan market or the Korean market or even the Chinese market, and I think with a lag effect, Indian IT companies should recover, but we are not trying to do bottom fishing at this stage. Let them correct something, some more percentages points, and then we like to evaluate.
Hi Sandeep, I heard you saying that one needs to be a bit constructive on the market right now. Where are you putting your incremental money to work? Which sectors or which stocks that you like at this point in time?
So for a change, we are actually a very large exposure suddenly on the private sector banks. So we have cut down PSU banks and we have built very large exposure in the private sector bank. There's a one area which we never used to be over on. So this is the first time we have been grossly over on the financial space. We also like the insurance company, irrespective of recent correction in some of these names. I think that's an area which is sunrise industry has a lot of potential. Lot of headwinds are settling down. So that's another area I like. Large cap companies, fairly good liquid names, quality management. So we are comfortable out there. Then we also have built some exposure in the mutual fund industry, the asset management industry companies also, because that's the area we see continuous growth happening. So those are some of the new companies are also getting listed. So we have increased their exposure, particularly in these areas.
Sandeep, what about the defense pack? What's the view on that? It seems there was a wish that came in the budget and the wish got granted. Anything's looking okay there or you rather stay away?
So frankly speaking, we are bullish on defense as a sector from a longer term perspective. But Nigel, we have to understand that valuations are pretty overstretched. Most of the names are grossly overowned. So I would like to wait for a corrective sort of thing, and this 10-15% correction is not very meaningful. So they have to come back to the respectable valuation level for us to participate. We were early to participate in the defense sector and we were equally early to exit. Okay, so we have not able to capture the exact peak. But at this point in time, I would like to have a wait and watch approach, but with a mindset that I will look for a buying opportunity at appropriate time, not at the current levels.
Stay on. Sandeep, need to slip into a very short break. But on the other side, we'll also put the spotlight on the cement companies. Are they gearing up for a very strong fourth quarter? We'll get to more on that on the other side. Stay tuned.
Welcome back. You're tuned into Editor's Roundtable. Now, there's plenty of talk with regard to Trump, tech, and you don't know what else with regard to the globe. So if you're looking at a sector that could relatively outperform, has no such relation to either tech or Trump or anything on the global front, we're looking domestically. And the question is cement ready to outperform in Q4? And I say that because, the pieces are coming together. Now, for the last quarter, just to do a quick recap, the volume growth is pretty good. High single digit to around early double digit for select companies. The blended EBITDA on a year-on-year basis actually was up. But on a sequential basis, it was down. EBITDA per ton is what I'm talking about. However, that was because prices were weak. So I'll get to that in just a bit. And commentary as well was fairly good, with a lot of companies talking about cost savings over the next few years. Now, the commentary, the demand is robust, and they're expecting things to continue because it's a seasonally strong period as well. Prices have improved. That's the takeaway. And cost savings of around 150 to around 200 rupees. That's the recap of the past quarter. Now, things are actually improving. If I look at prices after a period of close to around 8 months, they have improved. A price hike of around 2% has got absorbed. That's the confirmation. Non-trade segment as well, the price hike has got absorbed, which is good news. And in February, there is talk of a price increase as well. So in January, the price has moved to around 340 rupees per bag. There's an indication of another 10 to around 15 rupees per bag increase. So pricing, no worries. What about demand? Demand, as I said, the last quarter, high single digits for most companies, some even double digits. On an average, it was around 7% increase in terms of demand or volumes. Now, what the street is working with? Well, they're working with low double-digit volume growth for January. They're also saying that, the outside of the seasonally strong period will be pretty good. And they're expecting demand momentum to sustain. So put everything together. In Q4, prices are likely to move up. Demand is quite strong. And we'll see operating leverage that will play out. If you get a number, well, JM Financial, they have quantified it. They're saying that they're expecting 250 rupees per ton improvement in EBITDA per ton in Q4 in comparison to Q3. So if we're looking at an earnings surprise or an earnings strong quarter, well, cement could be that space. It's been a little bit jittery in the last few quarters, but Q4 is showing some promise. Let's wind it down with the valuation snapshot. I'll tell you what, when the industry does well, sometimes these small to mid-cap names sometimes do relatively better. In a weak period, the large-cap names do better. So let's see whether or not cement can stamp its authority in Q4. Let me put that question across to Sandeep. Sandeep, what do you make of this space? Consolidation, actually, the pace has gone down. But prices have been, absorbed, which is quite heartening. And demand, I've also done some ground checks. Demand is quite good, at least for the first month of this quarter and the first 10 days as well. What's your take? What do you like from there?
Nigel, frankly speaking, whatever channel check we have done, we are also getting a constructive feedback that at least on the housing front, the consumption, which is the cement consumption by household, that percentage is very large. That is picking up. So which is the good news. Then we are hearing that prices in the southern states have actually moved up. So it's a constructive background. I'm actually quite positive on the whole material space, because it has been in the neglected zone for a while. People have not looked into it because of the concern of extraordinary capacity which has been built. So I think industry is in a consolidation phase. One has to look at the stock-specific opportunity rather than just saying that entire sector looks to me. So, and this could be typically this quarter, typically January to April is a good season for the cement. So I'm also slightly optimistic. We have increased our exposure very marginally in this space. It's not very big call, but there's a constructive outlook.
Sandeep, we can't let you go without asking your view for gold and silver. I think your view was that it's looking toppish, right?
So Prashant, in the beginning of the year, I said that 2026 will remember as how the crypto behaves. The volatility in the precious metal will be very meaningful. You will see 15-20% move on either side. And that is something exactly what we have visualized has played out. And in fact, in our multi-asset fund, we have been very lucky. We actually sold silver. We were running around 24% silver in our portfolio. We sold virtually $111. And we converted whatever we have into gold because we have to maintain 10%. And then also we have cut down nearly 14-15% exposure in gold also, and nearly 5,500. So we are now running at the minimum requirement of set for the gold perspective or the silver. Our view is that very high likelihood that you have seen a top of 2026 at the prices what we have seen very recently. But I will say it will be very volatile asset. It's not going to be the way last 2 years, we have 1.5 years, particularly we have seen one way trended up. You will see extraordinary volatility and will remind you like it will behave like exactly like a crypto. So you have to live with that. But I will like to, at appropriate time, I like to rebuild the exposure in silver and gold both. I'm not extremely bearish, but we have to trade in a mature manner, but is a very, very volatile asset class at this point of time.
Silver is not part of that multi-asset thing, right? Is it? It's only gold.
Gold and silver both.
Gold. Silver is already down 50% from highs. You don't think that's the? It's not a. Yeah, I mean, as you said, you'll at some point rebuild the exposure. Not now, Sandeep.
Not on immediate basis, but it is there. When data points become constructive, we like to add that because I'm constructive from a longer term perspective. It's not something we have given up. We always said precious metal is a strategic position one should hold on. This year, beginning this year, I've been advising to all of the people who ever asked me on various forums. We talked about if you have a leverage position or if you have built extraordinary exposure in last 1 year or 1.5 years, it's the time. But now, if people are going to react, it's a bit late. Okay, so I think the way I look at both gold and silver, a lot of unwinding will happen as prices recover, but it will remain volatile. But you have to trade very smartly. If you can do that, then there's a ray of hope. Otherwise, the probability that you might get stuck at higher levels and get capitulated at the bottom levels.
Sandeep, great to hear your perspective, and thank you very much for joining us at the end of this very important week. Well, it's curtains down on this edition of Editors Roundtable. We thank you for watching. Stay tuned to CNBC TV 18 for more.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The Reserve Bank keeps the repo rate unchanged as expected, maintains a neutral stance. Governor Sanjay Malhotra reiterates the Goldilocks scenario for the Indian economy. RBI hikes its forecast for growth and inflation, expects GDP growth for this fiscal at 7.4%, projects inflation to cross 4% by October this year. Sovereign bonds decline as RBI refrains from fresh debt purchases. The rupee weakens by 30 paise against the dollar. RBI plans a framework to compensate customers impacted by digital fraud for up to 25,000 rupees, also doubles the limit of collateral-free loans to small businesses to 20 lakh rupees, allows banks to extend finance to real estate investment trusts. Sensex and the Nifty end higher for the second straight week. Mid-caps outperform, but IT stocks get battered. The Nifty IT index is down 7% this week. The tech rout on Wall Street keeps the markets jittery worldwide. Amazon pledges $200 billion, taking the total proposed spending on AI to a whopping $660 billion, including Google, Meta and Microsoft. Gold and silver prices remain under pressure. Bitcoin attempts to recover from a 16-month low. The proposed trade deal between India and the US will not include rice, wheat, soya, corn, sugar and dairy, according to government sources. Commerce Minister Piyush Goyal expects a joint statement and tariff reduction to 18% by next week. Civil Aviation Ministry informs the Parliament about repetitive defects in 50% of the 754 aircraft analysed across airlines in the last 13 months. 82% of Air India's aircraft, 37% of Indigo's aircraft analysed were flagged for recurring defects. However, the government does not specify whether these repetitive defects are critical safety-related faults or non-critical maintenance issues. UPL, Dhanuka Agritech, Coromandel and Crystal Crop Protection likely to be interested in buying the India assets of US-based agrochemical company FMC. Sources say the deal value could be around $450 million after write-downs. That's an exclusive. US companies slashed more than 1 lakh jobs in January. The layoffs are the highest for a month in 17 years since the financial crisis. Transportation, tech and healthcare account for a majority of the job losses. After weeks of tension and posturing, the US and Iran hold first stage of negotiations to prevent a war in Oman's capital, Muscat. Iran calls for a fair and mutually satisfactory agreement on nuclear power. At least 18 people are dead after an explosion at a coal mine in Meghalaya. Authorities say the rat hole was being operated illegally in what is one of the biggest mishaps in the last 12 years. But let's go straight to the top story this evening. The Reserve Bank's monetary policy. The repo rate was left unchanged as expected at 5.25%. In fact, all 6 MPC members voted to pause the rates. Now, the RBI has also retained its policy stance. It stays at neutral, with only one MPC member, that's Ram Singh, calling for a change to accommodative. On inflation, the central bank has raised its estimate by 10 basis points to 2.1%. That's for the current fiscal. Projections for the next 3 quarters have also been revised higher, with inflation expected to cross the 4% mark by October. The RBI has upgraded its growth outlook, projecting GDP expansion of 7.4% for FY26. That's up from the earlier estimate of 7.2%. Governor Malhotra said India continues to be in a Goldilocks scenario where growth remains strong and inflation stays under control. Take a look.
We are certainly, in the same sweet spot, maybe even better, because growth is looking up. Growth is looking even better, and inflation is the same. Headline, one is looking at headline, 0.1, 0.2%, 20 basis points here and there is a very small number. Point number one. Point number two, it is headline. As mentioned in my statement, it is primarily to do with base effects. It is primarily to do with the volatility in the food prices, core inflation, underlying inflation, barring precious metals, is very benign.
Well, that is the RBI Governor on the Monetary Policy Committee's decision. Sovereign bonds declined after the RBI refrained from fresh debt purchases. 10-year yields rose to 6.75%, but the rupee weakened by over 30 paise against the dollar. That's where the rupee finally closed, 96.5, and that's the bond market action for you. The rupee has strengthened by nearly 1.5% this week against the dollar, boosted by the India-US trade deal agreement. The governor said the central bank is concerned about any undue and excessive volatility in the rupee, but he also added that the RBI is not targeting any specific levels. Let's go across to Lata now. She joins us to take us through what she made of the commentary that came in from the RBI. Lata, no major surprises from the RBI itself in the policy, but what do you make of the commentary?
Oh, yes, it was a most status quo of policies. As you say, neither the rates nor the stance was changed, but that was as expected. The point is the governor seemed to even hint that there is a long pause. That is, the repo rate may remain at 5.25 for a long time, because he said the positive real rate is in accommodative to neutral territory. What it means is repo rate minus inflation. Should repo rate at 5.25, inflation rate, the forecast is around 4.5%. So the difference or the positive real rate is around 1 to 1.5%, which is the neutral rate. All this explanation was giving the impression that he's not going to change those rates anytime soon. All that was like on expected lines. But what was surprising was at the moment, there is a lot of liquidity in the system. So the call rate is often a good 0.5% below the repo rate, the one-day money. The Reserve Bank governor did not really address it, saying that broadly, it encourages transmission. That made mutual funds very unhappy because they are the people who put the money in what is called the TREPS market. And there they are getting only 4.25, where they were expecting 5.25. So they are unhappy, the banks are happy about it. But the point is the governor did not give a reason why he is not doing the, variable reverse repo rate, VRRR as they call it, to pull out the excess money. So mutual funds are unhappy. The other place where he did not commit at all was on the dollar rupee. The usual statement that, RBI only intervenes for volatility, they don't have a level. He also said that in the long run, the budget has steps, insurance, 100% FDI has been allowed, GCCs have been given safe harbor. These are all known, but on a daily basis, FPIs are pulling out money and pressuring the exchange rate. There was no real help for the market to understand that part better. So that's why I call it status quo and how in terms of this policy. But to be fair, on the governor's side, he did say that the borrowing program will be managed by proactive and preemptive provision of liquidity. He also probably is not committing either ways because there is a new GDP and CPI series coming. So therefore, probably was less committing or less revealing as to what the RBI's thoughts are. This policy is status quoist and how. That's the only way I can describe it.
All right, status quo policy. Lata, many thanks. The RBI, by the way, also announced a slew of measures aimed at protecting consumers, and we'll get you that in just a bit. But let's talk about today's market action. The Dalal Street closing in the green after a volatile session, the Nifty ending above the 25,650 mark. The mid-cap index underperforming. FMCG stocks ended at the day's high, and IT stocks extended their losses, closing lower for the third session. So that's the Nifty. Flat but in positive territory. The mid-cap index closing just about in the red, and the bank Nifty also closing in positive territory today. For the week, the markets have ended higher. That's for the second straight week, with the benchmark indices ending 1.5% higher. Mid-cap index has outperformed and ended about 2% higher. That's the picture for the week. The realty index up almost 5%, and the Sensex and the Nifty closing by about 1.5% each. Now, the tech rout on Wall Street is keeping markets jittery worldwide. Amazon has pledged $200 billion, taking the total proposed spending to a whopping $660 billion, including Google, Meta and Microsoft. We're talking about AI spending. Rima is standing by to take us through the massive capex plans that these tech companies have put in place and why that's making the markets worldwide nervous. Rima.
First, let's get the numbers. From the start of this year, Microsoft is down nearly about 18%. Software companies, Palantir, ServiceNow, Salesforce, all down close to about 30%. And most of the slide happened this week. Now, what drove the correction? One, the fear of AI. Not what AI is doing today, but what it can do tomorrow. So Anthropic Claude's plugins show that AI can now do sales, finance, legal, analytics without the traditional software layer. So investors are now questioning the business model, the operating model of software companies. And secondly, the capex numbers. Now, Amazon's $200 billion capex spend guidance for 2026 spooked the market. And to put it in context, just these four big tech IT companies are going to spend $650 billion potentially in terms of an AI capex this year. Is this money going to generate ROI? Or are big tech companies perhaps stuck in a game where they need to spend just to survive? For Indian IT service companies, the impact is second order, but it's real. For one, the fear is of greater revenue deflation. Two, client decision-making gets delayed. What happens to the expected FY26 earnings recovery? Does that slip further? And will IT companies, especially the large IT companies, get stuck in this mid-single-digit kind of a revenue growth rate trap? But here is an interesting counterpoint. Cognizant CEO exclusively spoke to CNBC TV 18, and he said AI won't magically plug into enterprises and create value overnight. That has never happened with any technology. AI is a contextual technology. Value only comes when it's grounded in enterprise workflows, processes, and operating layers. And there is a need for IT services companies to act as a bridge between models and enterprises. Brokerages, though, remain a divided house. Now, Kotak says it's plenty of panic over a little flutter. So they're arguing that the reaction was actually disproportionate. The risk stems from the future unknown breakthroughs rather than proven impact today. But Jefferies, on the other hand, is a bit cautious. They believe that currently there will be some more growth pressures. Valuations could correct. There are downside risks to valuation, which is why they have a selective stance. But the pressure that we saw in the Indian IT companies came in from overseas. Nasdaq sold off about 6% in a span of 3 days. But just to put it in perspective, over the last 3 years, this is the kind of rally that we've seen in mega tech companies. Nvidia up nearly 1,500%. You had a 3,000 plus rally on Palantir, 800% on Meta and Broadcom. So just to put the kind of correction that we've had in context with the kind of rally that we've already seen in the last 3 years.
Well, it's important to put that in perspective. Rima, many thanks for joining us. And let's shift focus now to the India-US trade deal. Government sources say the proposed deal will not include rice, wheat, soya, corn, sugar and dairy. Commerce Minister Piyush Goyal said that he expects a joint statement and tariff reduction to 18% by next week. Abhimanyu standing by. Abhimanyu, the government trying to allay concerns on agriculture. What are your sources telling you?
Government sources have indicated that the India-US trade deal will not have any adverse impact on Indian farmers since several commodities have been excluded from the ambit of the deal, which include wheat, rice, soya, corn, sugar and dairy. Also, government sources had indicated that India has committed to buying items from the US which are already imported from other nations, and India imports products like oil, gas, aircraft, laptops, smartphones and goods for data centers. India currently imports around $300 billion worth of products annually, which will now be sourced from the US as well. India expects to hit $500 billion worth of imports from the US in the next 5 years. It remains to be seen how early this growth is going to be achieved. Also, the Commerce Ministry has indicated that the first tranche of the BTA between both the sides is already ready, and they are hoping to sign a joint statement in the next few days. Also, a formal agreement is being drafted, which will be signed by the mid of March, possibly. It has been indicated by the Commerce Ministry that tariff reduction from the American side would take place, would be undertaken via an executive order once the joint statement is signed, whereas India's MFN tariffs, which currently apply to several American products which are imported into India, they would be reduced only when the legal agreement is signed. It remains to be seen how early all these processes are going to take place and how early the deal is going to take shape.
Abhimanyu, many thanks for joining us. Now, India's crude oil imports from Russia in the month of December fell by 33% compared to November. This as per the latest data. Now, Russia now accounts for less than 25% of India's overall oil imports in December. That's down from 34% the previous month. So as we've been pointing out, we have seen a consistent decline month on month of India's oil imports from Russia, and this number is likely to go down even further. Remember, President Trump has said that India is committed to buying zero oil from Russia and enhancing its import from the US. Now, we don't, of course, know the details of that, and the Indian government has chosen not to respond to that specific comment. Now, the race to acquire American agrochemical company FMC's India assets is heating up. Rachna joins us now with more. Who are the suitors, Rachna?
Well, sources have told CNBC TV 18 that the race to acquire FMC Corporation's India commercial business is gathering pace, with multiple Indian strategic players evaluating this asset. Now, people familiar with the matter say that UPL, Dhanuka Agritech, Coromandel International and Crystal Crop Protection are likely to be interested in the India business of this American company, but with more strategic players expected to join the process as it moves forward. Sources also indicate that the deal value could be around $450 million. This is after the write-downs FMC took took as a part of preparing the asset for sale. However, the final valuation, bid structure and transaction format are still being worked out. FMC's India business, which is on the block, includes branded crop protection products, a pan-India distribution network and a long-standing relationship with distributors and farmers, making it a strategically attractive bet for domestic agrochemicals companies looking to scale up quickly. Now, FMC has already classified the India unit as held for sale in its FY25 accounts, formally signaling its intent to exit the commercial operations in the country. But the company has said that the India sale is a part of its 2026 operational priorities aimed at strengthening the balance sheet. FMC is targeting a $1 billion reduction in their debt through a combination of asset sales and licensing agreements while sharpening focus on its core global portfolio. So while the intent to sale is clear, the timeline has also now being straightened out, which would be 2026. We did reach out to all the companies mentioned, but are yet to receive a response from them.
All right, Rachna, many thanks for joining us. Now on to aviation. Civil Aviation Ministry has informed Parliament about repetitive defects in 50% of the 754 aircraft analysed across airlines in the last 13 months. However, the government does not specify whether these repetitive defects are critical safety-related faults or non-critical maintenance issues. Madhiya standing by with more. Madhiya, take us through what the Civil Aviation Ministry is telling Parliament.
Well, fresh government data reviewed since January 2025 now showing that 754 aircraft across Indian airlines were analysed for technical issues. And what clearly stands out is that 377 aircraft, which is nearly 50%, were found to having repetitive defects, meaning the same issues were being reported more than once. Now, if we look at the airline-wise numbers, Indigo analysed 405 aircraft, of which nearly 36%, which is 148 aircraft, had repetitive defects. Air India is particularly notable here. 137 out of the 166 aircraft showed repetitive defects. That is over 82% of the aircraft that were analysed. Now, Air India Express had 54 aircraft with repetitive defects out of 101 that were analysed, and SpiceJet reported 16 such aircraft, while Akasa Air had 14. Now, the key issue here is lack of clarity. The government has not specified whether these repetitive defects are critical safety-related faults or non-critical maintenance issues. That distinction is crucial here. Critical defects are those that can directly impact flight safety. These include engine failures, landing gear jamming, flight control or hydraulic failures, faulty sensors, autopilot malfunction or software issues. Experts warn that these kind of defects require immediate attention or grounding of aircraft because they can pose serious safety risks. On the other hand, non-critical defects are typically allowed under the minimum equipment list, or MEL as it is known. These often relate to cabin or passenger comfort issues such as inoperative in-flight entertainment screens, broken seats or tray tables that we see very often on social media. There's damaged interior panels or minor cosmetic damage. While the numbers might look alarming, the fact that these aircraft are not grounded yet and are flying indicates that these defects, even though repetitive, could not be alarming.
Well, we certainly hope so, Madhiya, and we would wait for the government to clarify. But many thanks for joining us. Back to the Reserve Bank's policy. The central bank announced a slew of measures to protect consumers, including a 25,000 rupee relief for those that have been hit by digital frauds. Ritu standing by with the details. Ritu, what is the central bank saying?
A whole bunch of measures aimed at consumer protection, starting with a draft guideline that RBI will issue on mis-selling of financial products and services by any bank or NBFC. Number two, when it comes to recovery agents and their treatment of consumers, where we've heard all kinds of stories, there again, RBI is going to review the rules and harmonize them across various categories of lenders. Number three, it is also going to issue a framework to limit the customer liability when it comes to fraudulent transactions. So for small value fraud transactions, RBI proposes that customers can be compensated for up to 25,000 rupees. It will also issue a discussion paper to introduce safeguards when it comes to digital transactions. So for instance, it could introduce lagged credits and additional factors of authentication when it comes to transactions by senior citizens. Now, apart from these, there were other non-policy measures as well. For instance, RBI is now proposing to permit banks to extend finance to REITs. It is also going to enhance the limit of collateral-free loans banks can give to MSMEs from 10 lakh limit currently to 20 lakh rupees. There will also be exemption for certain NBFCs that are not consumer facing and that have assets of less than 1,000 crore rupees. They will not be required to register with RBI. And lastly, for certain categories of NBFCs that are lending against gold collaterals, they will now no longer require RBI permission to open more than 1,000 branches.
All right, many thanks, Ritu, for joining us. US companies have cut more than 1 lakh jobs in the month of January. The layoffs are the highest for a month that we've seen in 17 years since the financial crisis. Shilpa standing by with the details. Shilpa, the highest layoffs across sectors. Take us through who's been hit the hardest.
Well, January has begun on a rather weak note for the US labor market. Now, the 1 lakh job cuts in January is also more than double of last year's levels and more than 3 times the job cuts we saw in December. Now, the transportation and technology sectors cut the most number of jobs. Now, transportation tops the list because UPS alone laid off 30,000 workers after severing ties with Amazon. And that brings us to the second biggest sector handing out pink slips, technology. 22,000 jobs cut as companies continue to roll back pandemic-era hiring and flatten management structures, and that was led by Amazon's 16,000 layoffs. Now, healthcare is another pressure point. The sector saw over 17,000 jobs being cut, its highest monthly tally since 2020, and this as hospitals grapple with rising labor costs and tighter reimbursement budgets. Now, coming to the reasons cited, now contract losses and economic conditions were the biggest triggers, and they together accounted for more than half of all the layoffs. Now, restructuring and closures also featured prominently. But artificial intelligence, which has been the talking point, that was directly cited in just about 7% of all the job cuts, suggesting that while AI still remains a large part of the conversation, companies are still attributing layoffs to cost pressures and business realignment rather than outright automation. What also stands out is hiring, or should I say the lack of it. Well, hiring plans fell to just over 5,300 in January, and that's the lowest January number on record. Now, Challenger Gray and Christmas says that job cuts do tend to rise in the first quarter, but the scale that it's seen in January this year suggests that many of these plans were finalized towards the end of 2025, reflecting a more cautious view on the outlook for 2026 for the world's largest economy. Back to you.
All right, Shilpa, many thanks for joining us. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We're back in a minute with more.
Welcome to this monetary policy special. The Reserve Bank's Monetary Policy Committee announced a very status quo policy, status quo on rates, unchanged, repo rate at 5.25%. The stance, as expected, did not change from the current neutral. I call the policy status quo because the governor did not even comment on the exchange rate, which has been under pressure, nor did he comment on the excessive short-term liquidity, which has pulled the call rate way below the repo rate. The real takeaway from the monetary policy statement and the press conference thereafter was some very important steps announced for consumer protection, especially when they are victims of fraud under 25,000 rupees. Beyond that, the policy did not give us much hints of how things will pan out from here on. But precisely to read all that, I have with me a team of eminent economists and fixed income market experts. I have Samiran Chakraborty, the chief economist at Citi India. I have Mridul Sagar, who was the member of the MPC some time back and is currently a professor at IIM Kozhikode, and of course he has been executive director at RBI some years ago. We also have with us Devang Shah, head of fixed income at Axis Mutual Fund. Gentlemen, thank you very much for your time. Samiran, to start with you, are you getting a sense that we are in for a long pause, 5.25 for probably the better part of this year?
Thanks, Lata, for having me. I guess given where the current growth and inflation forecasts are, a long pause seems to be the base case. But as we have been highlighting that there is unusually large degree of uncertainty, the forecast uncertainty band is particularly wide on both growth and inflation now, because we don't know much about how the new CPI and the new GDP series is going to be coming. This is on top of the usual uncertainty from global and domestic headwinds and tailwinds. But this particular issue probably prompted RBI to be extra cautious in this policy, in not providing any guidance in either direction. So I'm guessing that as we move into April and the RBI is in a position to make better forecasts about FY27 based on the new GDP and CPI, we might get a bit more clarity on whether there is space left for any further easing. But at this point of time, it's more about maintaining a low interest rate for longer and trying to compress both the term premium as well as the corporate credit spread to the extent possible. I mean, both these things would ensure better monetary policy transmission.
So at the moment, your best guess is that in calendar 26, there won't be rate changes?
I mean, that's what we are going with right now.
All right. Well, let me come to you, Devang. The market reacted negatively in the sense bond yields went up from 6.65 to 6.7%. What did the market make? Why this jump in yields?
Yeah, so as I think Sovereign highlighted, there was nothing in the monetary policy from bond market perspective. I think bond markets were looking at a couple of things, which were like already RBI has done a lot of open market operations, but I think there was some more hope around that there might be some bit of announcements of open market operations. There might be some bit of announcements on some bit of VRRs or some kind of liquidity measures. Because there was no announcement of any kind of these measures, I think, and market also believes so, that probably incrementally there might be no rate cuts. With that, the gross market borrowing program being so high and the SDL supply for this quarter being so high, I think markets gave up the gains which probably happened over the last few days after the budget sell-off.
Okay. Devang, the governor did say that he will preemptively and proactively provide liquidity. Wasn't that an assurance for the market? If not for today, generally, is there a hope that there will be OMOs or there will be something done if the yields went higher?
So surely, Lata, you're perfectly right. I don't think that, I also feel that RBI has been very, very proactive in managing liquidity. And to be fair, when we did the calculations, we believe so that the durable liquidity after the 3 lakh crore of OMO which they've announced since end of December and 2 lakh crores of FX buy-sell swap,
the core liquidity goes up to around 6 lakh crore plus. So there is a banking liquidity which is slightly not very positive, and we are actually at around 1.5 to 2 lakh crores of banking liquidity positive. But when I look at core durable liquidity today, after all the actions which RBI has taken in the last 2 months, it is 6 lakh crore plus. And that is why that is the fear among market investors, that there is a possibility that because of such high core liquidity, RBI might not be able to do open market operations. They have been very proactive. The frictional part of the liquidity, which is on account of government high balance or on account of advance tax or some other reasons, might be taken care of more through VRR. In the absence of higher OMOs or an OMO announcements, I think market gave up the gains, because any which ways borrowing number announced in the budget was slightly higher, and there is a huge supply left on SDLs for the remaining part of the
Fair point, fair point. Yeah, I think he has not tackled the near-term or the medium-term long-duration bonds. Maybe that is the worry of the market. Time permitting, I'll come back to that. But let me first get to the currency bit. Mridul, you know, nothing much was provided for those of us or those in the market who are angsting about the uncertainty and the pressure on the exchange rate. Of course, the exchange rate has come up after the US trade deal announcement. But all that we got from the governor was that Reserve Bank intervenes to control volatility on both sides and nothing more. How do you explain this? Could not some confidence be given for those for those who are being beaten by a depreciating currency?
So, Lata, the more you kind of give those forward guidances, the more jam you are into it, and they lose its efficacy. I think this is the right call that RBI has taken to communicate very little on the exchange rate, or for that matter, on any forward-looking guidance. It's not the job of the central bank to just sort of take away all uncertainty when market needs to price that uncertainty. So I think if you ask me, the sum of the policy was calibrated very nicely, communicated very nicely. There is absolutely no doubt that status quo on rates, on stance, and not communicating hard measures on liquidity is just the right sort of call. We have the borrowing program known from the budget, but we still have to have a calendar. And clearly, see, what is important is that the budget has 250,000 crores of switches as an option. I think that will be a very hard number to achieve, but something like 154,000 crore, which RBI was able to do last year, could be repeated. The bond markets are in a very tough time, so pricing would be going up even if they do the switches, and market will extract a price. So we have to see how this whole game of chicken gets played, because in the sense the government had the first mover advantage, and the borrowing came a little bit higher than what the markets would have been comfortable with to keep bond yields status quo.
Well, Samiran, we've got the governor's statements as an input, and we've got the budget in terms of what it has said on GCCs getting a safe harbor, data centers getting a huge tax holiday. What's the sum and substance view on the currency now? Where is it headed by March or even later by June?
We tend to be at this point of time optimistic that if all the trade deals, they are not just signed, but also part of their impact starts getting felt on both the trade side as well as on the capital flows side, then the balance of payment situation will improve. Our own forecast for balance of payment is positive as we move into FY27. As soon as the balance of payment starts getting positive, automatically this depreciation bias on the currency could be somewhat tapered. Now, then comes the more difficult question to answer, which is that whether the balance of payment surplus could reach a point where the RBI actually starts allowing a substantial amount of appreciation in the currency also or not. Because we know that from a typical valuation perspective, the rupee in the typical matrix of 40 country RER and all which market tracks, rupee has become very cheap. So would RBI allow some amount of appreciation in the currency and make it come back to a more normal mean reverting way in the middle of that RER range that we have historically seen or not? I think that question is a more difficult question to answer at this point of time. But clearly, if the balance of payment turns positive, then this additional depreciation pressure that was coming on the currency, that will definitely get stopped.
Okay. Well, if you took the governor at face value, he's only going to intervene even on the appreciation side when it is speculative and not if there are actual flows. In any case, let us see the actual flows. At the moment, you may talk about long-term flows like GCC or data center or even 100% FDI in insurance. But on a day-on-day basis, money is moving out, dollars are moving out, and that has to be filled. So, I mean, it doesn't look like the depreciation story is over on some days. On many days, it looks like that. But you have a number for the depreciation itself by March? You have a 92? Yeah, Samiran. 92, 91.5, what, any number?
We think it's possible that if the trade deal is a favorable one, then we can even go below 90 also in the short term.
Okay.
But because that inflation differential still would remain, over the more medium term, it's more difficult to be having on that appreciation bias path for very long. So we'll revert back to a more normal kind of depreciation path is over the medium term.
Okay. Not much time left. Mridul, what is your best guess on, the changed CPI and the changed GDP series? Are you expecting inflation to go higher and growth as well to be marked higher? And a related question, do you think we are out of that low nominal GDP period? So two questions. What is the impact on inflation in the new series? And are we out of the low nominal GDP period?
So let me come to inflation first. I think clearly what we know as of now is that the weight of food in CPI has come down to 40.1%. And that would cushion some of the inflation pressures on the CPI, but that could get nullified because basically now new quotes which they will get from new places and the new commodities could sort of put a little bit of upward pressure because the earlier series would have more older quotes which generally don't tend to rise. So we need not expect too much of changes in CPI. Maybe marginal upside pressure could be witnessed when the numbers come out, but that's just my guesstimate. I don't know the numbers.
Okay.
And also on the GDP front, while we could see an upside of maybe 0.2 or something at the best, but we also have to recognize that double deflation may come in the manufacturing, which will put a downward bias. So there are offsets in this.
Okay, let's see. We'll have to wait and see. I'm sorry I'm out of time. We should have a longer discussion when we get the new series. Devang, only a one-word answer. What's the range for the 10-year up to March 31st?
660, 680.
Oh, that's a wide range. Thank you very much, gentlemen, for giving us your views about the monetary policy and how money markets and currency markets may trend in the near future. We have to get into a break. Thereafter, we speak to the country's biggest banker, Chairman of SBI, Mr. C.S. Sethi. Welcome back to our special monetary policy show. And now I have with me the country's biggest banker, the State Bank of India chairman, Mr. C. Sethi. Mr. Sethi, thank you very much for sparing time on a very busy day for you. Well, my first question to you is, do you see any big recovery in the market? The governor has actually pushed up the growth forecasts in the old series by 20 basis points. Are you getting a sense that we are on the throes of better growth?
First of all, thank you, Lata, for having me on your show. And the growth, upsizing the growth rate, as well as the fact that the governor has indicated we are in a situation where very modest inflation backed by a good growth rate is a very good situation to be in. And the numbers, what RBI has also given in the last fortnight, indicates that the credit growth rate in the system is progressing well. And I think it's very positive feeling of what we are all getting in the economy.
Okay. He also did not give any relief to people who were expecting he will do a VRRR, a variable rate reverse repo. At the moment, the call rate and the TREPS rate is almost 1 percentage point below the repo rate. Any response to that?
So the governor was very clear that preemptive, he has used the word preemptive liquidity support will be given. I think I latch onto that word and would go by his promise that the sufficient liquidity will be there in the system. As we speak, liquidity is surplus by almost 3 lakh crore. And if that liquidity support is available, and which is required in this particular quarter, as you know, Q3 and Q4, generally the banking sector witnesses very good credit growth rates.
Yes.
And this time around, we are seeing continued credit growth rates which are robust in the system. So which means that sufficient liquidity support in the system is extremely critical. And the very fact that the governor really clearly mentioned that preemptive measures will be taken to provide liquidity is a very good positive development for us.
All right. The other thing that bankers wanted was that either the new LCR regime be advanced or that your CRR be counted for LCR, simply because some of the private banks don't even have any extra bonds to give it to the Reserve Bank for a repo. I mean, is that a disappointment that they have not allowed it to count your CRR towards LCR?
So the last CRR cut anyway was there, and we had got benefited. The full benefit of LCR cut was available by November end, right? So any measures in terms of LCR issues also on account of the ability of the system, going to our willingness to go to a high cost deposit is also pushing up. In the system, Lata, I don't know whether you applied your knowledge towards that. There's a lot of differential interest rate deposits happen in the system, the wholesale deposits, what we call.
Yeah.
And many of these deposits have high runoffs, while you pay higher rates, and the runoffs are higher, which means that you are spending on acquiring these deposits, but you are not getting the benefit of the LCR. And that is the conundrum many of the banks are facing.
It's true.
That is also one of the reasons why the banks are accessing the certificate of deposit market, because that would augment their LCR. So we will see, I think, if sufficient liquidity is provided. Yes, unsecured market is limited for the bank borrowings, but eventually the retail deposit mobilization is critical. And the banks have to definitely focus on retail deposit mobilization, while there are competing investment opportunities. But I think we can further strengthen engagement with our customers.
No, I agree. The tax is also not working in favor of term deposits vis-a-vis, say, equity mutual funds. I take a point on that. But the governor was very forgiving of high credit deposit ratio. He said, I don't care whether it's 80 or highest in many years, so long as banks maintain LCR. Does that come as a relief? Any reaction to that statement?
In fact, this is something what I did mention earlier also, that I think undue focus on LDRs is not an appropriate one. Obviously, the banks, you did ask me in one of the interviews that whether there is a structural shift in the way the bank balance sheets will be funded. Yes, there will be a reversible structural shift. As the market instruments are gaining ground, the banks have to structure in a manner that you can't finance your asset side purely by deposits on the liability side. Which means that while the fundamental requirement of the RBI would be that whether the bank has sufficient liquidity. As long as the liquidity is there, and where does this liquidity come from? I think we should be leaving to the bank boards and the management.
Okay, fair point, sir. There is this very good, or I don't know, whether, depending on which side you are, that customers losing money on fraud up to 25,000 will be, compensated by the fund, and the banks will take 15% of the hit, and the borrower takes 15% of the hit. You see that as an extra expense coming your way? People could be gaming the system.
First of all, I would like to say that SBI always has been the customer side. So we are both on the same side, Lata. The customer protection for RBI for ages has been one of the major priorities, and particularly this governor has been giving a lot of importance in terms of customer service as well as customer protection.
Okay.
And as a lot of digitalization has happened and the payment systems have become very strong and people have started using, today almost 70 to 80% of our transactions happen digitally. And if you consider the whole alternate channel mechanism, if for a bank which has got 23,000 branches, even then 98% of the transactions happen outside the branches, which means that the customer protection becomes extremely vital. And in this process, while the digital adoption has increased, digital financial literacy is very weak. In the process, I think one is the increased financial literacy on the digital front, and combined with some compensation mechanism, we have to see the guidelines, what eventually will come and what circumstances compensation has to be given. But I do not see it as a cost increasing measure, but I think it's more in terms of protecting our customers and also increasing the responsibility of the whole financial ecosystem to see that the customers are always protected.
Okay, thank you very much, Mr. Sethi, for joining us in this very important monetary policy analysis show.
Thank you, Lata.
Well, that's it on this monetary policy special. Thanks so much for watching.
with great pleasure, let's welcome the Chief Economic Advisor, Anantha Nageshwaran, here to the budget verdict. Mr. Nageshwaran, many thanks for joining us here on CNBC TV 18. And here's a fun fact for those of you who've been following the CA and his economic surveys. He's presented 2. This was his 3rd one. And there's been a lot of convergence between what the survey has prescribed and what the budget has taken forward. So as I told him yesterday, he delivered a hat trick. So Mr. Nageshwaran, 4. So let's start with that. As you put the economic survey together, and in your own words, this was longer than usual, 730 pages at that. How did you identify the areas that you believed would need to be prioritized by the government, and then they found their way into the budget? Take me through the process of putting together the economic survey, the rationale behind identifying the sectors that you chose to prioritize.
Thank you, Sharon. Happy to be here, and thanks for having me. The selection of topics actually is sort of a year-long process. From the time the survey finishes the year before, whatever keeps happening, and we kind of store it in some sort of accumulating both the empirical developments, data, and everything. But the choice of topic for prioritization, as far as this particular survey is concerned, I am referring in particular to chapter 16, because the rest of the many of the other chapters kind of choose themselves. They are part of the routine. What requires deliberate decision making are 2 things. One is what are the special essays we focus on, and the other one is global development. So this time global developments played a very big role in the choice of chapter 16 to be added, and that too in 2 parts. And urbanization, I think, from the way we see traffic flows and quality of life, pollution, etc., we decided to take it up. And AI, I think, because we wrote about it last year, and much has happened since then, we felt it is important to keep track of it and keep updating the country with these developments, both macro as well as on the computing side, etc. So that is how the topics end up getting chosen.
You said that, of course, the global mix was a significant aspect of what the survey has dealt with, and how India must prepare itself for future challenges as well as possible shocks. But let me address an issue that is now starting to sort of get a lot of attention, and I think in a way you also highlighted that in your survey. Ridham Desai on CNBC TV 18 earlier today said in the last 30 years of tracking the markets, he's never seen this kind of dissonance between the macros and the markets. The macros are stable as they are, and the markets underperforming. You've also, in a different way, asked for an examination of the investment reluctance that is at this point in time visible when we talk about FPI flows or we talk about FDI flows. How would you address this dissonance that we're seeing between very stable and strong macros and weak markets at this point in time?
So there are no clear-cut formula, a mechanism to address this, because at some point, because there have been occasions not just with reference to India, but with other markets as well, when they have decoupled briefly for specific, it could be specific stimuli that markets are focused on, which is not coming, or because of global developments, or a combination of the 2. But over time, they do sort of fall in line together. So right now, I think the concerns leading up to the economic survey and the budget that the markets were looking at were possibly, valuation concerns, and mainly because of the FII net outflows, which in turn was based on the fact that the tariff matter uncertainty with the United States was lingering, apart from concerns about the fact that India didn't have a specific or few AI plays in the stock market, and then whether the tariff would have any impact long-term on China +1. And also the concerns with respect to H-1B and other noises coming from United States on even the services sector. So these were the question marks that people had. And also I think we had specific sector, specific concerns on IT sector, etc. in India. So there are multiple factors. I am confident that over time this divergence between the 2 will close, with the markets kind of recognizing that the India story hasn't been derailed because of these developments. That is how I see the divergence closing.
Speaking of global developments, Mr. Nageshwaran, and I want to understand from you if, how you're seeing this business about a new Fed chief in place and the possibility of now the Fed's balance sheet shrinking or being cut. We've already seen a significant amount of volatility in the commodities market on account of that. What do you foresee as a result of some of these developments as and when they do take shape? Because, we still haven't seen the change or the changeover, and there's a question mark even on the changeover itself. But, the likelihood of a taper tantrum, is that a significantly high possibility at this point in time?
A very fast set of questions, Shireen, but the range of questions, the number of questions we have is so wide that any answer I attempt to give will be very speculative in nature. Because we know from his previous writings, etc., that Mr. Vash had a different view on quantitative easing, ultra-low interest rates, etc. But he and all of us are facing a very different environment and a very different relationship between the executive and the central bank, etc. So I think it will be premature to speculate on what stance would Mr. Vash adopt, etc., and what kind of implications would it have on the dollar. Right now, I think the markets have reacted to his appointment based on what they recall from his writings post 2008 in 2011-12 period. But we simply have to wait it out. There is no point in, because there are multiple pathways to speculate on.
No, absolutely a fair point that you make there. But, how do you read into the implications of this new world order or this new world disorder, depending on how you see it? What could the implications be in the near term?
So the problem is not that there is a new world order. What we know for sure is that the old way of looking at the world or functioning has been disrupted, and a new one is yet to emerge. That is why the entire set of confusion and uncertainties, because we are in this interregnum between two world orders. My suspicion is that this will continue for quite some time. So that is, in other words, while we often say that change is the only constant or the only certainty is uncertainty, I think that is what will be with us, not just for 2026, but for a few years before we are able to settle on a new order, whatever that might be. But I think we have to accept the fact that the so-called interregnum will not be as short-lived as we would like it to be.
If it's not going to be as short-lived as it's likely to be, and I think the budget in a way sets out the framework of the choices that India will need to make, some of the choices that you spoke about in the economic survey as well, the sectors that we will need to fortify, so to speak. In your assessment, how ready are we today to face some of those challenges?
So there is no yes or no answer to that. We are getting ready in many ways, and to some extent the budget pushes that agenda or progress in getting ready to face this world forward in quite a few ways. Whether it is in the rare earth corridor matter, whether it is in trying to achieve certain self-sufficiency in key areas, including medicines, chemicals, and then giving exemptions for capital goods involved in the nuclear power generation, etc. If you think about it that way, these are all in line with what we wrote about in chapter 16 of the economic survey, where we said you have to look at the scope for indigenization or self-sufficiency in a 2x2 matrix between feasibility and desirability or necessity. That is exactly the kind of approach that the budget has taken. So it is not a question of saying country A is ready and country B is not ready, but I think it is a process. And I think what the budget signals unmistakably is that we are well cognizant of the need to undertake this process and the journey, given the state of potential disruptions to supply chain, either due to logistics difficulties or as conscious choices made by nations, etc. That therefore this budget is a sort of a advanced preparation exercise for that.
And just to take that forward, I'm trying to understand if there has also been a shift, a nuanced shift in the way that the government is trying to address the issue of how the private sector is going to deal with some of this. I think the government, and you've been pretty vocal about it as well, has done the heavy lifting when it comes to public capex. The government has put corporate tax breaks on the table. It's put PLI incentives on the table and plenty more. But the ask is from the industry is more R&D subs, for instance, which the government has stayed away from. Is there now an increasing understanding or an acknowledgement within government that incentives per se or incentives by themselves cannot get industry to invest more in setting up fresh capacity and so on and so forth? That is to be done by demand. And so by giving more incentives, you may not necessarily get private capex moving.
I don't think this is articulated in that fashion quite as you put it. But nonetheless, you are right broadly that the reduction in the corporate taxes in 2019, along with the choice given to them to shift to a lower rate with fewer exemptions, and the fact that we have already implemented the suggestions with respect to the Anusandhan National Research Fund and the Research and Development Innovation Fund, spanning the TRL level entirely from 1 to 9. So there have been a lot of action on the part of the government in putting the money where its mouth is, so to speak. And if you look at the corporate sector's profitability recovery post-COVID from the lows of the second decade has been very impressive. So it is not for lack of resources. And the more important thing, again, taking the cue from what you said, ultimately corporates invest on the basis of demand, and therefore the direct tax relief last year, a substantial one, and the indirect tax relief later in the year, they are attempts on the part of the government to ensure that policy is doing whatever it can to create that demand certainty. So to an extent, I understand that the private sector is concerned about the global uncertainties, supply chain disruptions, competition coming from another country which is suffering from very weak domestic demand and therefore substituting that with external demand by exporting, and therefore how profitable will my investment be if I create domestic capacities, etc., is a valid question. However, what I see from bottom-up data is that in 24-25 financial year, the corporate sector's investment performance wasn't particularly bad. I think 23-24 was a disappointing year. I think my analysis based on bottom-up data will be borne out when we see the full year disaggregated data coming from MOSPI later in February. So there are some legitimate concerns and questions that the corporate sector has, but we have to appreciate the fact that we are living in a country with a 60+% private consumption ratio as a percentage of GDP. And the more we postpone these investments, the questions become bigger and more pressing rather than going away, especially since I said these question marks will be with us for a few years. They're not going to dissipate. I think the corporate sector has to say that sometimes the answers to these questions will be found when we actually confront them, not by ducking them.
Chief Economic Advisor Anantha Nageshwaran, many thanks for joining us here on the CNBC TV 18 Budget Verdict, for highlighting for us why this budget will make a dent as far as India's aspiration to move up the value chain across many sectors.
Nirmala ji, thank you so much for giving us the first exclusive interview after the budget. You've been very kind to us every year, and thank you so much for that. Millions of people are watching you across India through CNBC TV 18, CNN, and our News 18 channels across the country. First of all, congratulations on what is your 9th consecutive budget. No other FM has done it consecutively for so many times. I think it has also been a period which has been marked by a lot of turbulence. You've seen it all. You've seen the pandemic. You have seen some shooting wars and now tariff wars. And through it all, you have steered the economy. I think if you look at the bigger picture, a job very well done indeed. You know, it is one of the fastest growing economies in the world, any consequential economy in the world. You know, you've managed to keep fiscal discipline under check. You've also kept inflation well below 2%. So the big picture really looking good. I'll ask my first question, which I always do when I start. You know, if you look at the reactions of the budget, some people have called it a status quo-ish budget. People have called it a conservative, cautious budget. How do you react to this, you know, people saying no bold reforms this time? Of course, much is there in the fine print, and it is all coming out. The markets have, you know, come back today. What was weighing on your mind when you were preparing this budget?
Well, as was observed by you and by domain experts, not just in India, even outside, Indian economy's fundamentals are absolutely strong. It is the global uncertainties, which of course always every government has faced global uncertainties of different order, different level. But now the extent to which global uncertainties are bearing on countries and impacting decision making is of an order that we have never seen before. So certainly we had to keep that uncertainty in mind and plan for what is going to happen this year and what is going to commence in the next 5 years from this year. In that, a new finance commission cycle starts. And above all, like the Honorable Prime Minister said, this is going to be the first budget in the second quarter of 21st century, which is up to 2050. Yes. In between, closer to 2050, is 2047, when Vikasit Bharat will have to be achieved. So our direction, our goal are all set. So it was for us to, keeping in mind the global uncertainties, plan for 1, for this year, 2, for the entire finance commission cycle, and 3, leading up to Vikasit Bharat, how do we want to take them? And that is why, slightly differently from every other budget, this time a lot more was said through Part B.
You're projecting a nominal GDP growth of 10%. What is your outlook for inflation and your estimate for the real GDP in 26-27?
I think we've indicated it very clearly in the budget. I'm very sure that inflation will remain within the tolerance band, and therefore inflation doesn't have to worry us much. And everything therefore looks at it from the point of view of if there is a deflator which is going to remain low and stable, it will have an impact on your estimates.
Yes. Look, you know, if you look at the GDP growth in the last 2 quarters, 8% has been impressive. Do you think that we can sustain this like China did for many years, an 8% growth? Do you think India can do that in the longer term to be able to grow at the clip that we are hoping it to achieve?
Yes. And that is why the stability of the government and also the policy of the government matter.
Okay. And do you think, what is feasible for India, considering that the nominal GDP has been on a decline since FY22? So where do you see the nominal GDP going in the next couple of years?
I strongly believe once the fund flows come in, because all of the factors are strong, all of the factors have really been the strength of India. So your macroeconomic is, I mean, 2 days ago we had this news reports saying foreign exchange reserves have touched and crossed 700 billion.
Yes.
So you have every indicator doing well. So what is that one thing which can make a difference? That one factor which can make a difference, and this is common knowledge, is if there is more funds flowing into India, that itself will give us a big relief. And for that, those who went out also went out booking profits.
Right.
So India will have to draw a lot more funds for investments in India.
We'll come to fund flows in a little while. An interesting thing that I noticed, World of Statistics says that China contributes 26% of GDP growth in the world, global GDP growth. India contributes 17%. Right? So overall put together we are 43%. US has done a mere 9.9%. Elon Musk had an observation here. He said that the balance of power is shifting. Would you agree with that? And how soon can we close the gap with China?
It is the truth that China and India together contribute so much. That's a fact. For India to aspire to bridge the gap, yes, we have to work very hard. And there are sectors which will have to be given greater stimulus. Productivity gains will have to arise out of using technology. Our manpower should also get better deployed in the areas in which their skills lie. Yes, we have a lot of work to do, and we will have to do it. So, and that is where my trust and faith is. When the government is stable and when forward-looking policies are encouraged, we can still achieve it.
Stability has been your big message this time. You know, tax holiday for data centers has been a bold reform this time. What response do you expect from this? And would it also apply to Indian companies like TCS?
See, we are talking about global companies setting up GCCs.
Yes.
Global companies, if they are Indian in origin, will also have to have their profits and other things understood. Global profits made in India. And most of these global companies who are setting up business in India are already also paying tax. It's not as if they are not being covered by taxation for the earnings that they get from India. So if anyone who fits into this definition, not just this, we very clearly defined it. So referring to that definition, whoever fits in will get it.
So an Indian company like TCS might fit into that.
A global company.
A global company like TCS would fit in. You know, the one thing that you did this time, which you know, has become a subject of conversation, the markets also reacted, was increasing STT in the derivative segment. And I've heard the comments by your secretaries who say that it was to curb rampant speculation. You know, could it have been done differently, by managing margins or contract sizes? And was it a prudent thing to do at a time when, the global sentiment is the way it is and the markets are also on a weak footing? How do you react to this?
There are many observations that you're making on which opinions can differ.
Yes.
There are people who within India comment saying India's markets are overpriced. I'm not even getting into that debate.
Sure.
The Revenue Secretary made it absolutely clear. It is not for revenue considerations that we've done this.
Yes.
It's not on all STTs.
Yes.
We are only touching on futures and options.
Yes.
Cash is not even touched.
No.
So it is the speculative tendencies. And in fact, the Ministry of Finance has received several parents, elders who call us and say, are you going to sit and watch people lose money? And one of the studies showed that 90% of people who've gone into futures and options have lost money.
Yes.
Of course, the market regulator will also do his or her bit. The institution will do its bit. So we've only tried bringing in a deterrent where speculation is rife. We are not touching the market. Other STTs are not being touched.
No, thank you for that clarification. Let me ask you a slightly directional question. Whether it is long-term capital gains or short-term capital gains, in the last few years they have only inched up. When most of the other taxes have really gone down. So how do you, I'm asking you from a broader perspective, as the finance minister, how do you see this pan out over the years?
I don't agree with you when you say it's inched up. Yes, it has gone up or it is rationalized so that all asset classes can be treated equally.
Right.
And that's the logic and reasoning behind that particular rate change.
Right.
It wasn't done with an intent of earning out of it. But the disparity and the differential couldn't be sustained. So we had to rationalize it. And in fact, after that, we even gave that option to say, you choose which one you want to have.
Right.
I remember standing up during the government amendments time, the finance bill passing time. We brought in that flexibility to the people who felt that they were, shortchanged. So that was rationalization. That wasn't for kicking up the rates.
So you think that the current rates are comfortable and...
The stable approach towards tax incidence or keeping tax incidence stable has always guided us.
RBI has reduced benchmark repo rates by about 125 basis points since 2025. But the 10-year bond yields has increased, which means high borrowing costs. How do we tackle this? How do we reduce the cost of borrowing?
I think we are very conscious that yields are going up. Again, without shifting the blame or the responsibility, it is dependent on so many different factors. Yes, crowding in is one of the things on which the market gets heated up and yields can go up. But it's a fact that given the levels of developmental activities which all of us want to ramp up, both central government and state governments, going to the market is one way of raising your fund. But the yields going up also pushes back, and therefore people who want to look at better timing go back without raising the funds. So there is this concern, and that itself could be a deterrent for many states because they cannot afford it.
Yes.
So it's a very evolving situation. We'll have to see how it goes.
Okay. Finance Minister, your party has always stood for a strong rupee. But you know, if you look at the Indian rupee in the last 1 year, it's been on a losing streak. It's almost lost 10% against the dollar, around 16% against the euro. Are you comfortable with this level of the rupee, and are you happy with the steps that the RBI is taking to maintain it?
Let's understand one thing. Our party, yes, was in favor of and is in favor of always a strong rupee, no doubt. But it's also got to be predicated in the context of how the economy is. Economy suffering from high inflation, economy being fragile, and your rupee value also not in a good position, makes it really hard and difficult for everybody. But one thing I can clearly say is economy is fine and fit. Yes. Your macroeconomic fundamentals are strong. And that's not to say, look, therefore are you being indifferent to rupee-dollar exchange rate? I'm not indifferent. But I'll also look at it from the realistic challenges that we have to understand where rupee is finding itself now. Reserve Bank is closely monitoring.
So you are saying that you are comfortable with this situation at the moment?
I'm leaving it there. I don't think I will say I'm comfortable, not comfortable. I'll leave it there.
Okay. India's holding of US Treasury bonds have declined about 25% compared to the peak of 2023. At the same time, Reserve Bank of India has increased its holdings on gold. Do you see this trend continuing?
I think many central banks, not just Reserve Bank of India, are pitching to buy more gold, and India seems to be following the trend.
Okay. Gold is up by about 80%, silver by 250%. How do you see this in the last 1 year, this phenomenon?
The uncertainties in the world are making people to fall back on, let's say, time-proven asset, which is gold. And that's bound to be because it is beyond anyone's fair assessment to see where things will move, and therefore the demand for gold.
Okay. That brings me to the next point, which was also discussed a lot this budget. Capital gains on sovereign gold bonds purchased in the secondary market. Market participants feel this is some kind of a retrospective tax. Do you agree with that? What was the logic behind this?
No. The intent of that sovereign gold bond was at the time of the issuance and also making sure that you hold it the full term.
Yes.
So those are the two boxes to be checked. If you are doing one and not the other, you picked it up not at the time of issuance but from the secondary markets, one of the boxes not getting ticked, and therefore you're taxed. You bought it during issuance, but you're not holding it full term.
Right.
One box is not checked, so you're being taxed. It's only when you've taken it at issuance and you're holding it full term,
yes,
you get that concession. So every other, which there are only 4 situations, right? So the other 3 situations where both the boxes are not getting checked
is where you understand. You've set up a committee to review the banking sector. What will be the remit of this committee? What are the timelines that you are looking at? Could you give us some details?
I've not worked on the TOR yet, but the broad intent was that towards Viksit Bharat, there couldn't be better time for us, especially now when the bank's health is very good. We would want from that strength to understand where we can go and how do we go, which is the path that we take to go there. So that is where we want that committee to work.
You know, in the past you have been disappointed about private sector, capex not picking up. This has been, you've said it in a couple of meetings, you've said it in our interviews as well. Do you see an uptick now because of certain reforms that you have introduced?
I see some green shoots. I think it is the situation is improving, and I have reasons to believe that private sector investments will only grow.
When I was asking you about this bank committee, there are 2 questions that I have related to that. One is, are you looking at the consolidation of PSU banks? Some mega banks as opposed to a whole lot of PSU banks today. And the second, would you allow conglomerates, Indian private conglomerates, to get into banking?
That's for the committee to tell me. Of course, I've told you that the terms of reference is not made yet. But obviously, when you're looking at banking for Viksit Bharat, banking sector for a Viksit Bharat, there are many core such issues which the committee will have to look into. We'll wait and see what they have to say. It may not be right for me to give my view and preempt what they're going to say.
But about the PSU banks, directionally, are we in that direction? I mean, there are far too many of them, and a consolidation of some kind might lead to bigger entities which may be more viable.
Let's wait for the committee to say. There is a need for India to have more banks, better banks, bigger banks, whatever. The committee will have to have its mind.
I've asked you this question before, but India's trade deficit with China is greater than about $116 billion in 2025. Even though the exports have also gone up, how do you tackle this issue?
That is where I think we are very clear in Atmanirbhar Bharat. We need to have capacities built in India for those essential goods that we import and make sure that we are able to make it in India for Indian market. Even as I say this, we have not restricted the imports of some of the critical machines or equipments or some raw materials which are so important for our industries. So capacities will have to grow, but in the meanwhile you still need for those very same capacities imported equipments. So we are doing a fine balancing act in not denying the raw material coming or the equipment coming, because there are some precision tools which you so need when you're going to set up a particular type of factory. We need those to come in here. Sorry. But at the same time, capacities in India will have to be expanded, ramped up sooner, so that our dependencies can come down. But this story is one side of the coin.
Right.
The other side of the coin is market access in China. I was Commerce Minister, and I know in my time also we've been asking for greater market access for Indian goods.
Right, in China.
That is moving very slowly.
So now that the relationship with China is improving, would you consider relaxing restrictions on investments by China through Press Note 3? That would really take the relationship to the next level.
Well, some discussions were happening. I'm not sure where it is reached as yet. Once we arrive at something, I'll be able to expand on it.
Sure. Nirmalaji, disinvestment target is something that is missed almost every year in the last few years. This year also you've taken an ambitious target of 80,000 crore for the coming year. How is it going to be achieved? I've heard, your press conference where it was discussed about IDBI. But what about Shipping Corporation, BPCL, BMEL, Container Corporation, and so on? Can you give us some broad roadmap on the way
I'm
forward?
not repeating my answers, but I also want to underline the fact that when government has decided in the cabinet that a certain number of disinvestments will have to happen, it's a duty to honor it.
Yes.
We will never be able to bypass it and say no, unless the decision itself is changed by the cabinet, and no decision has changed till now. Earlier it was, at least a few years ago, it was COVID affected market, economy reviving market, so we had to be cautious about going to the market when it is not so suitable and so on. But I'm very clear that I will be focusing also now on disinvestment, having given quite a few concessions in direct taxation, having been given in GST indirect taxation. My revenue also will have to be looked at from the point of view of what I'm going to get out of disinvestment. So it's not to say that I didn't give the attention earlier, but the earlier attention was circumscribed by the fact that we were facing COVID, or we just came out of it, or the situation in the market is not. And some sectors do well, and therefore you can take them forward faster.
Yes.
Some others take their own time. But we will be going ahead with.
This time it's a very decisive mandate to go for.
That's right.
And you're very confident of achieving the number as well. Thank you so much for taking so much time and answering all our questions. It was indeed a pleasure talking to you. Thank you, and look forward to the next interaction.
Thank you very much.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The Reserve Bank keeps the repo rate unchanged as expected, maintains the neutral stance. Governor Sanjay Malhotra reiterates the Goldilocks scenario for the Indian economy. RBI hikes its forecast for growth and inflation, expects GDP growth for this fiscal at 7.4%, projects inflation to cross 4% by October this year. Sovereign bonds decline as RBI refrains from fresh debt purchases. The rupee weakens by 30 paise against the dollar. RBI plans a framework to compensate customers impacted by digital fraud for up to 25,000 rupees, also doubles the limit of collateral-free loans to small businesses to 20 lakh rupees, allows banks to extend finance to real estate investment trusts. Sensex and the Nifty end higher for the second straight week. Mid-caps outperform, but IT stocks get battered. The Nifty IT index is down 7% this week. The tech rout on Wall Street keeps the markets jittery worldwide. Amazon pledges $200 billion, taking the total proposed spending on AI to a whopping $660 billion, including Google, Meta and Microsoft. Gold and silver prices remain under pressure. Bitcoin attempts to recover from a 16-month low. The proposed trade deal between India and the US will not include rice, wheat, soya, corn, sugar and dairy, according to government sources. Commerce Minister Piyush Goyal expects a joint statement and tariff reduction to 18% by next week. Civil Aviation Ministry informs the Parliament about repetitive defects in 50% of the 754 aircraft analysed across airlines in the last 13 months. 82% of Air India's aircraft, 37% of Indigo's aircraft analysed were flagged for recurring defects. However, the government does not specify whether these repetitive defects are critical safety-related faults or non-critical maintenance issues. UPL, Dhanuka Agritech, Coromandel and Crystal Crop Protection likely to be interested in buying the India assets of US-based agrochemical company FMC. Sources say the deal value could be around $450 million after write-downs. That's an exclusive. US companies slashed more than 1 lakh jobs in January. The layoffs are the highest for a month in 17 years since the financial crisis. Transportation, tech and healthcare account for a majority of the job losses. After weeks of tension and posturing, the US and Iran hold first stage of negotiations to prevent a war in Oman's capital, Muscat. Iran calls for a fair and mutually satisfactory agreement on nuclear power. At least 18 people are dead after an explosion at a coal mine in Meghalaya. Authorities say the rat hole was being operated illegally in what is one of the biggest mishaps in the last 12 years. Well, let's go straight to the top story this evening. The Reserve Bank's monetary policy. The repo rate was left unchanged as expected at 5.25%. In fact, all 6 MPC members voted to pause the rates. Now, the RBI has also retained its policy stance. It stays at neutral, with only one MPC member, that's Ram Singh, calling for a change to accommodative. On inflation, the central bank has raised its estimate by 10 basis points to 2.1%. That's for the current fiscal. Projections for the next 3 quarters have also been revised higher, with inflation expected to cross the 4% mark by October. The RBI has upgraded its growth outlook, projecting GDP expansion of 7.4% for FY26. That's up from the earlier estimate of 7.2%. Governor Malhotra said India continues to be in a Goldilocks scenario where growth remains strong and inflation stays under control. Take a look.
We are certainly, in the same sweet spot, maybe even better, because growth is looking up. Growth is looking even better, and inflation is the same. Headline, one is looking at headline, 0.1, 0.2%, 20 basis points here and there is a very small number. Point number one. Point number two, it is headline. As mentioned in my statement, it is primarily to do with base effects. It is primarily to do with the volatility in the food prices, core inflation, underlying inflation, barring precious metals, is very benign.
Well, that is the RBI Governor on the Monetary Policy Committee's decision. Sovereign bonds declined after the RBI refrained from fresh debt purchases. 10-year yields rose to 6.75%, but the rupee weakened by over 30 paise against the dollar. That's where the rupee finally closed, 96.5, and that's the bond market action for you. The rupee has strengthened by nearly 1.5% this week against the dollar, boosted by the India-US trade deal agreement. The governor said the central bank is concerned about any undue and excessive volatility in the rupee, but he also added that the RBI is not targeting any specific levels. Let's go across to Lata now. She joins us to take us through what she made of the commentary that came in from the RBI. Lata, no major surprises from the RBI itself in the policy, but what do you make of the commentary?
Oh, yes, it was most status quo of policies. As you say, neither the rates nor the stance has changed, but that was as expected. The point is the governor seemed to even hint that there is a long pause. That is, the repo rate may remain at 5.25 for a long time, because he said the positive real rate is in accommodative to neutral territory. What it means is repo rate minus inflation. Should repo rate at 5.25, inflation rate, the forecast is around 4.5%. So the difference or the positive real rate is around 1 to 1.5%, which is the neutral rate. All this explanation was giving the impression that he's not going to change those rates anytime soon. All that was like on expected lines. But what was surprising was at the moment, there is a lot of liquidity in the system. So the call rate is often a good 0.5% below the repo rate, the one-day money. The Reserve Bank governor did not really address it, saying that broadly, it encourages transmission. That made mutual funds very unhappy because they are the people who put the money in what is called the TREPS market. And there they are getting only 4.25, where they were expecting 5.25. So they are unhappy, the banks are happy about it. But the point is the governor did not give a reason why he is not doing the, variable reverse repo rate, VRRR as they call it, to pull out the excess money. So mutual funds are unhappy. The other place where he did not commit at all was on the dollar rupee. The usual statement that, RBI only intervenes for volatility, they don't have a level. He also said that in the long run, the budget has steps, insurance, 100% FDI has been allowed, GCCs have been given safe harbor. These are all known, but on a daily basis, FPIs are pulling out money and pressuring the exchange rate. There was no real help for the market to understand that part better. So that's why I call it status quo and how in terms of this policy. But to be fair, on the governor's side, he did say that, the borrowing program will be managed by proactive and preemptive provision of liquidity. He also probably is not committing either ways because there is a new GDP and CPI series coming. So therefore, probably was less committing or less revealing as to what the RBI's thoughts are. This policy is status quoist and how. That's the only way I can describe it.
All right, status quo policy. Lata, many thanks. The RBI, by the way, also announced a slew of measures aimed at protecting consumers, and we'll get you that in just a bit. But let's talk about today's market action. The Lal Street closing in the green after a volatile session, the Nifty ending above the 25,650 mark. The mid-cap index underperforming. FMCG stocks ended at the day's high, and IT stocks extended their losses, closing lower for the third session. So that's the Nifty. Flat but in positive territory. The mid-cap index closing just about in the red, and the bank Nifty also closing in positive territory today. For the week, the markets have ended higher. That's for the second straight week, with the benchmark indices ending 1.5% higher. Mid-cap index has outperformed and ended about 2% higher. That's the picture for the week. The realty index up almost 5%, and the Sensex and the Nifty closing by about 1.5% each. Now, the tech rout on Wall Street is keeping markets jittery worldwide. Amazon has pledged $200 billion, taking the total proposed spending to a whopping $660 billion, including Google, Meta and Microsoft. We're talking about AI spending. Rima is standing by to take us through the massive capex plans that these tech companies have put in place and why that's making the markets worldwide nervous. Rima.
First, let's get the numbers. From the start of this year, Microsoft is down nearly about 18%. Software companies, Palantir, ServiceNow, Salesforce, all down close to about 30%. And most of the slide happened this week. Now, what drove the correction? One, the fear of AI. Not what AI is doing today, but what it can do tomorrow. So Anthropic Claude's plugins show that AI can now do sales, finance, legal, analytics, without the traditional software layer. So investors are now questioning the business model, the operating model of software companies. And secondly, the capex numbers. Now, Amazon's $200 billion capex spend guidance for 2026 spooked the market. And to put it in context, just these 4 big tech IT companies are going to spend $650 billion potentially in terms of an AI capex this year. Is this money going to generate ROI, or are big tech companies perhaps stuck in a game where they need to spend just to survive? For Indian IT service companies, the impact is second order, but it's real. For one, the fear is of greater revenue deflation. 2, client decision-making gets delayed. What happens to the expected FY26 earnings recovery? Does that slip further? And will IT companies, especially the large IT companies, get stuck in this mid-single-digit kind of a revenue growth rate trap? But here is an interesting counterpoint. Cognizant CEO exclusively spoke to CNBC TV 18, and he said AI won't magically plug into enterprises and create value overnight. That has never happened with any technology. AI is a contextual technology. Value only comes when it's grounded in enterprise workflows, processes, and operating layers. And there is a need for IT services companies to act as a bridge between models and enterprises. Brokerages, though, remain a divided house. Now, Kotak says it's plenty of panic over a little flutter. So they're arguing that the reaction was actually disproportionate. The risk stems from the future unknown breakthroughs rather than proven impact today. But Jefferies, on the other hand, is a bit cautious. They believe that currently there will be some more growth pressures. Valuations could correct. There are downside risks to valuation, which is why they have a selective stance. But the pressure that we saw in the Indian IT companies came in from overseas. Nasdaq sold off about 6% in a span of 3 days. But just to put it in perspective, over the last 3 years, this is the kind of rally that we've seen in mega tech companies. Nvidia up nearly 1,500%. You had a 3,000 plus rally on Palantir, 800% on Meta and Broadcom. So just to put the kind of correction that we've had in context with the kind of rally that we've already seen in the last 3 years.
Well, it's important to put that in perspective. Rima, many thanks for joining us. And let's shift focus now to the India-US trade deal. Government sources say the proposed deal will not include rice, wheat, soya, corn, sugar and dairy. Commerce Minister Piyush Goyal said that he expects a joint statement and tariff reduction to 18% by next week. Abhimanyu standing by. Abhimanyu, the government trying to allay concerns on agriculture. What are your sources telling you?
Government sources have indicated that the India-US trade deal will not have any adverse impact on Indian farmers, since several commodities have been excluded from the ambit of the deal, which include wheat, rice, soya, corn, sugar and dairy. Also, government sources had indicated that India has committed to buying items from the US which are already imported from other nations, and India imports products like oil, gas, aircraft, laptops, smartphones and goods for data centers. India currently imports around $300 billion worth of products annually, which will now be sourced from the US as well. India expects to hit $500 billion worth of imports from the US in the next 5 years. It remains to be seen how early this growth is going to be achieved. Also, the Commerce Ministry has indicated that the first tranche of the BTA between both the sides is already ready, and they are hoping to sign a joint statement in the next few days. Also, a formal agreement is being drafted, which will be signed by the mid of March, possibly. It has been indicated by the Commerce Ministry that tariff reduction from the American side would take place, would be undertaken via an executive order once the joint statement is signed, whereas India's MFN tariffs, which currently apply to several American products which are imported into India, they would be reduced only when the legal agreement is signed. It remains to be seen how early all these processes are going to take place and how early the deal is going to take shape.
Abhimanyu, many thanks for joining us. Now, India's crude oil imports from Russia in the month of December fell by 33% compared to November. This as per the latest data. Now, Russia now accounts for less than 25% of India's overall oil imports in December. That's down from 34% the previous month. So as we've been pointing out, we have seen a consistent decline month on month of India's oil imports from Russia, and this number is likely to go down even further. Remember, President Trump has said that India has committed to buying zero oil from Russia and enhancing its import from the US. Now, we don't, of course, know the details of that, and the Indian government has chosen not to respond to that specific comment. Now on to aviation. Civil Aviation Ministry has informed Parliament about repetitive defects in 50% of the 754 aircraft analysed across airlines in the last 13 months. However, the government does not specify whether these repetitive defects are critical safety-related faults or non-critical maintenance issues. Madhiya standing by with more. Madhiya, take us through what the Civil Aviation Ministry is telling Parliament.
Well, fresh government data reviewed since January 2025 now showing that 754 aircraft across Indian airlines were analysed for technical issues. And what clearly stands out is that 377 aircraft, which is nearly 50%, were found to having repetitive defects, meaning the same issues were being reported more than once. Now, if we look at the airline-wise numbers, Indigo analysed 405 aircraft, of which nearly 36%, which is 148 aircraft, had repetitive defects. Air India is particularly notable here. 137 out of the 166 aircraft showed repetitive defects. That is over 82% of the aircraft that were analysed. Now, Air India Express had 54 aircraft with repetitive defects out of 101 that were analysed, and SpiceJet reported 16 such aircraft, while Akasa Air had 14. Now, the key issue here is lack of clarity. The government has not specified whether these repetitive defects are critical safety-related faults or non-critical maintenance issues. That distinction is crucial here. Critical defects are those that can directly impact flight safety. These include engine failures, landing gear jamming, flight control or hydraulic failures, faulty sensors, autopilot malfunction, or software issues. Experts warn that these kind of defects require immediate attention or grounding of aircraft because they can pose serious safety risks. On the other hand, non-critical defects are typically allowed under the minimum equipment list, or MEL as it is known. These often relate to cabin or passenger comfort issues such as inoperative in-flight entertainment screens, broken seats, or tray tables that we see very often on social media. There's damaged interior panels or minor cosmetic damage. While the numbers might look alarming, the fact that these aircraft are not grounded yet and are flying indicates that these defects, even though repetitive, could not be alarming.
Well, we certainly hope so, Madhiya, and we would wait for the government to clarify. But many thanks for joining us. Back to the Reserve Bank's policy. The central bank announced a slew of measures to protect consumers, including a 25,000 rupee relief for those that have been hit by digital frauds. Ritu standing by with the details. Ritu, what is the central bank saying?
A whole bunch of measures aimed at consumer protection, starting with a draft guideline that RBI will issue on mis-selling of financial products and services by any bank or NBFC. Number two, when it comes to recovery agents and their treatment of consumers, where we've heard all kinds of stories, there again, RBI is going to review the rules and harmonize them across various categories of lenders. Number three, it is also going to issue a framework to limit the customer liability when it comes to fraudulent transactions. So for small value fraud transactions, RBI proposes that customers can be compensated for up to 25,000 rupees. It will also issue a discussion paper to introduce safeguards when it comes to digital transactions. So for instance, it could introduce lagged credits and additional factors of authentication when it comes to transactions by senior citizens. Now, apart from these, there were other non-policy measures as well. For instance, RBI is now proposing to permit banks to extend finance to REITs. It is also going to enhance the limit of collateral-free loans banks can give to MSMEs from 10 lakh limit currently to 20 lakh rupees. There will also be exemption for certain NBFCs that are not consumer facing and that have assets of less than 1,000 crore rupees. They will not be required to register with RBI. And lastly, for certain categories of NBFCs that are lending against gold collaterals, they will now no longer require RBI permission to open more than 1,000 branches.
And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We're back in a minute with more.
Hello and welcome to Startup Street. I'm Arundhati Ramnan, and with me as always is Shruti Mishra. These are the top headlines from the startup world. AI voice generation firm 11 Labs is now valued at $11 billion after raising $500 million in its latest funding round. The latest round, led by Sequoia Capital, more than triples the company's $3.3 billion valuation from January 2025.
AI-enabled NDT robotics startup Octobotics has raised around 10 crore rupees with a seed round led by Navam and BYT Capital. The proceeds will be used to accelerate product development, strengthen field validation, and support international expansion.
Marine robotics startup iRov raises 13 crore rupees in a pre-series A round, co-invested by AWE Funds and Unicorn India Ventures. Funds raised to be used for R&D and new product innovations. Startup recently bagged an order of 47 crore rupees from the Indian Navy.
E-commerce giant Nykaa has reported a strong set of numbers. Revenue grew more than 20% for the 13th straight quarter. The company also reported its highest ever margins. Nykaa's beauty segment drove growth, with losses narrowing in the fashion segment.
The European Union has accused TikTok of breaching digital rules over addictive design. Features such as autoplay and infinite scroll. EU regulators said the app failed to properly assess risks to mental and physical health, including children. The European Commission said TikTok should change the basic design of its service, which the company denied.
Well, those were the headlines we've been tracking for you this evening. Recently, the Supreme Court delivered a landmark judgment declaring menstrual health a fundamental right under Article 21, directing states to ensure free sanitary pads, functional toilets, and dignity for millions of school-going girls across India. As policy finally catches up with a long-ignored reality, India's women's hygiene market is seeing rapid innovation and scale. Today, we bring you one such company at the intersection of women's health, consumer brands, and profitability. Psafe, a women's hygiene and wellness brand, has raised $32 million in Series C funding from global healthcare investor OrbiMed while staying profitable at scale. So what does it take to build a profitable women's health brand in India, and what comes next? Joining me now is Vikas Bagaria, the founder of Psafe. Vikas, welcome back to Startup Street. Like I mentioned earlier, the Supreme Court has now ruled menstrual hygiene a fundamental right. How significant is this moment for companies like Psafe that have been building in this space long before policy caught up?
Shruti, thank you so much for having me again. Nice to see you here. Now, the entire universe in India who are working on the menstrual hygiene, they are so excited to listen to this verdict of Supreme Court. We have been working for so long. When we entered early 2017, the penetration was very low. It was like south of 20%. Now the penetration of menstrual hygiene is close to 30-35%. I think this will only help in companies like us and hundreds of people who are working towards period poverty and menstrual hygiene management. I think this is a great judgment where not only the schoolgirls, but I think we have to also work towards the young adults or the working classes, that if sanitary napkins are available to them. So absolutely excited to have this verdict so that we can work more on this.
All right. You've raised $32 million from OrbiMed. Break this down for us, Vikas. Where exactly will this fresh capital go? Is the biggest push offline retail, quick commerce, or brand building?
Now, as you know, that Psafe is, we don't call ourselves a D2C brand. We call ourselves an FMCG brand, where we are present where our consumers are. So we have been there across offline, online, and of course exports. But this particular capital, by OrbiMed will definitely help us expand our retail reach. We may go deep into a particular city if we are there for, say for example, 1,000 stores. But the universe is of 5,000 stores, so we will go and reach that 5,000 stores. We are present in almost 100 cities, so we want to expand that as well. Along with that, we haven't done much of a branding as such, so we'll be investing in branding, we'll be investing on manpower, because if you go GT and MT heavy pharmacies, we need more manpower, more soldiers on the ground. And of course, quick commerce, which is one of our highest category where we get the revenue from. Along with third party or maybe unicorn from Amazon and Flipkarts. So I think we'll be investing in all three categories, and branding will play a role.
So offline expansion is on the radar, and so is quick commerce. Picking up from what you just said, you're also, doubling down on quick commerce and marketplaces. Of course, quick commerce is becoming a critical channel for hygiene and wellness. So how is your consumer behavior changing here? And what does, quick commerce really unlock for a brand like Psafe?
No, last 2.5 years, I think Psafe has really grown on quick commerce. We are present in more than 4,000 dark stores across all the quick commerce players. And just take for an example, if you are traveling next day, it's an instant gratification for product which you want to consume instantly. So we have seen that between 9 a.m. to 11 a.m., people order the maximum toilet seat sanitizer on quick commerce. And if you have a surprise period, if you don't have your favorite products at home, you can call in, say, 10 to 15 minutes. So I think quick commerce has really changed how the behavior, how the consumer's behavior will go forward. Of course, we do have 3PL companies like Amazon and Flipkart, but I think quick commerce is a to channel for toilet hygiene, feminine or intimate care, which we offer. So I think we are very excited about it.
All right, very quickly, Psafe is doing 150 crore plus in annualized revenue, and it's profitable while being present in 23 international markets. Vikas, which geographies are driving growth, and what are the near-term revenue targets for you now?
Now, if you take India, we are almost present across India, but South India is where the maximum revenue comes from when it comes to online. Offline, we really have to go deep into South India. If you take internationally, Middle East and Indian subcontinent is a great market for us. We are very, very heavy in Saudi Arabia. We are present in more than 1,100 retail stores in Saudi Arabia. The growth will definitely come from North America as well. We are not present there. But in a real term, I'll say that not in the real near terms, but in next 3 years, we are looking at achieving a 500 crores of top line with of course EBITDA positive.
All right. With a global healthcare fund now on your board and strong policy momentum building in India, what does the next phase of Psafe really look like? Is it bigger categories, deeper science, or wider access? And which taboos are you planning to take on next?
No, definitely we want to go deeper into the geographies we are present in, the channels we are present in. Psafe is built for people to serve women health from puberty to menopause. We have been focusing on puberty so far. So menopause is where we want to get into it. So we are working towards that. And the taboo which we need to break is, of course, the perimenopause. Nobody talks about it. Indian women are aging slowly, and in the next 10 to 15 years, we'll be having a lot of women in the age group of 40 plus. So I think from puberty to menopause is what Psafe's story is all about. And we'll be definitely going and talking more on menopause.
All right. One final question, Vikas, if you would quickly answer in 10 seconds. Now that menstrual hygiene is a constitutional right, what's the one gap, policy or market-led, that still needs urgent fixing?
I think it's both. We not only have to solve for schoolgirls, we also have to solve for people who are in their working class or who are into villages, who are still using unhygienic products. So it's a great start that we are getting habituated. The schoolgirls will get habituated, but we have so many people out of schools and colleges, so we need to focus on them as well.
All right. On that note, it's time for me to wrap up this conversation. Many thanks, Vikas, for joining us on Startup Street today.
Thank you so much for having me.
And moving on, AI-led marketing and commerce platform Nitro Commerce has raised $5 million in a Series A round led by Cornerstone Ventures as it looks to build a full-stack growth engine for India's fast-expanding digital consumer economy. The company says it has already clocked 10x revenue growth, crossed $5 million in ARR, and is targeting $10 million within the next 6 months. Nitro is positioning itself as a serious alternative to the traditional ad tech duopoly. Joining us now is Umair Mohammed, the founder and CEO of Nitro Commerce, to talk about the raise and the road ahead. Umair, thank you so much for taking time out and being here with us on Startup Street. AI-powered growth platform for India's digital consumer economy. That's how you're positioning yourself, right? If you could take us through what you have on offer and sort of, that gap that you're addressing in the market.
I think, honestly, over the last decade or so, India's consumer economy has exploded, and we've been a party to that. But what was happening was that a lot of this was centered toward primarily two platforms. And if you ask any consumer brand today, These are the two digital mediums that have kind of, been the beneficiary of the digital ecosystem, the Meta ecosystem and the Google ecosystem. And we still saw an opportunity for a third player to come in and kind of aggregate the supply and demand. So a lot of this growth has come from SMB, and the government of India also is doing a lot of things to promote MSME growth, SMB growth, and so Nitro has brought in the supply and the demand together in a fully integrated AI-led platform that SMBs can easily access. So what that means for SMBs is that it opens up completely new advertising avenues for them to advertise to very high intent audience without shelling 35, 40, 50% in some cases of their P&L into advertising. And
absolutely. So helping them save some money there as well. And you've raised this $5 million in a Series A round. So what are your key priorities? You're looking at deeper AI and agentic capabilities, global expansion, enterprise partnerships. So where's the money going to go? What are you going to look for in the immediate?
I think partnerships for sure. On the supply side, we are building deeper integrations with our supply partners, that likes of Truecaller, PhonePe, Zomato, and Snapchat, for example. So we're building more deeper capabilities, integrations with these partners. But I think the primary focus area definitely would be agentic AI for us, where we believe that agentic AI will completely transform how advertising has been seen, or traditionally how advertising has been. So ads have traditionally been seen as very intrusive in nature, right? The fundamental nature of ad, and I think we can change it in a way that Instagram, for example, has changed it today. That you don't mind it because they're so relevant to you. They're sometimes so relevant that people say, "Oh, have they been listening to my conversations?" So I think that's the aim, that we can do that kind of personalization for majority of audience and make advertising. We can make advertising great again.
Sure. I mean, I'm always wondering how Instagram heard what I said based on the ads that I get. So we get your point there. But how do you sort of monetize today, right? Is it platform SaaS fees, ad spends routed through Nitro ads, performance commissions, or sort of like a blended model? If you could quickly tell us, because we're running out of time.
I think if you would ask this question to maybe a company in the United States, I think they would have a very clear answer. Unfortunately, the way Indian market has always been structured, it has to be a blend of everything. You have to earn certain commissions from you have to earn certain commission on the sales, incremental sales that you drive, and you have to also take a little bit of commission either from your partners across your advertising partners or your supply partners. So I think it's a blend of all of that. But rest assured, we are very, very clear that we will only earn from the dollars that we earn for our partners. So I think that's been the key for our growth, that we align our incentives to our advertising partners.
Sure. And you've reported this 10x revenue growth and hit $5 million in ARR in just 12 months, right? You've got this big target of hitting 10 million in just 6 months. How much of this growth is sort of coming from repeat enterprise clients versus new brand additions? And how sticky is this revenue?
Honestly, if you ask me this, when we started building, we did not realize, because it is said that when a product hit PMF, people start snatching the product out of your hand. And we saw that because this is such a massive need in today's ecosystem, that even while building the platform, there was so much demand. Even today, we have so many brands trying to onboard to Nitro, and we don't have the capacity to fulfill the demand. So honestly, we're very fortunate to be building in this space, because the demand is such. But if you ask me where the revenue is going to come from, I think overall revenue, about 65% of the revenue will come from the enterprise, the repeat, because they have the largest spending power. But we also see a very strong surge in India's SMB market, mid-market, which is going to drive about 30-35% of our growth.
Sure. And in 30 seconds, if you could tell us, you've launched this new 100 crore rupee embedded capital program, right? How many MSMEs do you realistically expect to fund through this pool? And what's the ticket size per brand that you're sort of underwriting for?
I think that's a great question, because every time we have internally asked this question ourselves, the answer has gone from, is it 100, is it 1,000, is it 10,000? Because the MSME growth is such, I'll tell you that even 10,000 is a very small number. But for us, this 100 crore just represents maybe 50 to 100 companies. And this is just a drop in the funnel. This entire market is 5 lakh crore. And I think with Nitro and its AI capabilities, we see ourselves as an enabler of growth, and capital is a very, very important part of that growth. So if you ask me, this 100 crore, I think 100 companies, but that is not even a drop in the ocean. It's such a big market that I think that this is going to, maybe the next time I'm here, we're talking about maybe 10,000 crores.
Absolutely. All right, Umair, thank you so much for joining us on the show, and we wish you all the best on this journey going forward.
Thank you so much. Thank you for having me.
Well, on that note, it's time for us to head into a short break. But coming up, beyond likes, reels, and endless scrolling, a voice-first social platform is building real conversations at scale in small-town India. Friend has already crossed 3 million users. Details on the other side.
Welcome back. You're still with us on Startup Street. In a digital world built on likes, follows, and endless scrolling, a growing number of Indians are looking for something far simpler: conversation. Friend is a voice-first social platform that's quietly building scale across small-town India, focusing on real-time interaction instead of content creation. With over 3 million users and strong engagement, Aishwarya Anand brings us the special report on how Friend is rethinking social media for Bharat.
When I log off social media, I still feel lonely. Every night I open my phone just because I don't want to feel lonely.
ऑनलाइन सोशल मीडिया काफ़ी क्राउडेड प्लेस है, पर फिर भी काफ़ी अकेला सा फील होता है.
What I actually want is just someone to talk to.
पूरे दिन doom scrolling करता है, but real connection का क्या?
I don't need more likes. What I want is real connection.
I don't just want to be seen. I want to be heard. What you heard just now is not from a dating app or a social network that you already know. This is from a space built for those who often do not feel seen online. This is Friend, a voice-first social network that is growing quietly in small-town India, where connection still means conversation over content.
Friend now has more than 3 million users, with over 60,000 people logging in every day. On average, users spend over 30 minutes on the platform, not scrolling, but talking.
On all social networks, below a post, below a short video, below, let's say, in the comment section, there were users trying to interact with each other, specifically in their vernacular language. And that was one of the eureka moments for us, that while everyone is creating a content social app, let's create a social app which focuses on interaction.
எனக்கு friend app இருக்குறதே தெரியாது. ஆனா என்னோட friend
I didn't even know the friend app existed, but a friend of mine, a boy, was using it. He told me, "You speak so well. You should try talking on this app."
மனசு ரொம்ப கஷ்டப்படுவேன். யாரும் பேசுறதுக்கு இல்ல, அப்படி தனியா இருக்கேன் அப்படினு சொல்லிட்டு.
He suggested it for times when I feel very sad, lonely, or have no one to talk to. I am a divorcee, so I don't sleep much at night. I just stay awake thinking. That's why he recommended an app specifically meant for talking.
ஆப்ல நமக்கு எப்ப தூக்கம் வரும், தூக்கம் வராதுன்னு நமக்கு தெரியாது. ஆனா இந்த நேரத்துல
when I tried it out, I really liked it. I haven't downloaded any other apps. This is the first and only one I have used. It is much easier to share things here than in person. In real life, if we see someone on the road, we won't talk to them. We judge them by their appearance first. But on this app, we are here specifically to talk.
டைம் வந்து போகுது. நான் ரொம்ப ரிலாக்ஸா ஃபீல் பண்றேன். நான் வீட்ல இருந்து பட்ட கஷ்டங்கள் எல்லாமே இப்ப நானே எனக்கு நான் ஹீல் ஆகிட்டேன். Even as the big platforms go vernacular, Friend is asking a different question. What if the problem isn't language, but how social apps have been designed till date?
Inside Friend, users don't scroll through posts. They enter one-on-one connect rooms, join group conversations hosted by RJs, or play social games like dumb charades, Ludo, and cricket. Users appear as avatars instead of photos, and tools like voice verification, video blurring, and KYC checks are designed to keep conversations safe, especially for women and first-time users.
In a lot of private conversations, especially the video conversations, we have this AI copilot which monitors the conversation without human intervention. The copilot will ensure that you are showing your face in the 90% of the screen, 100% of the time.
When it comes to Friend app, it gives more safety. Even in app, we can't take screenshot and recordings. There is like no such things. I feel more confident.
About 5% of Friend's users are paying customers, a strong conversion rate for a conversation-first platform.
People can do transaction of, let's say, as less as 9 rupees to as high as, let's say, 5,000 rupees depending on their spending capacity.
What does a sustainable Friend business model would look like in the next 5 years?
So right now we are at ballpark 50 million ARR.
Okay.
We are profitable. I would want us that in the next 12 months, we double it and cross 100 million ARR. So that's an internal target which we have.
The appetite for apps like Friend is not just coming from users, but also investors. Backed by the likes of Krafton, Elevation Capital, and India Quotient, and the revenues growing sharply over the last year, Friend is now part of a bigger shift, where India's next big social networks are being built far away from the metros. With camera person Gaurav Kumar, this is Aishwarya Anand for CNBC TV 18.
Well, time to take stock of all the deals from the startup world. According to Venture Intelligence, this week has seen a total of 16 deals worth $119 million. Some of the notable deals include AI-focused cybersecurity firm 63sat Cybertech that raises $27.11 million from RE Ventures. Climate tech firm Varaha bags $20 million from Westbridge, Omnivore Partners and RTP Global. The Whole Truth raises an additional $17 million in a Series D round from Peak 15 Partners, Z47, Sofina and others. And that's not all. Fashion-focused quick commerce player Zillow got $15 million from Peak 15 Partners, Chirate Ventures and InfoEdge, while Loop AI raises $14 million from Alumni Ventures, Based and Partners and others. This year has seen a total of 102 deals worth $750 million so far.
And with that, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
Without further ado, may I request the chairman of Reliance Industries, Mr. Mukesh Ambani, and the chairman and CEO of BlackRock, Larry Fink, to please join us on stage. Ladies and gentlemen, a big round of applause for the two leaders who join me in a conversation on what it will take to invest in a new era, the trends that will shape our investment choices. Mr. Ambani, Larry Fink, thank you very much, and welcome to a warm, sultry Mumbai from a very cold Davos, Larry Fink, where you were in the throes of conversation with world leaders about the world order or the world disorder. So let's get started with that. We're talking about investing in a new era. What are the changes that you foresee that will shape the investment choices, the investment decisions of leaders like you as we look at this new era?
Well, first of all, it's great to be here in Mumbai. It's great to spend time with my partner, Mukesh, and the entire Reliance NGO team. So it's a real honor to be here. Weather is nicer here than it is in Davos, and much nicer than New York, where I had our board meeting last week. So it's good to be here. You know, we talk about a new era to give people a foundational understanding where we are. As an investor, I don't look at any era. I mean, our job is to be having people focus on the real opportunities to invest over a lifetime. There's so much information that confuses people. Media talks about the moment, the velocity of money. And the reality is, for most people, they need to be in a position to grow with each and everyone's country. So when you think about the growth of India, it's not a quarter, it's not a day or a week, it's not a year, it's over a long horizon. And you could say maybe this is the era for India and over the next 20, 25 years. But if you use that as a foundational paradigm that we all want to think about, the era of India, forget about the era of investing for a second, but the era of India, the key for us, the key for BlackRock is to compel more people to understand what does that mean, the era of India, and how do you participate in it? What we've learned in the United States, for that segment of the population that had invested with the growth of America, they're far better off than those who just kept all their money in a bank account. Mm-hmm. And so the key is, if you believe in the era of India, forget about the era of India, investment, the era of India, which I believe in, we need to get more people investing alongside the growth of the country. And that's the role of the capital markets, that's the role of what we can be doing together. And to me, whether it's, you want to focus on AI, you want to focus on how we live, how we grow, how we educate ourselves, to me those are subsets of the era of India and the opportunity to be an investor alongside the growth of India. And to me, that's a compelling story. It's not about, about tariffs or President Trump or anything else that's top of mind. We need to be compelling people to think about the horizon of investing over a long period of time, to grow with the great companies of India, to be a part of that and to participate in that. And I'm absolutely convinced, if you believe in that, in the era of India, we need to compel hundreds of millions of Indians to invest alongside the growth of India. And that will actually transform India in so many ways, because as more and more families invest alongside the growth of India, India has less needs for the importation of capital. And I do believe the combination of importation of capital from foreign investors who believe in the era of India, but the fundamental foundation of any country is having the domestic economy being built on the back of retirement savings, on the back of excess savings, to invest alongside of that.
Well, thank you very much for those opening remarks. And, the era of India, says Larry Fink, that is certainly going to be one of the headlines that goes out this evening. But if I could ask you to explain to us what excites you the most about India. You referenced the tariffs and, we've had a deal with the US overnight. President Trump and Prime Minister Modi have signed off on that reciprocal tariff agreement. So the overhang has lifted at least on one aspect of that relationship. How crucial a development is that, and what excites you the most about India today?
Well, let's be clear, over 20 years it had no bearing. Maybe over the next 6 months or a year it had some significant bearing, but over time, the foundational issues of India, how it's able to leapfrog. I mean, you watch what has, over the last, I would say, since the era of the smartphone. And I think that's a pivotal point. 2012 was, I mean, think about your life before the smartphone here in India. But the beginning of the smartphone, the rollout of 5G, and how that transformed India in so many ways. When you think about how the Modi administration digitized the rupee and how it transformed commerce in India across the board. I am very worried about other countries. Even the United States is falling behind. We need to be digitizing. We need to be thinking about how this all plays out. I think this is part of the democratization of India, and so now India is a leader in this. And so I can cite many things that give me optimism, but the fundamental opportunity is the huge intellectualism of India, the transform what technology, whether the technology was created in the US or somewhere else in the world, the dispersion of that technology in India is really what is so inspiring, and the utilization of the new technology for more and more people, and how that transforms commerce, consumption, information, education, all of that is ripe for real solid growth. And I agree that India has, over the next 10 plus years, it's going to grow anywhere from 8 to 12%, probably hovering around 8 to 10. And that's a place where I want to personally invest in, and what we need to do is compelling more Indians to invest alongside that growth.
Well, we certainly hope that more Indians are going to be investing in that story as well. And speaking of one such Indian, Mr. Ambani, let me talk to you about Larry Fink's phrase of saying that this is the era of India. Now, you've seen India over the last 2 decades transform itself in many, many ways, especially as far as the digitization era is concerned. Specifically, what excites you? What is compelling about the India story today? How have you seen it being transformed?
Well, Shireen, before I answer that, let me warmly welcome Larry, and I'm grateful to Larry to again come back to India. It was a conversation that we had in 23, and it just took me 5 minutes to saying, Larry, BlackRock should be back in India. And he said,
that's all it took, 5 minutes?
Will you partner me?
I think it was less. It was a car ride. We had to go to point A and point B, and we accomplished it in a car ride.
In terms of, here you are with your full team, and we have launched the business. So thank you for again coming back to India, and India warmly welcomes you and your colleagues, and to all my colleagues from the industry and the financial community, a very warm welcome. And we look forward to working with each and every one of you. As Shireen said, I think that, Larry, there is an old Indian saying that a tree only attracts attention if it bears fruit. And today, in this new era, as you described it, India and the tree of the Indian economy is bearing fruit with great visibility, with sustainability and abundance. As everybody said, right, we are confident, like we are the largest growing fast economic growth in the world. 8 to 10% is possible and doable, and I think that sustained double digit is not ruled out. So that gives us and that is why we are, after a long time, attracting all this attention. And this has happened primarily because I think that the last 10, 15 years, right, We had 2 successive periods. We had 10 years of Manmohan Singh, where we focused on growth. And then we were very lucky to have now consistently 15 years of very stable leadership. So stable economic leadership defines a country. And I think that we have to be thankful to Prime Minister Modi for giving us this stability now for like going in, by 2029, it'll be 15 years. Yeah. I also think that we've got what is different about this is we've got a very clear goal. A goal in terms of saying we have to be developed, Viksit Bharat by 2047, which every Indian aspires to and has started believing in. Second, we've executed at scale, right? While as Indians, we like to criticize ourselves, and we are not, and it's a good thing in a democratic mindset, but if you see, we've built more roads in the last 15 years than any other, like multiple times than any other country, including the United States at its peak. We've built like power capacities. We are now the leading renewable power producer in the world. We've built in our own industry digital capacities, 5G, that is better than most people in the world and cheaper than most people in the world in terms of what. And now every Indian village has got 5G. So, and I can go on, like we built the same thing in terms of infrastructure, the roads that you see in Mumbai. For a long time we said that we will connect Mumbai to the mainland, and we now have the bridge that is running. So we've executed. We've also had policy which is sustainable. So even when you see between governments, right, we all thought that Aadhaar was the earlier government's piece. I think this government was wise enough to saying we've had continuity in policy at all times. In terms of that, we've had stability, we've had predictability. We've also been conservative. So as Indian successive finance ministers, we've always maintained our debt in order. Relative to global debt, we are still 50% of GDP as debt. So we are not, like the world norm is now 100%. So we've had, and I think that we've also in the private sector, and what excites me the most is the startup industry. When I interact with startups and we see young 28, 30-year-olds starting up companies, and I can clearly see, right, 100 new Reliances in terms of where, and the aspiration, the confidence that they have. And finally, it is the confidence that you see. Fortunately, we now operate across the length and breadth of India. So it's not only the confidence in forums like this, but when you see the confidence in young people going to school and colleges, wanting, and in parents today believing that their tomorrow is better than today. Right? And that is a big, big change in India, that all of us, this is our baby boomer generation. This is the Indian generation that believes that they'll make a better tomorrow than today. And that's the confidence that we see as a result of all of this. And I don't want to rule out, like when everybody, we've also had, right, at least I think a sustained 15, 20 years of great law and order. Right? And that is a prerequisite to continuous economic growth, social harmony. All of these things matter in terms of that. And hopefully, like we are now setting the foundation for many, many decades. The world sees that. And that is why, even like after the budget, we had the European Treaty, we had, fortunately, the US. So the world is looking at us. We have, and we at Reliance get at least every month 3 or 4 global majors. We cannot say yes to everybody for partnerships in terms of saying we want to come to India and can we work together. So the world is taking notice of India. It's a tree laden with abundant fruit. And I've always believed that for profit and for prosperity, nobody needs an invitation, and that is why we are attracting all the people, and I think this is very, very sustainable over the coming decades.
Sustainable for the coming decades, and 100 more Reliances, in your words, from the startup ecosystem. If that is, comes true and that bears fruit, it'll be a very, very different economy, as you point out, Mr. Ambani. But, I want to understand from you, since we're talking about Jio BlackRock, we're talking about the opportunity for India's financial sector. A lot of people are asking, is the ambition and the aspiration to disrupt this business just as you did with telecom, Mr. Ambani?
Well, our ambition and aspiration starts with, what I admire about Larry. Right? And Larry is not only, the result-oriented CEO of a US top global multinational, But I think that he has a very compassionate and passionate heart, right? When he told me that, look, at the end of the day, purpose of BlackRock is not to just make short-term results or not even to make returns, for my investors and my shareholders. If I cannot put this money to work, first for the betterment of society, and as a byproduct, I give my investors and shareholders returns, then I would have done my job. And that is the Reliance philosophy too. We've always believed that our minds match. And the purpose of Jio BlackRock, And I think that disruption is fashionable, but the opportunity that we see is that Indians have really been savers, right from, if you look at our history, we have saved consistently over the last 5-6 decades. What has happened is that some of this saving has not been productive. If you see just the last year, we as India imported $60 billion worth of gold, and we imported $10 to $15 billion worth of silver. And all of this not for industrial use, but really for domestic savings in terms of... Now, this is unproductive. If we can actually convince the Indian saver that if one invests in the capital markets in a safe, transparent, and consistent way, there are returns. And these returns, we heard from all the three panelists, compound. And for us at Jio BlackRock, the opportunity is to encourage Indians to save, but to make sure that we give them the options to convert those savings into earnings and hopefully compound their earnings so that they not only work for themselves, but they also work for the Indian economy. And that propels the Indian economy to grow in terms of what we want to do. And then we all grow together. So yes, if you call that disruption, we will use technology, distribution to achieve that for every Indian household, for every Indian small business and large businesses. That's our objective.
So from the foundation and the beginnings of BlackRock, we never focused on targets of growth, ever. And yet, our focus has been relentlessly on the client, whether it's a client who's awarding us 100 rupees or a sovereign wealth fund who is awarding us tens of billions of dollars. If you are working on behalf of each and every client, and you're serving that client over a long horizon with good advice, with maybe a degree of safety, and importantly, just confidence building about the opportunities of compounding over a long period of time, through the utilization of technology to intersect more often, more frequently, to have deeper, broader relationship with your clients. That's how disruption occurs. But disruption does not occur because you set a target. The target is making sure you're living with purpose every day with each and every client. And if you can achieve that with consistency day after day, clients will reward you with more share of their wallet. And so to me, it's just it's a process. It's a process you have to earn every day, live every day. And if you do that properly and you embedded that in the culture of the firm, we can be disruptive, but you can't be otherwise.
Mr. Ambani, let me come back to you on the investing in India's growth opportunity and this new era that we're speaking about, and the role of making strategic choices today, which will require patient capital. And I want to understand from your perspective what it will take actually to build patiently with patient capital over the next 2 decades.
Well, I think that the Indian opportunity, as we stand at about $4.5 trillion of GDP in a $110 trillion world. Right? I see us outgrowing the world and finding our right place. So I am one of those believers who think that this 4.5 in a 20-30 year period, right, will outgrow the rest of the world, and we will hit $25-30 trillion. It's going to be 30 years from now, but as we do that, the India opportunity is a 10, 20, 30-year opportunity. And when you think about solving India's energy problems, I am a believer that in the next decade, India will not import 80% of its energy. We have a path, and God willing, with technological breakthroughs, we will be reasonably self-sufficient in energy. Investments in such energy sectors which make us self-sufficient are 20-30 year time horizons. Investments in physical infrastructure that we still need. We have the opportunity to build with today's technology the physical infrastructure for 1.4 billion people. We've done a lot, but there's a lot more to do. These are also 20, 30-year opportunities. Technological infrastructure. We are not going to be behind the world in terms of building country-scale intelligence infrastructure so that every village has intelligence available to them. And this also is a 20, 30-year opportunity. Each one of this is hundreds of billions of dollars of investment. And within that, while the benefits are there, right, they're long-term, sustainable, compoundable opportunities, and that requires sustainable capital, which comes both from within and outside. And to my mind, India is attracting, we ourselves, our own experience in most of our industries is that it is not capital which is a problem. It is opportunities and execution, right? And the ability to give an overall transparent framework to both the consumers and the investors, which is the opportunity. It's not going to be limited by patient capital. The world recognizes that India, because the world also doesn't have many such scale opportunities where they can deploy on a few projects hundreds of billions of dollars.
Absolutely. The market, of course, in India presents a very compelling opportunity across different sectors, as you spoke of. But Larry Fink, let's talk about AI and the power, the potential of AI. And you're a big believer in the AI story, not just for BlackRock, but in general. You know, the stock market volatility notwithstanding, the fact that we're spending hundreds of billions of dollars in this AI infrastructure build out, and this is sort of front-loaded spending, and there's a question mark still on the revenues and the returns. How do you sum up what is happening in the world of AI today? What do you look for? What do you look at?
I would first and state that I don't believe there's an AI bubble.
You don't believe that?
Not at all. I believe the greatest risk we have is if we don't invest and continue to invest, China will win. And I believe the need to rapidly expand the AI opportunities is necessary. That doesn't mean we're not going to have some bankruptcies. We'll have some failures. That's capitalism. You're going to have some big successes and big failures. But the opportunity that companies have in utilizing AI is going to be present in everything we do. I mean, even yesterday you had Anthropic announce a new model, which is going to be threatening for some businesses, but it's going to be an opportunity for other businesses. You mentioned Davos, and you mentioned the word cloud. There's no question AI is among the most topical conversations we're having now because it is disruptive. It's going to be disruptive for some industries, but it's going to also be very advancing. I mean, the future of AI in terms of drug discovery, in terms of humanity, is real. The use of AI for the development of new sources of power or cheaper sources of power, what can that mean in the long run for the global south? Could we have abundance in energy one day? Now that's still pretty far-fetched at this moment, but the opportunities of the acceleration of science is there. Rob Goldstein talked about, having the ability to use AI to learn everything about one subject in minutes now. And so AI is going to allow more discovery, more opportunities, and with that technology, like so many other technologies, it's going to be disruptive for some businesses and some economies. And the key for AI to be really successful in every society, we need to make sure that AI broadens economic success and it doesn't narrow economic success. We talked about that a lot in Davos the last 2 weeks, and that's going to be the real issue. Can AI be not only disruptive, but can it be expanding and broadening economic success throughout all economies? And that's going to be the big question about, how do we play that out? In the early part of AI, you're going to see countries that are huge winners and some countries that are going to be left behind. And so you have all this dynamism around how AI is going to be playing out. That is in the short run. In the long run, I think it's going to be more democratizing, but in the first few parts of AI, it's going to be more limiting. And so we look at AI as a huge opportunity. For us in navigating the $14 trillion that we manage on behalf of our clients, we have to use advanced technologies to process the business that we are already doing. And the same thing for all the other major companies. Through AI, you have better understanding of your clients, better understanding of your inventory controls. You have so many advantages.